Hello my dear friends, this is CA Chinmaya Hegde, your learning partner in PA Final SFM. So welcome to the one-day marathon on strategic financial management, CA Final. Objective of this session is to provide you the ready-made discussion for one day before examination. So for what kind of people this will be useful? Those who have attended my regular classes or fast track classes, this will be a very quick revision so that entire content can be revised at one stretch. If you have not attended my sessions, in some places some things might find new to you, but let me tell you, it will be definitely be worth it. For example, if I go for forex, when to multiply, when to divide, how to take the higher rate, lower rate, such things I would have done in a particular manner. So if you have not attended my classes, you might have done in a slightly different manner. But let me tell you, whatever method, even if it is something new to you, it is definitely worth it. Fine. So with that background, let us straight away go into the discussion. Before that, I am not solving any problems here. I will be covering all the conceptual part. Along with that, I'll give some examples. I'll write down, and you can also write down some numericals, but I'm not solving any questions. But because if I start taking the questions, it will not serve the purpose. It is purely conceptual purpose. I will discuss through all the charts what is meant for revision purpose. Fine. So let us begin. Okay, so now moving on. This is the main problem that CA students now will feel. Most of the cases, you have done so many books, so many concepts, so many formulas, so many problems, but how do you read one day before exams, or what do you read one day before exams? That is what I am covering it now. Okay, let's come to chapter 1, that is basic principles involved in SFM. Among all the 8 subjects which talks about various aspects, this subject SFM is purely about decision making, whether to do or not to do, whether to accept the project, when to buy the share, what is the value of the share, and so on. And decision is based on historical data. That is why many of our concepts will revolve around averages. And one of the methods is converting many numbers into one number. We call it as expected value, that is concept of probability. Now, decision making purpose means we need to compare few things, and here I would call it as cost versus benefit analysis. So when it comes to cost, we usually measured by market price, because only when you make a payment towards a product or an asset like a share, you get the share. So market price, option price, bond price, future price are all cost. That is what you pay to get the asset. And how the price is determined is always by market factors. Market factors means supply and demand. So market price is not determined by one individual person. It is always decided by market. So if somebody tells you compute market price, that is not right, because you cannot compute market price. But in Walter model, Gordon model, a fair value of futures, in option binomial model, we compute price, we compute theoretical price, we compute fair value, meaning what is supposed to be the price, but the actual price is available only in the market, that is determined by market factors, supply and demand. And when you make a payment, that is price, what benefit you get, that is called as value. Value of share, value of option, value of future, and so on, fair value. Now value is what you receive. So whenever we say value is more than price that is good to be purchased, because it's good, you get more. Whenever the value is less, that means it is less, so it should not be purchased. Or other way around, when the price is more, it is called as overpriced and that need to be sold. When the price is less, it is underpriced, it is good to be purchased. And value differs from case to case as well as subject to subject basis. It is changing from person to person, situation to situation basis. And in financial management, whenever we talk about the benefit, it's only about the present value of future cash flows. So what is the major thing that you need to remember here? Whenever it is price less than value, that is underpriced, and price more than value, it is overpriced. And price less than value, underpriced, means it is good to buy, and price more than value, overpriced, means it is good to sell. Keep this in mind. Now, basic assumption in financial management is zero position, which means if you borrow money and purchase something, there is a cost of borrowing, interest. If you use your own money and purchase something, that also has a cost, that is called as opportunity cost. So irrespective of the source of finance, there is always a cost of finance. This we call it as the opportunity cost or the cost of capital, or we can also say required rate of return. Different names can be there: opportunity cost, cost of capital, required rate of return, and so on. Okay, now coming to the valuation, I told you in financial management we only talk about present value of future cash flows. So there is time value of money, and time value of money in financial management we follow compounding interest. Compounding interest basic formula F equals to P into 1 plus R to the power of N, or important factor is whenever you want to compute something in financial management, we don't add, we multiply. We call it as multiplicative model. For example, if I want to add first year interest and second year interest, that is 10% and 11%, I don't add 21%, I don't get 21%. Though answer is approximate, we don't do it. What do? 1 plus 0.10 into 1 plus 0.11, 1 plus R into 1 plus R1 into 1 plus R2, and so on. So first year and second year, it is multiplied, and then you subtract the investment 1 rupee, then you get the interest. So multiplicative factor basic model basic is whenever I want multiple period return, I don't add the values, I multiply by 1 plus R, 1 plus R, 1 plus R, and so on, where 1 rupee is the investment made. For every 1 rupee investment made, what future value I get, then I subtract 1 rupee, that is investment, the remaining what I get is the actual return. That is multiplicative model. So present value, if it is one time future cash flows into present value, we use discounting factor, which is 1 by 1 plus R to the power of N. Remember, the discounting factor is multiplied, but it has the effect of division, because 1 by 1 plus R is multiplied. So though it is multiplied, effectively it is divided. And if you want to consider many cash flows into present value, that is called as annuity factor. So one cash flow into present value, we multiplied by discounting factor. Many cash flow into present value, we multiply by annuity factor. That is nothing but sum of discounting factor. Sometimes we may have to compute installment, where the formula is loan divided by annuity factor, which means present value is whatever the annual amount multiplied by annuity factor. And if I want the annual amount, which is installment, then present value by annuity factor. This concept is very important. We will be using it in places like option premium, in interest rate options, interest rate caps, where these kind of elements are being applied. Okay. Now finding the present value, we can follow two formats. For variable cash flows, I can follow year 1, year 2, year 3, year 4, separate cash flows, then separate discounting factor. Cash flow multiplied by discounting factor will give us the discounted cash flow. If it is annuity factor, instead of writing like this 1 to 4, we can write 1 to 4, then annuity factor. How do you compute? Or that I should give an example. Suppose discounting factor is 12%. So how do you do for first year discounting factor? 1 by 1.12 equals, let me write it here, 1 by 1.12 equals. Keep pressing equals, you will get the every year discounting factor. And if I press GT, then everything will get added. What I get is annuity factor. So to get the annuity factor, press equal to so many number of times as number of years, press GT, all the numbers are added. I know you can do with equal to M plus MRC, but I would recommend get a calculator with GT. That will save lot of time in examination. Usually discounting factor will be given in the exam, like 3 decimals, 2 decimals, 4 decimals, use it. If they have not given it in the exam, then please follow 4 decimals and give a note saying that while solving the above problem, 4 decimal discounting factor has been adopted. Fine, let's move on. Compounding need not happen only annually. Basic formula I told you, P into 1 plus R to the power of n. But compounding can be done half yearly. So what that is frequency of compounding can be more than 1 year. In such case, what do you do? The factor R should be divided, let's say the number of times it's being compounded, and the n will be multiplied by t. If it is half year, you divide by 2, in the power you multiplied by 2. If it is quarterly compounding, divide by 4, in the power multiplied by 4. If it is monthly compounding, divide by 12, and in the power multiplied by 12. And continuously compounding means you divide by infinity. Instead, the simplest form is P into e to the power of Rn. Some people also say e to the power of Rt. So R is the rate of interest per annum, percentage per annum, and N in all these examples are number of years. So whenever I say E, that means it includes 1 plus R to the power of infinity. So E is always approximate answer should be 1 plus R. So how to calculate E value? Usually in the exam, they will give you continuous compounding E value. If not, let me give you the example. There are two methods are there. Let me give you both the methods. First method, approximate value of E is 2.7183. So type that number 2.7183, square root 15 times minus 1 into this power what I'm like to calculate 0.12, then plus 1 into equals, not just equals, into equals, like that 15 times you get the number. One more method is also there. You can use this e to the power of R. I told you e to the power of something means 1 plus. So 1 plus R, that is there. Then R square by 2, R cube by 6, R to the power 4 by 24. So please be careful. Actually, it's easy to remember also. Please observe. Very easy. Please observe. So you have written R square by 2. 2 into 3, 6. 6 into 4, 24. You can go and so on. But these three numbers are fine. So if I put this as example here, e to the power of 0.12 equals 1 plus 0.12 to guarantee plus R square 0.12 square, then divide by 2, then 0.12 cube divided by 6 plus 0.12 to the power of 4 divided by 24. Use this in calculator, use equal to m plus, that method, MRC, finally you get the answer approximately I think 1.12749. Approximately that number you should get. You can try in the both the methods, but in the exam anyway they will give it to you, so you don't have to worry. And even if you calculate, be careful. When I say e per 0.12, the answer has to be 1.12. If it is e to the power of 0.05, answer has to be 1.05 something. If it is e to the power of 0.08, Answer has to be 1.08. Some more decimal should come. Okay, because E always reflects 1 plus R. Fine. And sometimes you have to calculate this also using probability expected value. So one column will be for random variables like expected market price, expected option price, and so on, or intrinsic value, multiplied by respective probability. The product, do the total, that will give you the expected value. But remember, expected value is nothing but an average. Okay, so that is about the first chapter. Okay, now moving to the second chapter. Second chapter as per your syllabus is risk management is there. So some theory chapters like risk management, debt securitization, and startup finance. 5 minutes I'll do at the end. So let me go to security analysis. Some basic factors of market that you need to understand. Market means it's a place where buyers and sellers meet. So one important point in market is, if you want to buy, there has to be another person to sell. If you want to borrow, the other person should be able to lend. So for every, that we call it as two sides of the same coin. One person, if you think that it is good to buy, other person should think that it is good to sell. So whenever you think about the market strategies like arbitrage strategy, speculative strategy, you should always identify the fact that you need to understand the other person aspect. That is, only when two person with opposite expectations meet, who want to buy, who want to sell, who need, or who want to have, who have surplus money, who require money, demand and supply. So only when these two aspects, opposite things meet, there is a market. So it might be stock market, money market, and so on. Currency market also. Coming to security markets, it's a place where the securities are bought and sold. Parties involved are buyer, seller, but more importantly, broker. So buyer cannot buy the product directly in the stock market. He needs his agent called as broker. Similarly for seller. And how the price discovery happens, I told you in the previous segment, price is always determined by market. And how does the market determine? Through this, that is supply curve. People who would like to sell shares, for example, with people who want to buy the shares. Person would be expecting it to sell at a certain price, let's say 50 rupees. Other person would like to buy at a certain price, let's say 49 rupees. Only when these two meet, come to a common point, that intersection point is called as the price mechanism. In India, market starts at 9:15 and ends at 9:30. Open price, high price, low price, close price. During the day, how the variation happens, but we usually understand only about the close prices with respect to the all our theoretical discussions. Okay, now how the stock purchase mechanism happens, just a quick recap. Buyer, when he wants to buy, he will go to a broker. Let me just do one small thing. Okay. Okay, so buyer, when he wants to buy a stock, he will go through his broker and they will place the order in the stock market. They will place the order. Similarly, seller who have the shares, who wants to sell, he will place an order through his broker in the stock market. That is for sale order. When the order for buy and sell happens, matches, then the price, where both of them are intersecting, the price will be determined for buyer and seller, and then delivery take place. So from the day from which the person placed the order till the day in which he takes the delivery, or for the seller cash, it takes transaction plus 2 time. That is the Indian mechanism, Indian stock market mechanism. The moment you place the order, once it is traded, it takes 2 days to complete the order. So order, trading and settlement, these are the 3 words you need to understand. First you place the order, then the trading take place when the order matches. After that, the settlement take place, either getting the shares or getting the money, and this game or this gap is 2 days, 2 effective working days. That's why it is called as T plus 2 days in rolling settlement in the Indian context. Okay, fine. Now, security analysis, like how do you say that, okay, this stock needs to be purchased. Now we are in the coronavirus stage. Okay, now which stock to purchase? You might say, okay, now I think pharma companies will do well. Let me buy pharma companies. That is one method. The other method is, I think Reliance is doing lot of good things now. They are finding lot of strategies. Let me buy the Reliance now. Or you might say, I think we should concentrate on the stocks which are not China based companies, because China based companies now for various reasons might face backslash, so China companies are not good. So these kind of analysis you come up with while picking up a stock. So broadly we are having two categories. One is called as fundamental analysis, other is called as technical analysis. Fundamental analysis talks about pure value. I gave an example, whereas technical analysis talks about price and charts, like okay, this chart is going up, upward trend, bullish nature, this chart is coming down, downward trend, bearish nature. Now this kind of chart, market is not showing any trend, that means it is having two-way market, two-side market. Those kind of analysis you do through charts, through statistics and estimations, that is called as technical analysis. Okay. Now coming to fundamental analysis. Fundamental analysis talks about three broad areas: economic analysis, industry analysis and company analysis. Economic analysis means how the economy is doing, how the politics happening, social factors, demographic factor. India is good place because average or median age of the Indian population is below 30 years. Young population, good to invest. Those kind of broad macro factors you analyze, that is called as economic analysis. You may consider national income, industrial sector, inflation, interest rates and so on. Industry wise, I gave an example. Now the whole world is facing problems with respect to the coronavirus. So pharma sector is going to be a good sector to invest. I'm not telling, that is an example. Or you might say that I think people will now move into online companies more. So let me buy online education companies, edutech companies. Those companies are good to buy. Many of those kind of analysis. It depends on the nature of industry, size of the industry, the volume, product life cycle, cost conditions, probability, demand supply gap, government policies and so on, many more aspects. Or you might say, give an example of Reliance. Reliance is going good strategy. They are getting disinvestments from Facebook. They are having a tie-up with so many corporates. Now they are removing the debt and replacing it with equity shares. So they will not have interest burden. Though those kind of company specific analysis is called as company analysis. So whenever you select a stock, these things are being considered. Okay, these are the aspects that you need to identify while making a decision about purchasing a stock or making a portfolio of stocks. Technical analysis, I told you, it's all about charts. Assumption is market knows everything. Prices moving in trends. History tends to repeat. That is the biggest assumption under technical analysis. That is, history repeats. Yesterday the price is like this, so same pattern will apply and it will continue like this. CA exams were difficult earlier, in the same pattern will be difficult now. So this kind of repeating the history, estimation through prices is called as technical analysis. Okay, trend charts, patterns are there. Few theory questions they can ask, like Dow theory. Let me do one small change. Okay. Dow theory. What is this Dow? Dow Jones. We call it as DJ, not your regular DJ. Dow Jones is one of the index in US market. So taking the US index, the Dow Jones, as the basis, this theory has been developed. That's why it's called as Dow Jones theory or Dow theory. What is the theory of this? they divide the market movement into three kinds of movements or segments. Primary market, the primary movement, which is the long term. Secondary movement, which is primary movement, will be like in the trends, like in the year 3 to 5 years kind of thing. You see the trend that is going to happen. Secondary movement will be like, let's say, 3 months to like 15 months, monthly category. And daily fluctuations like 5 days to 10 days, how the market will move, in which pattern they try to analyze. So whenever you identify a trend, primary movement, there might be upward trend, secondary movement might be downward trend. Like now what is happening now, in the coming 3 to 6 months, people are expecting things might go down, so secondary movement is down. Last 2 months also it is down. But if you look at 3 years history, 5 years long term, the market still might be going up. So these three, like primary movement, you can say long term, secondary movement, you can say medium term, and daily fluctuation is short term. This kind of analysis is called as Dow theory. Random walk theory says that, which is opposite of efficient market hypothesis, which says that the movement cannot be predicted. Movement cannot be predicted. Market is the movement of market is like a walk of a random person, random drunkard person, where one person is completely drunk, and if he starts walking, you know how it's going to walk? No idea. Random walk is also like that. If you want to compare a better thing, maybe you can compare a CS student after writing his exam. Maybe you people, final students, after writing the final last exam, how happy you are, or how blank you are. You don't know what to do, you don't know where to go, you don't know what else to happen. I mean, you're not really having anything, complete uncertainty. That is what is called as market. Nobody can predict. That is random walk theory. So random walk theory is complete opposite of efficient market hypothesis, or opposite of technical analysis. So what is efficient market theory says? Efficient market hypothesis is one of the important questions for theory. They say all informations are available reflected in price. Market is best. If they say the share price of Infosys is 610 rupees, that is best. Nobody can object to it. Market is supreme. Market is God. That's what efficient market hypothesis says. The test for hypothesis also, they are having weak form of efficiency, semi-strong of efficiency, a strong form of efficiency. So these three things are to understand the market movement, what factors are involved. If I say only using the price, I can tell what could happen to the price in the future. Price is my input. Price is only input. That is called as weak form. It reflects only price. It consider price not only volume, that is how many units are purchased, how many shares are purchased, what is the daily turnover. So when I consider the price as well as volume, it is called as semi-strong efficiency. If I consider price also, volume also, and then other data which are publicly available, it's called as strong form of efficiency. It's like using the prices, I can predict. That means market is weak. Using the price, I cannot predict. That means market is not weak. But using the price and volume, I can predict. That means market is semi-strong. Hope you're able to understand what are the aspects that would be involved in efficient market theory. There is something called as empirical evidence, process of statistical analysis, correlation test is there. Only one time it came in the exam. It is there in your study material or in practice manual. I will give you the formula. I'm not going to solve the problem. Okay. So the steps are like this. First step, compute the mean using mu equals 2n1 n2 by n1 plus n2 plus 1, where n1 is number of positive signs and n2 is number of negative signs. How do you say number of positive signs and negative signs? Suppose today market is 10,000. Tomorrow it became 10,500. It became 9,000, 9,200, 9,500. See, 10,000, 10,500 is plus. Then 10,500 to 9,000 is minus. 9,000 to 9,200 is plus. 9,200 to 9,500 is also plus. So number of positive signs becomes 3, number of negative signs becomes 1. Similarly, you use the standard deviation applying this formula. Then compute the interval using mu plus or minus the t value multiplied by standard deviation. Mu value you computed here, standard deviation you computed here, then t value, the t distribution value will be given in the problem that you choose it, where t is n minus 1 degrees of freedom, or we'll say we have n1 plus n2 minus 1. You do this, corresponding number t value will be given in the problem. So then you compute something called as n called as number of test runs. Number of test runs means where the direction is being changed. For example, please observe here, now you start with plus, plus became minus, there is a direction change, minus became plus, there is a direction change, but plus plus no direction change. So starting with plus, count as 1, became minus, then 2, minus became plus, then 3, then plus only 3. So you have in this example, that is 3 test run being there. Like that in the problem you can apply. So on one hand you have the interval in the step 3, on the other hand step 4 number of test runs. If the n what you computed is outside the limit what you compute in step 3, that means we say market don't exhibit weak form. Basically we say market is not depend on prices. If n is within the limit, like this limit what you calculate happens to be, let's say 10.92 and 18.45, and number of test runs let's say 16, in between these two numbers, then we say market exhibits weak form of efficiency. If this number say it is 20 outside these two limits, then we say market does not exhibit weak form of efficiency. Okay, now coming to the next chapter, that is bond valuation. Okay, security analysis is what the institute has given a chapter. I'm doing that. Security valuation. Security valuation means it will include bond valuation also and equity share valuation also. But there is one more chapter, corporate valuation, that comes later. So I don't want to mix between those two, that there is corporate valuation which talks about equity, then security valuation talks about equity. To avoid this confusion, in security valuation I only talk about bond valuation. In corporate valuation I include equity share, economic value added, dividend valuation, everything. So corporate valuation will consider the comprehensive coverage of equity elements, and security valuation I'm going to do now, I'll only talk about bond valuation. Okay, let's go to bond valuation. The bond valuation has got these elements, like okay, we have to compute the how to go for value of bond, how do we compute YTM, yield to maturity, what is duration called as Macaulay duration, volatility, modified duration, convertible bonds terms, yield curve and forward rates, bond replacement decisions, and also convertible bonds I've talked about. So these are the areas that we need to understand. Only this bond replacement decision is from issuer perspective, rest everything else is from the investor perspective. You understand, no? Person who issue bonds, other person invest bond, like equity shareholder and the company is the issuer and the shareholder is the investor. So all of these aspects we only talk about the investor, only bond replacement we talk about the issuer point of view discussion. Okay, coming to bond. What is the basic difference between a bond and a loan? Both has rate of interest, both has repayment, and both has some security, and sometimes it might be unsecured. The difference is loan is a contract, bond is an instrument, which means loan cannot be traded. Bond can be traded. Loan cannot be purchased and sold. Bond can be purchased and sold. That's why bond valuation is important. Okay. So keeping the basics in mind, bond is an instrument, means marketable, tradable, requires valuation, representing debt, loan, rate of interest. So it is a fixed income security. It will have a face value, and on the face value you apply interest. That interest is called as coupon rate, and there will be a frequency of repayment like annual, semi-annual, etc. It will have a maturity period also. Sometimes it may not be maturity, we call it as perpetual bonds, that is also there. So it might be fixed rate bond or fluctuating rate bond or floating rate bond. Fixed rate bond means interest rate, the coupon rate is decided at the time of issue itself, whereas floating rate bonds are not having a fixed rate of interest. When it will be determined, it will be determined periodically. For example, every annual beginning of the year they will fix what could be the end of the year coupon rate, and next year beginning will be for next year end coupon. So at the beginning of every period, whatever the coupon for that period is determined, that is called as floating rate. Interest rate is variable depending on the market rate of interest. The type of repayment may be regular bonds. Regular bonds means you pay coupon regularly, and on the maturity date the principal amount is repaid along with face value or maybe at premium. Annuity means like a loan, you repay installments, which includes principal as well as interest. Perpetuity means it will be repayable only in the event when the company is liquidated. Until then only coupon is paid, no repayment. Zero coupon bond is opposite, no face value or no coupon payment, only redemption, no coupon, zero coupon. Now coming to value of bonds. Coming to value of bonds. You see, in SFM, any chapter you take, value means present value of future cash flows. Now with respect to bonds, what are the cash flows that are involved? Once you purchase the bond, of course you have to purchase. For purchase you have to pay premium, you have to pay the market price. What benefit you get? Being a bond holder, what you receive? You receive over a period of time. That present value is called as value of the bond. Okay, so what you get over a period of time? Coupon every year. Remember, these are all remaining cash flows, not the cash flows in the past, cash flows in the future, remaining time till maturity, remaining time till maturity. So whatever the coupon is there, which will happen over a period of time, might be periodical, annual, half yearly, etc. And last year you get the redemption price. Redemption price, if nothing is specified, means face value. And when you discount it, present value means discount it, that is you discount it at required rate of return, or it can be opportunity cost, or it can be cost of capital, and so on. When you discount it at required rate of return, that value what you get is called as the value of the bond, or it is called as intrinsic value of the bond. So this value of the bond, let's say, is 1050, and market price of bond, let's say 1045. So would you recommend to buy or sell? Since the market price is less, it is underpriced, and when it is underpriced, it is recommended to buy. So underpriced means good to buy the bond. Okay, now, or instead of calculating like this, coupon is same every year, only last year redemption price will change. Coupon you club it. Instead of discounting it every year, use the annuity factor. But for redemption price, no annuity factor. You will have to use the discounting factor only. Okay, the format what we follow for computing this value of the bond. Okay, like I've explained earlier, you can do like every year coupon separately, year 1, year 2, year 3 coupon. Last year the coupon and redemption price will be there. Discounting factor you multiply, you get the discounted cash flow. Or since coupon will have same discounting factor, you can use annuity factor for that. But for redemption price, you have to use the discounting factor. The total what you get is called as the present value, nothing but the intrinsic value of the bond. If the price is less, that bond is good to purchase. Now, cash flows in the bonds, initial cash flow, market price, that is, I'm just repeating myself, that is what you pay to enter into the bond market. Then once you enter, you get the interim cash flow, which are coupons, and the last year what you get is terminal cash flow, redemption price. When nothing is given, redemption price is equal to face value. The value of the bond is present value of cash flows, present value of coupons, and present value of redemption price. And for coupon, you can take the annuity factor. For redemption price, you can take the discounting factor, where discounting rate is required rate of return. Okay, now comes. Please understand. In the example I gave you, or before that, let me give you one more thing. Let me give you one more example. Then I'll go to this chart. Whenever you see the rate of interest is increasing, whenever the required rate of return increase, what will happen to the value of the bond? Look at this. Rate of return is in the denominator. When denominator increase, value will decrease. So the important observation is coupon, or let's say required rate of return, is more than coupon rate. Means they are giving 10%, you want more. When required rate of return is more, the value of the bond will be less than the face value, because when you require more return, you pay less. When you want more return, you pay less. So if required rate of return is more, then the value of the bond will be less. If required rate of return is less, value of the bond will be more. You can just remember inverse relationship. You can remember the inverse relationship. Market required rate of return is less, the value of the bond is more than face value. Required rate of return is more, the value of the bond is less than the face value. So that when before even computing, you should know the answer. For example, they say face value is 1000, coupon rate 12%, required rate of return, let's say 15%. Compute the value. Now before even computing, your mind should tell required rate of return is more. When you require more, you pay less. So answer will be around 900 something or 800 something or 950 something, but less than 1000. Hope you got it. When required rate of return is more, the value of the bond will be less. Okay, that is one. Now value of the bond is there. If I want to compute the implicit rate of return, that means what is the thing we have just calculated? Just go back to the calculation. Yeah. Now based on the coupon, redemption price, and the required rate of return, I got the value of the bond. If the value of the bond and compare the bond with the price of the bond, you determine whether good to buy or good to sell. Now imagine if I want to make this value of the bond as price of the bond, then what is my discounting rate? What is the discounting rate such a way that the present value will be equal to the market price? What is the rate of return provided by the bond by making present value equal to market price? Value of the bond is computed based on individual required rate of return. Then what is that bond is providing? From instrument point of view, implicit rate of return, internal rate of return is called as YTM, yield to maturity. So what should be the present value? Such a way that the present value, the discounted value will be equal to the price. Such discounting rate is called as YTM, yield to maturity. Remember, the required rate of return is from the individual person's point of view. So when I discount it, I get the value of the bond. But YTM is from the instrument point of view. Therefore, when I discount it, I don't get the value of the bond, I get the price of the bond. YTM and price both are from market point of view. One individual person cannot control it. Okay. Now that is about the YTM. YTM can be calculated in two ways actually. Let me give you the formula. I have not mentioned here. So value of the bond, you done it. Now come to YTM, yield to maturity. So YTM is coupon rate plus redemption value minus coupon divided by minus market price, current market price, divided by remaining life, number of years, whole divided by redemption value plus market price divided by 2. Or you can use the IRR method or interpolation method. What is interpolation method? You take one higher rate and lower rate, then between those two you try to estimate such a way that it will be equal to the market price. Interpolation method, that is called as value of the bond. So at required rate of return, present value is value of the bond or intrinsic value of the bond. But at YTM, present value is market price of the bond. Present value is market price of the bond. Fine. Let's go further. So what we have understood so far in this chapter, value of bond and YTM. Two things we have understood. Let's go further. Duration of the bond or Macaulay's duration. Duration means, okay, theory is there, you can read through it. Once you become a bond holder, you get coupon, let's say for year 1, year 2, year 3, and last year you get redemption price. So many cash inflows are there. If I consider an average of these cash inflows, that average maturity is called as duration. But every cash flow is not equal. Coupon is equal, but last year redemption price is equal. So the amount is not equal. Then what you should do? The amount should be multiplied by the weights. That is what we need to calculate as an average. So what is Macaulay's duration? Duration, very simple words. Keep it in mind. Very simple words. It is a average maturity period. Average maturity period. Average maturity period. So consider each period like a separate instrument and take an average of it. Can I divide by number of years? No, because it is not a simple average, it is a weighted average. So how do you calculate the duration of the bond? Duration of the bond is calculated by this. You can use shortcut. I'll use a shortcut formula also. This is the format we are going to follow. Year, cash flow, like let's say 5 years, year 1, 2, 3, 4, 5. First year will be coupon, I'll say C. Second year coupon, last year coupon plus redemption price. Nothing is given, face value. Then you do discounting factor at YTM. Remember, discounting factor at YTM. Then you do the discounted cash flow. Then you do the product. How do you get discount cash flow? Cash flow into discounting factor. How do you get the product? Year column multiplied by DCF column year and DCF, that will give you the product. Remember, DCF you are treating like a weight. Then you do the products, you do the total. The weight also you do the total. Best part about the weight, because you're discounting at YTM, the discounted cash flow should be what? Market price. The formula is the summation XW by summation W. This is the product column, this is the market price. So instead of writing summation W, what I've done is market price. That will give you the duration, average maturity period. One more point to be kept in mind is, institute sometimes what they do, they convert these weights into decimals. So DCF divided by total, you get the decimals. Then the decimals multiplied by year, again a world average, you get the same answer. So that method also sometimes is there. And one more, the shortcut method also there, that also you can follow. It's slightly complicated, but you can get the answer in one line. So 1 plus YTM, YTM yield to maturity, C stands for coupon rate, and T stands for remaining time to maturity. So using this also shortcut, you can find out the duration of the bond. For zero coupon bond, the best part about this duration is equal to the remaining time to maturity, because coupon will not be there. Coupon will not be there means you will have only the remaining time to maturity. Okay. That itself will be equal to the duration of the bond. So YTM is maturity, C coupon rate, and T is time to maturity. Okay. Okay, so you got it. How do we calculate the duration of the bond? It's also called as Macaulay duration, nothing but average time to maturity. This duration is also to be used for the concept of bond immunization. I'll come to it in some time. One extension of that duration is volatility, or also called as modified duration. See, what is the basic input variable for the bond value calculation? All the coupons, that is cash flows, and the redemption price discounted at YTM will give you the market price. If YTM changes, the market price will change. The coupon and redemption price are fixed, they don't change. So what are the factors that will have an impact on changes in the value of the bond? One is YTM, other is the market price. So when the YTM changes, the market price also will change. Correct? Now that connection is called as volatility approximately. It's also called as the first derivative of the bond value function. So if you differentiate the bond function, the first derivative is called as the volatility. Formula is very simple, duration by 1 plus YTM. What is the interpretation? Let me come to it. Okay, so interpretation, if volatility is 3 more than percentage, it's better you understand it as times. That is, if YTM changes by 1%, the market price will change by 3%. In fact, when the YTM increase by 1%, the market price will decrease by 3%, because the price and the YTM have got inverse relationship. When the YTM changes, the market price will change. By how much it will change, that is given by the connection volatility. Therefore, you can also understand volatility is the sensitivity between the interest rate and the market price. Okay, so this is the one aspect you need to keep it in mind. YTM market price is inversely related, I told you, sensitivity also is there. So higher the volatility, that means the bond is higher responsive, higher sensitive, therefore higher riskier. Higher the volatility, the bond is higher riskier. Okay. Now relationship between the YTM and market price, I just told you now. Let's say y-axis, I will say YTM, x-axis YTM, y-axis is the market price, and the relationship is inverse, therefore it is downwards in nature. Now imagine downwards is a curve relationship. Now let me draw one, let's say a line. Hope you can see the line here. Yeah. This rate of change between the line is called as volatility. The rate of change between the line tangent is called as volatility. But you see, it is not a linear relationship. Please observe here, my dear friends. When the movement is small, a linear, non-linear, both are fine. But when the movement is big, you see from this point to this point, there is a deviation between the line and the curve. That is called as, the deviation is called as convexity adjustment. Put it in very simple words, this is what you should know. Volatility establishes linear relationship between YTM and market price, whereas actual relationship is curve, which is measured by convexity. So linear relationship is volatility, actual curve relationship is convexity, and the difference between these two is called as convexity adjustment. So far questions have not come in the exam, but theory may come, just be aware of it. Anyway, if you want to compute the theory or calculate the value of convexity and then convexity adjustment. Convexity means the price of the YTM if it increases plus price of the YTM if it decreases minus 2 times the current price. Price if it goes up, price if it comes down, minus 2 times the current price divided by 2 times the current price into delta YTM, means change in YTM square. Like if I say 1% change, 1% change, here I'll write it as 1% change square, 0.01 square. That value is called as convexity. Convexity is the actual relationship between the market price and volatility. And you want to do a convexity adjustment, the difference, that is what is the C, what you calculated into the change in YTM whole square. That's what you call it as convexity adjustment. Okay, moving on. One of the utilities of the bond duration is bond immunization. Now bond immunization means whether the market is increasing, market rate, interest rate, or interest rate is decreasing, your value need to be protected. How it is to be protected is what is going to happen here. Okay, so for example, one bond is having a duration of 1 year, another bond is having a duration of 4 years, but your holding period is 2 years. So you want 2 years, but one bond is having 1 year duration, not maturity, duration, other is having 4 years. Then what you should do? You should make a portfolio. You should invest in both of these bonds such a way that their weighted average will come to 2 years. So in that case, what happens is, if the interest rate goes up, on one bond you get profit, other bond you get loss, overall your profit or loss is minimized. Even if interest rate comes down, on one bond you get loss, another bond you get profit, on an average you get equalized. So whether the YTM increase or decrease, your value of portfolio is protected. So simple, bond immunization is a process of investing in multiple bonds such a way that the market movements in the interest rate don't affect your fixed income portfolio. How it is achieved? Bond immunization is achieved by bond immunization is achieved by investing in multiple bonds, maybe more than two also, investing in multiple bonds such a way that their weighted average duration will be equal to the optimum, or will be equal to the intended required holding period. So what are the steps to be followed are here. Steps are: step 1, determine the duration of each bonds, 3, 4, whatever the number of bonds, find out the duration. Once you do it, compute the proportion of investment, that is, you should invest in both the bonds, in the first bond also, second bond also, such a way that their weighted average will be equal to the actual required holding period. Find out such weight, that is the weights proportion in which the amount need to be invested. Okay, then if you want 1 lakh after like 2 year in my example, and this weight happens to be, let's say, 60%, 40%, that 1 lakh don't divide 60%, 40%, because 1 lakh is required after 2 years. So what should you do? 1 lakh should be divided by the discounting factor, or multiplied by discounting factor of second year. That will give you the present value. That present value amount divide in the proportion of the weights determined in step 1 and step 2. Okay, then you can divide by the market price. You will get the number of units, if they ask number of units. One question you may ask, sir, how do you know the discounting factor of both of these bonds are same? Both bonds can have different YTM. Different YTM means different discounting factor. When you invest, you should invest in same risk bond, same credit rated bond, AAA bond, AA bond, like that. You should invest in same bond or same category of risk bond, so that same will have the equal YTM. So discounting factor also can be equal. So let me repeat the steps. Step 1, compute the duration of the bonds under consideration. Step 2, compute the weight such a way that the weighted average duration of the bond, the proportions multiplied by the duration, is equal to the required holding period, and divide the present value of the amount required in the weights that was determined, that is the amount to be invested in both of these bonds. This process of investing in the bonds by considering the duration so that their impact on the portfolio will not be there is called as the bond immunization. Okay, next comes to yield curve. See, when you go to bank, they will display this fixed deposit rates. They will be like 0 to 180 days 3%, 181 to 365 days 6%, more 1 to 3 years 7%, more than 3 year 7.5%. So what are these rates? All of these rates are per annum basis. All of these rates are per annum basis. So if you observe here, what exactly it's happening, this the same data if I represent it. If you deposit for a half year, 6 months, how much you're getting? Just 3%. If you deposit for, let's say, 1 year, 365 days, you get 6%. If you deposit for 1 to 3 years, 1 to 3 year, then you get 7%. More than 3 year, you get 7.5%. More than 3 7.5%. So if I join this curve, that is called as yield curve. So what is an yield curve? Yield curve is reflection of the yield for a bond or a similar bond which are same in all respects except maturity. Correct, no? When you deposit in, let's say, Bank of Baroda, or let's say State Bank of India, For 1 year, they give one rate of interest. One more year, they give one more rate of interest. I'm not comparing two different banks here. Same bank, but different maturity period. Same credit risk, different maturity period. So yield curve is representation of the income or the rate of interest for the same or similar bonds, the only difference being the maturity period, and all these rates are per annum basis. Hope you got the yield curve. Now suppose 1 year you got, let's say, 12% rate of interest. If you deposit for 2 years, you get 13% rate of interest. Okay, now remember this 12% is per annum, 13% is also per annum, and 12% per annum for how many years? For 1 year, right? And 13% per annum for how many years? 13% per annum for 2 years. So 13% into 2 means for 2 years, because per annum. So if I ask you one question, think carefully. What is the incremental return for second year? Incremental return for second year. How much you get? Is it 13%? No, 13% is not for second year. 13% is for 2 years. Approximately, first year if you deposit you get 12%. If you increase your holding period by one more year, that is 2 years, for both year you get 13%, which means approximately 26%. So for increasing 1 year, you got incremental return of 14%. That is your incremental benefit, like your marginal cost. Like your marginal cost. This incremental rate of return applicable for a certain number of years incrementally is called as forward rate. When I say yield, it means it's applicable for certain number of years. When I say forward rate, it is applicable for a particular year. For example, if I tell you 13% YTM of year 3, that means it is 13% per annum for 3 years. If I tell you 13% forward rate FR3, that means it is 13% for third year. So YTM is like an average rate, whereas forward rate is like an incremental rate. It is applicable only for a year, whereas YTM is applicable for a certain number of years. Hope you got it. Now using the forward rate we can compute YTM, or using the YTM you can compute the forward rate. Vice versa, both are possible. Okay, let me give an example. Suppose first let me give you a basic example, then let me go for formula using the forward rate. Okay, so year forward rate. Year 1 10%, year 2 let's say 11%, year 3 let me say 14% or 15%. So YTM, how do I calculate? I'm using very simple average method here. First year forward rate YTM, first year same. Second year, first year forward rate, second year forward rate, I need to take an average. So 10 plus 11, average is how much? 10.5. Third year, how do I do it? Average of all the three, 10 plus 11 plus 15, that is 36 by 3, 12. So average rate is nothing but YTM. Vice versa also true. YTM base is also, we can compute the forward rate. Okay, now 1 plus forward rate. Now we can reach the same destination using the forward rate and using the YTM. Okay, same answer should come. What is the difference? When I say forward rate, every year can change, but YTM for every year should be same. Okay, so 1 plus forward rate for year 1 should be equal to 1 plus YTM of year 1. So basically first year forward rate YTM both are equal for first year. Second year you do from forward rate multiplicative model, 1 plus forward rate of year 1, 1 plus forward rate of year 2, and YTM side 1 plus YTM of year 2 whole square, because for both the years YTM should be same. Correct? Now third year means 1 plus forward rate of year 1, 1 plus forward rate of year 2, plus 1 plus forward rate of year 3 into 1 plus YTM year 3 whole cube. If I have to represent this in a graph format or a chart format, it looks like this. Give me 1 second. One second, so that it becomes visible. That is my intention. Okay, now it's visible. Okay, so from year 0 to year 1, then year 2, then year 3. Now year 0 to year 1, forward rate, multiplicative model, 1 plus forward rate of year 1 using forward rate. Second year into 1 plus forward rate of year 2, different rate. Third year into 1 plus forward rate of year 3. YTM means how do you do? First year same, 1 plus YTM. Second year how do you do? From 0 to 2, same YTM should be there. Second year YTM should be there. So 1 plus YTM 2 whole square. Like same YTM will be there. First year also, second year also. Third year means 0 to 3, 1 plus YTM of year 3 whole cube. Hope you are able to understand what is really happening here. So forward rate 1 plus FR1, 1 plus FR2, 1 plus FR3. But if I want YTM, 1 plus YTM square or 1 plus YTM to the power of cube, because YTM should be same for every year. Okay. Now, again am I repeating? 1 plus forward rate of year 1 is equal to 1 plus YTM of year 1. But second year 1 plus FR1, FR2 on the left hand side and 1 plus YTM2 square. Similarly for third year. So therefore, first year forward rate and first year YTM will be same. Sometimes what happens, you may have to calculate the forward rate using YTM, using the bond price, price valuation method. So for that method, please remember this format. Cash flow of year 1 is first year discounting factor. Cash flow of year 2, second year discounting factor. But you can't choose same rate. So what I have done, 1 plus forward rate of year 1 and 1 plus forward rate of year 2, multiplicative model, that is discounting factor for year 2. Discounting factor of year 3, what do you do? 1 plus forward rate of year 1 into 1 plus forward rate of year 2 into 1 plus forward rate of year 3. That's how I got the third year discounting factor, and then I do all of them, I will get the market price. So when they give you, they will give you like this. They'll give you like duration, market price, like coupon, maturity, something like they will give you maturity. So what you should do, first you calculate for a bond having 1 year maturity, means only this will be there, coupon by 1 plus FR1. That will give you forward rate of year 1, whatever the number you get. Then second year bond will be there, mix those two. 1 plus forward rate of year 1 you have computed, use this year also, 1 plus FR2, that FR2 you need to simplify, thereby you get forward rate of year 2. How did you compute the forward rate of year 1? Using bond with 1 year duration, maturity. How do you compute FR2? Using a bond with 2 year maturity. Then next step what will be there? The third one, third bond will be, first year will be there, second year will be there, third year will be 1 plus FR1, FR2. These two are already calculated, and 1 plus FR3 means that is going to be simplified. So like that you calculate the forward rate for every year when they have given you the different bond price, market price. I'm not solving any problems here, because if I start solving problem, it will become a crash course. So this is only purely the revision using concepts, not solving any problems. Okay. Now, before we go to the convertible bonds, let's discuss this one bond replacement decision. Bond replacement decision. Okay. Okay. Bond replacement. When it will come, why it will come? A company has already issued the bonds. A company has already issued the bonds. It has already committed for a coupon rate. But in the market, what is happening? Like now, what is happening? Everywhere the interest rates are falling. Can you pay the lower rate of interest? Not possible, because you have already committed for a higher coupon. So you are already committed for a higher coupon, but in the market the coupons rates are coming down. You want to take the advantage of the lower coupon rate. How do you make use of it? The existing coupon, existing bonds, you redeem it, you pay it off, and the new bond you are going to purchase it. So in the existing bond you could have paid the higher coupon that you saved. In the new bond you are paying the lower coupon. That is what you wanted to achieve. It's like you're having one relationship and you are finding some more new person interesting. You understood what is happening? You're in a relationship, but you're finding one person interesting. So what do? You'll have a breakup with this person and you enter into new relationship. So when you have a breakup expenses will be there. And when you enter into a new relationship, initial expenses will be there. When you redeem the old bond will have some cost. When you issue the new bond will have cost. So considering this cost and the benefit being your savings in coupon rate, overall is the NPV positive? If it is positive, the bond should be replaced. If not, the bond should not be replaced. Okay, so that is the idea. So look at the heading. One option for you is continue with the existing bond, one column. Second column, redeem the old bond and issue the new bond. That's what we're discussing. And incremental cash flow is B minus A. The problem with the institute is many times they will not, or most of the times they will not give you these two columns. They will give you only the last column. But follow this columnar method, you will be able to achieve better. Okay. Now divide the cash flows into three timelines. All big problems I solve like this. First, initial cash flow, what happens today. Then interim cash flow, okay, what happens during the course of bond life. And terminal cash flow means what happens once the bonds are redeemed at the time of closure. Okay, now if you continue with the existing bond, redemption of bond, call premium, issue of bonds, issue cost, tax impact, nothing will come, because these are the cash flows that are important only when you are going to redeem the bond and issue the bond. Okay, now let's come to the point B. When you decide to replace, what will happen? Redemption of old bond means that will be outflow. Old bond will be redeemed to the extent of face value. Then call premium because when you redeem the old bond, you may have to pay more because you're having a premature payment. It's like when you repay your loan earlier, pre-closure loan charges and all will be there, that kind of thing. Premium payable to debenture holders in the event of early redemption, premature redemption, that is call premium. So that is also going to be outflow. And how do you calculate it? Face value into the premium into 1 minus T after tax. This premium will be allowed for expense. So 1 minus T. Then issue of new bonds will be inflow. That is again face value. Then issue cost will be again outflow. Issue cost, if they give you percentage, face value into whatever is the percentage. But don't multiply it by 1 minus T. Don't multiply it by 1 minus T. The reason being, these issue cost will not be recognized for tax purpose immediately. This is a new bond. So over a period of this new bond, this issue cost will be amortized. So don't take it now. Fine. Then tax impact on amortized issue of old cost of bonds. This is interesting, important. Old bonds, when it was issued long time back, would have issue expenses, not the new bond, old bond. And how the issue expense would have been recognized for tax purpose over a period of life of the bond, old bond. But now the old bonds are redeemed earlier. Therefore, those old bond issue expenses should be transferred to P&L account earlier for tax purposes earlier. Whether allowed for tax purpose, I don't know, but logically it has to be allowed. Because as long as the bonds are there, issue expenses are amortized. Bonds are not there, issue expense also are not there. So old issue expenses amortized fully because of premature redemption is what I need to consider. And this issue expenses for old bonds were already considered. Then what is not considered? Only the tax impact. Therefore, it will be inflow, tax saving, tax shield, whatever is the unamortized cost, old issue bonds cost, old bonds issue expenses that you consider. So after considering all, whatever net will come in the outer column, incremental cash flow. Okay, now then coming to interim cash flow, old bond, you have one old face value, old coupon, you can do into 1 minus t after tax, same face value into new coupon into 1 minus t. This is the outflow of interest cost coupon under existing bond under new bond. Then old bond, if you continued, amortization cost would be there, that whatever the amortized cost into tax rate, because it's a benefit, here also into tax rate it's a benefit. Then consider all of them, consider net, that is my incremental cash flow on interim basis, annual basis. Then last year redemption price, usually it will be face value under both the cases, because usually they would have been redeemed at face value, and incremental amount. Then consider all three amount net present value. If it is more than 0, bond should be replaced. Keep it in mind, this initial cash flow, no discounting factor, it's already in present value. This what you have interim cash flow, interest cost and amortization is to cost net amount, will come every year, so multiplied by annuity factor. And redemption price, what you have got, this incremental value is only on the last year, usually this will be 0, but anyway, if some extreme case some amount comes, you multiply by discounting factor, that then you consider the net impact. If net present value is more than 0, then the bond should be purchased or replaced, and I mean old bond should be replaced with the new bond. So this is about bond replacement decision. Okay, now moving on, last segment here, the bonds, convertible bonds. What are convertible bonds? At present you are a bond holder, but anytime you can convert it to shares, convertible bonds, and the ratio of conversion is called as conversion ratio. Okay, so certain terms you have to understand. Let's understand one by one. One is called as the stock value or conversion value. This means if you convert today, if you convert today from bond price into shares, what is your value of holding? Formula is very simple, market price multiplied by conversion ratio. Okay, market price of the share is the value per share, conversion ratio is the number of shares you get. Suppose the ratio, conversion ratio is given as 20:1 and market price of share is, let's say, 12 rupees. So how much do you get? Ratio 20:1 means one debenture, one bond will give you 20 shares. You get 20 shares. And what is the value for share? 12. 20 into 12, 240. That is what is called as stock value. Conversion premium. Premium means how much more value you are paying to remain in bond. How much extra to remain in bond. Suppose convertible bonds. has got market price of 265. 240 if you convert it to share. 265 if you remain in bonds. So how much extra you are paying to remain in bonds? 25. The 25 is what is called as conversion premium. Market price of convertible bond minus stock value of the bond. So in the convertible bond, what is stock value? The extra what you are having, the extra element what is there is called as premium in rupee terms per bond. If you divide by number of shares, or if you divide by conversion ratio, that is going to be conversion premium, that is going to be premium per share. This formula is per debenture. If I divide by conversion ratio, it will be per share. Or if I divide by the what is this stock value, then I get the premium in percentage. So premium can be expressed in per bond basis, per share basis, or also on a percentage basis. Downsize risk. See, you are having convertible bond. Convertible bond means you have the right to receive coupon and redemption value, or you can convert, right? So even if conversion portion becomes 0, you still have the right to receive coupon redemption price. That value is called as the straight value. So in the convertible bonds, you have got the right to receive coupon and the redemption price. The value of those cash flows, the present value, is called as stock value. In other words, even if the conversion option becomes useless, the straight value, so not stock value, straight value of the bond is still there, which will give the right to receive the cash flows in terms of coupon and redemption price. Those values are called as straight value of the bond. So what is straight value? In the convertible bonds, the element of coupon and redemption price is called as straight value of the bond. So straight value of the bond is calculated as the coupon multiplied by annuity factor plus redemption value multiplied by discounting factor. But remember, the factor has to be non-convertible bonds. The cash flows, coupons, redemption values are all convertible bonds. But the discounting factor, required rate of return, expected rate of return is based on non-convertible coupon rate. Non-convertible coupon rate are considered as a discounting rate. But the cash flows considered are from the convertible bonds. That present value is called as straight value. And convertible bonds will be more market price because you will have conversion option also. So the difference between market price of convertible bond and straight value of the bond is called as the downsize risk. So we understood stock value of the bond, conversion premium, downsize risk, and conversion parity price. Okay, last one is there. Conversion parity price are also called as market conversion price. This is at what rate or when it's beneficial to convert it into shares. Let me take the same example. Convertible bonds, market price is 265. Conversion ratio is, let me say, 20:1. And market price of share is, let's say, 12 rupees. Now, is it worth converting it now? What will happen if you convert 20 into 12? 240. Not worth it. If it becomes 13 rupees, is it worth it? 20 into 13. 260. Not worth it. If it becomes 14 rupees, 20 into 14. 280. This will be more than 265. But instead of calculating like this one by one, why don't we find out the rate, the price, like a cutoff rate? Crossing this rate, convert it to share. Below this rate, don't convert to share. The formula is very simple. The formula is convertible bond price by conversion ratio. So like in the example, convertible bond is 265 by conversion ratio is 20. I think you get some 13.25 or something. So whenever the market price crosses 13.25, then the bond should be converted into shares. As long as it is below 13.25, the bonds can be remained in bonds. Can I tell other words? Whenever there is a premium, parity price will always be more. Whenever there is no premium, then the parity price will be less. Anyway, this point you don't pray about it, forget it. So these are the factors to be kept in mind regarding convertible bonds. Terminologies I have explained, formulas I have explained, example I have given, and various aspects in bond valuation also has been covered. So this is the discussion on bond valuation, security valuation or fixed income securities. Okay, so moving on to next most important chapter, that is portfolio management. It comes in the exam at least for I would say 10 marks, maybe sometime 20 marks also. Anyway, so let's go fast. This is not a regular class. Portfolio management means, what are the aspects that to be considered in portfolio management? Give me 1 second. Yes. So portfolio management is all about managing a group of elements, not single, multiple elements. It may be group of shares or allocation of time. In the examination context, we only talk about portfolio of shares here. Okay. An objective of portfolio management is twofolded: maximize the returns, minimize the risk. So we should know how to calculate returns and how to calculate risk. Okay, basic principle is to help make a decision, and based on historical data, and it will have averages. So both returns calculation and risk calculation will have average application. So measurement of returns can be based on the averages, of course. The returns may be for a security or for a portfolio or for a market. Three levels are there, three layers, hierarchy. First for a security, then based on multiple securities portfolio, and all of them put together will become market. So for a security return for a particular year, we follow this P1 minus P0 by P0 into 100, and sometime we'll have dividend also. This will be P1 minus P0 plus D1, dividend at the end of the year, divided by P0 into 100. Sometimes dividend yield might be given. In such case, difference between market price P1 minus P0 by P0 into 100 plus dividend yield. Like this might be 8%, this might be 2%, so total might be 10%. Okay, that's how we calculate the dividend and price based returns for a security for a particular year. Sometimes they will give you many years, like 2005, 6, 7, 8, 9, all the returns will be there. Then take an average, add all the numbers, divide by number of observations. Sometimes probability might be there. Then what do? Returns multiplied by probability, the expected value will give you the average return, expected return. Portfolio return means, portfolio means group, I told you, weighted average, that is R1 W1, R2 W2 and so on. That is R1 R2 and all return of particular securities, W1 W2 and all weights of particular securities. And for the purpose of convenience, keep the returns in percentage and the weights in decimals, so that when you multiply, the result will always be in percentage, because one confusion is always there, when to multiply it by 100, when to divide by 100. So the best method is keep the returns in percentage, like 13, 14, 15, 16, and the weights make it in decimals, 0.53, 0.27, like that. When I multiply and total it, the return will already be in percentage. No need to multiply it by 100, no need to divide by 100. This is the portfolio returns. Market return, I'll come to it. Market return is represented by index. Market return is represented by index. The stock market index returns is market returns, like Nifty, Sensex. So whenever they give you index returns, that we consider as a representative of market return, because index is a larger portfolio. So we also say a market portfolio kind of thing. Okay. Okay, index is a larger portfolio. So market return means index returns. Index is a representative of market. Risk means we always measure by standard deviation, and risk of a security, risk of a portfolio, risk of a market. We need to understand all these things. Okay, first let me come to representation, like individual securities, then group of securities called as portfolio, and all the portfolio together we call it as market. And how you are going to calculate the market is using the market index, that is stock market index like Nifty Sensex, where they are the representative. So index is a notional portfolio with sample components. For example, when I say Nifty 50, Nifty is a large 50 companies in the NSE stock exchange, and what are those values are represented on a proportionately called as points. For example, if I say Nifty 10,000, it means 10,000 rupees. If I invested in all these 50 companies, what would have it become tomorrow? That notional amount, proportional amount is called as Nifty point. Therefore, market returns are represented by index, stock market index. Okay, this I explained. I don't want to repeat once more. This is stock market index. Let's come to the the risk calculation process. I think I need not explain these things. These are regular part. Let me come to the formula. Risk is measured by standard deviation. Sigma is the symbol. It is average length of deviation. Variance is average area of deviation. Okay, standard deviation and variance, this is one of the common thing you need to keep it in mind in general. Standard deviation is 1, variance is standard deviation square. Standard deviation will tell you length of deviation, variance will tell you area of deviation from mean. So standard deviation is a measure of risk, whereas if you want to simplify risk, if you want to compute something, if you want to mix something, then you need to go for variance. I repeat, whenever you want to express the risk, you go for standard deviation. Whenever you want to simplify the risk, you go for variance. For example, you have a 30-40 site in Bangalore or Mumbai. Somebody asks you what you have, you say 30-40 site. But if you want to sell, how do you say 30-40 site? Selling at 3,000 per square feet, 5,000 per square feet, 10,000 per square feet. So for expression, it is line, standard deviation. For simplification, it is area, which is variance. So for expression, standard deviation, and for a simplification, we require variance. Okay, let me come to interpretation now. Standard deviation can be anything, but because in this chapter we only talk about the returns which are in percentages, even the standard deviation also will be in percentages. Coming to interpretation, standard deviation can be either positive or negative. Otherwise, you have to understand this. So if I tell you that X bar is 18 and standard deviation is 2, this means most probably from this stock next year I can expect 18% return. It can be plus or minus 2. Plus 2 means 18 plus 2 20, minus 2 means 18 minus 2 16. So my range is 16 to 20. This range is obtained by applying standard deviation. So standard deviation means it can be a higher side more than the mean, or it can be lower side than the mean. X bar plus or minus standard deviation. And calculation wise, it is summation x minus x bar whole square divided by n. So first you get x values, individual returns, then you do x minus x bar, that is x bar is average, then x minus x bar individual deviation you would have done, square it, that square number you get, then total it, divide by n. And if you want to calculate with probability, same formula, x minus x bar whole square, but you have to multiply it by p. I'll give you all the tabular formats for this, don't worry. Now, going further, apart from standard deviation, one more measure you require is correlation. What is correlation? It is a measure of strength and nature of variables like price and demand, whether they are moving in same direction or different direction, USD price and petrol price, index and gold. So between two variables, how they are behaving with each other, that interaction level is called as correlation. It represents the chance of variables moving in either in same direction or in opposite direction. Okay. Now this correlation coefficient is measured by R. Let me give you the formula explanation once more. Range of values is -1 to +1. See, for example, R equals to 0.76. It means there is 76% chance that variables move in same direction because R is positive. R is this correlation coefficient, measurement of correlation. If R equals to minus 0.8, that means there is 80% chance that variable moves in opposite direction. So correlation is nothing but a probability but expressing the direction between two variables. Therefore, it is between -1 to +1. And our formula is covariance by sigma x into sigma y, standard deviation of x into standard deviation of y. How do you calculate covariance? If it is with probability, x minus x bar into y minus y bar into probability, total it. Or otherwise, if it is no probability, then simple x minus x bar into y minus y bar, x minus x bar one column, y minus y bar one more column, multiply those two, you get one product column, that you total it, divide by n, that will give you the covariance. Correlation can be positive, that means variables are likely to move in same direction, can be negative, variables are likely to move in opposite direction, or no correlation, that means variables are independent, no connection. Regression. Why regression is required beyond correlation? Correlation only will tell you whether the two variables are in one direction or opposite direction. If one variable moves, by how much other variable moves is not obtained by correlation, that is given by regression. So correlation cannot be used for estimation, it is given by regression. So a regression establishes mathematical relationship. Mathematical relationship means by way of an equation, and that equation when represented in the graph becomes the regression line. It's also called as the regression line by best fit. Equation of a line is this: y equal to a plus bx, where x is independent variable, x is always independent, right? And b is slope, y is dependent variable, and a is called as the intercept. Okay, so in the line, if I show you the graph, this is how it looks like. This x is independent variable, y is dependent variable. Usually the market, we take it as independent variable, and security return, we take it as dependent variable, and then intercept means the starting point, then the proportion at which it moves when market changes by 1%, how much the security will change. The ratio of proportion of movement is called as the slope, and b is called as the intercept. Formula wise, b is r into sigma y by sigma x. R is correlation coefficient, sigma y sigma x are standard deviation, and a is y bar minus b into x bar. This will come later also, just remember these formulas as of now. Okay, that is about correlation regression. Portfolio return, coming back to the theories, we have different portfolio theories one by one. Let us understand in the same sequence. First, portfolio return means weighted average of individual securities returns. Weights multiplied by respective securities returns. Weights keep it in decimals, returns keep it in percentage, so that the answer will also already be in percentage. Portfolio risk. Give me 1 second. Portfolio risk, let's actually do a quick derivation itself. Fine. Portfolio risk, it's like a plus b whole square formula. Okay, it's like a area formula. Well, divide the area into two parts because two security is what I'm doing. First security is W1 sigma 1, weights in first security and risk of that security. Then W2 sigma 2. Same thing vertically, W1 sigma 1, W2 sigma 2. Then how do you find out the area? Length into width. So W1 sigma 1 into W1 sigma 1 becomes W1 sigma 1 square. Then W2 sigma 2 into W2 sigma 2 is W2 sigma 2 square, and this W1 sigma 1 is one side and W2 sigma 2 is other side, and similarly here W1 sigma 1 is one side and W2 sigma 2 is other side. But these two areas are influenced by first security also, second security also. So when both securities are there, it is important how they behave with each other. So you multiply it by correlation coefficient R between these two securities. When you add all, what you get is variance. I told you standard deviation is used for expression of risk, variance is used for simplification of risk. So if you remember the A plus B whole square formula, it is very simple. A square B square 2AB. So sigma W1 sigma 1 square, W2 sigma 2 whole square, 2 W1 W2 sigma 1 sigma 2 into R, that is called as portfolio variance area. And if I take a square root of this, that is what is called as standard deviation. And some simplification. In the formula, you know, R equal to covariance by sigma 1 into sigma 2. If I multiply R into sigma 1 into sigma 2, what I get is covariance. So in the formula, sigma 1, sigma 2 and R can be replaced by just covariance. You can simply see this is one of the formula, because without computing R, you can get the answer faster. One alternate formula I should remember. Now coming to portfolio, risk recalculated. Under various situations, what can happen? If I put R equal to plus 1, what will happen is, if I simplify, it will become A square B square 2AB. So that is A plus B whole square, and simplified, you get simple answer W1 sigma 1, W2 sigma 2. If R equal to minus 1, then same question will come, but answer will be W1 sigma 1 minus W2 sigma 2. So these two are called as perfect correlation. When R equal to plus 1, perfect positive correlation, answer is W1 sigma 1, W2 sigma 2, just like the return you calculate, a weighted average. If it is R equal to minus 1, same answer, but instead of plus 1, you are going to write it as minus 1. Okay. If I put it as risk-free security means R equal to 0, then what will happen? Again, this is not really required, but just for our understanding purpose. Okay. Risk-free security means R equal to 0, and if I simplify it, this part will become 0, this auto part will become 0. One of them is risk-free security, let's say. What I get is W1 square sigma 1 square. That only means W1 sigma 1. That's a simple answer if I'm doing for risk-free securities. Anyway, that is for 2 security portfolio. 3 security portfolio means, you remember A plus B plus C whole square. A square B square C square. 2AB, 2BC, 2CA. Okay. And return W1 R1, W2 R2, W2 R3, weighted average of returns. So W1 sigma 1 square, W2 sigma 2 square, W3 sigma 3 square, 2 W1 W2 sigma 1 sigma 2 multiplied by R between 1 and 2, 2 W2 W3 sigma 2 sigma 3 R between 2 and 3, 2 W1 W3 sigma 1 sigma 3 R between 1 and 3. Fine. Okay. Oh, very good. So you are able to calculate the. Let's come to different theories now. In fact, the formula what you have just learned is Markowitz portfolio theory. So Markowitz portfolio theory says that a portfolio is efficient if others are inefficient. Nice sentence. A portfolio is efficient if others are inefficient. I am efficient if you are inefficient. Then when are you inefficient? Then they are telling you this. Then there exists more return for lower risk. If there exists no other portfolio that gives more return for lower risk, if somebody gives more return for lower risk, that is efficient, you are not. So more return for lower risk, more return for same risk, or the same return for lower risk. If these three, one of the three things happens, that means somebody else is efficient, you are not efficient. If these three portfolio do not exist, that means you are efficient, because efficient portfolios others are not, that means you are efficient portfolio. So this is how the graph will look like, risk and return. This is the first I would say theory, portfolio theory, which talks about comparison of risk and return. They say you have to choose the security with negative correlation. That is the first requirement, because only when you have a negatively correlated securities, diversification can be achieved and portfolio risk can be achieved. As and when you increase the weights of negatively correlated securities, the risk starts reducing, return starts increasing up to a particular point, after which risk will increase, return also will increase. So if I compare the two things between C and B here, or let's say between A and B, A is having higher risk as well as lower return, B is having the lower risk and higher return, as compared to that C is having even more higher return and lower risk. So B and C are called as inefficient and rest we can call it as efficient. So the moment the line takes turn, all of them are called as efficient returns. As you move up the ladder, you increase your return and you increase your risk. So C is called as low risk low return, D is called as medium risk medium return, and E is called as high risk high return, and AB below the curve are called as inefficient. And this list of the efficient portfolios are called as efficient frontier. And when does this turn take place? This turn where the graph is taking turn, where the lowest risk you can find, that is called as minimum variance portfolio, and that formula is given by this minimum variance portfolio. The formula is this. You can remember like this: denominator is like a minus b whole square. You see, a square b square minus 2ab, sigma 1 square sigma 2 square minus 2 sigma 1 sigma 2 into r. Numerator only changes. Again this factor will come and this square will come. Only one point to remember is, when I'm computing the weight of 1, here you should take sigma 2. That one point many people will do a mistake. Okay, so once you compute w1, you can easily compute 1 minus w1 remaining as w2, or you can use the formula here. And when I'm using w2, everything same, only this part will become sigma 1 square. W1 means sigma 2 square, w2 means sigma 1 square, rest everything remains same. And you know, sigma 1, sigma 2 and into r, all these three can be simplified by covariance. This will save some time when you're solving full-fledged problems in examination. Okay. Okay, now zero risk portfolio, it can be done only when it is perfect risk, perfectly negatively correlated portfolio. And when it will happen, perfectly negative means r equal to -1. So that is possible. Derivation I have given. Derivation you don't have to go through it. Remember the formula, that's sufficient. W1 is sigma 2 by sigma 1 plus sigma 2. That rule I told you, for W1 you should use sigma 2, and for W2 you should use the sigma 1. That remember, you in that ratio sigma 2 by sigma 1 plus sigma 2 or sigma 1 by sigma 1 plus sigma 2 will give you the different weights. Derivation you don't have to worry about it. Okay, so while solving these problems, either to calculate standard deviation or to find out the covariance or to find out the correlation, this table you can keep it in mind. Okay, so one column x, one column y, one column p, that they only will give you. Then you do x into p, that total will give you x bar. Then y into p, y into p, yp, that will give you y bar. Then you do x minus x bar, that is x is this value minus x bar. So x minus x bar, one column. Then you square that column, x minus x bar whole square. Then x minus x bar whole square multiplied by p, that total will give you the variance of p. Or if probability is not there, then divide by n, that will give you the variance. Similarly, you do y minus y bar, then y minus y bar whole square, then y minus y bar whole square into p, that will give you the variance of y. If probability is not there, divide by n. Once you get the x minus x bar whole square and y minus y bar whole square, then you go for covariance, that is x minus x bar into y minus y bar into probability, 3 columns to be multiplied, that will give you covariance. Okay, then you take a square root of this variance, you get standard deviation. Covariance by dividing by these two standard deviation give you correlation. You can use the covariance as it is, you can use the variance as it is for the formulas. Okay, now coming to next improvisation of Markowitz capital allocation line. Give me 1 second. Okay. Now, Markowitz explained risk return optimization, but it did not explain the concept of risk-free return. That even when there is no risk, even though when there is no risk, there is return. That is called as risk-free return, which is not given by Markowitz, that is given by Sharpe, which is capital allocation line. So x-axis risk, y-axis returns. Against the Markowitz efficient frontier, a line is drawn that is called as capital allocation line starting from risk-free return, and a proportion amount is kept on being invested in risky securities. So any point in capital allocation line, an amount invested in risk-free security and a proportion of amount invested in risky securities. Okay, now you could have invested various places. When everybody starts investing in the same security, that capital allocation line will be converged into capital market line. That is, capital allocation line is for a security. When everybody followed the same security, that will become the capital market line. And capital market line, this is how it looks like. Okay, let me show you the capital market line. The same x-axis risk, y-axis return, a line will be drawn. Risk-free return is the starting point, and that security which I marked earlier now becomes market portfolio. So market portfolio, if I invest, that is my market return, and risk means market risk means standard deviation. Then simplification that I've done, I'm not ready to show you the derivations here. The answer will get you this: the return of a portfolio in case of CML is RF plus sigma P by sigma M into RM minus RF. I know this is very similar to CAPM, but hold your thoughts. CAPM is improvised after this formula. So risk return of a portfolio in CML is RF plus RM minus RF into sigma P by sigma M. So what are the interpretations of this? Let me explain to you. Consider 100% investment in risk-free securities, no risk, only RF is your return. You move further, point 2 in the graph, that means your returns has increased, risk also has increased. Coming to point 3, you're investing only in market, so your return will be same as market, your risk also will be same as market. Coming to point 4, your return will be more than market because your risk also will be more than market. How can you have more risk than the market? That means you are borrowing. So the fourth point in the graph represents a portfolio where you are borrowing money and investing in the market. Therefore, you are borrowing and investing. So if market goes down, that is your loss, and you have to pay your interest, that is your loss. Therefore, you have a higher return and higher risk, that is called as leverage position. Fine. So that is one, no risk. Second, less risk than market. Third, same risk as market. And fourth, higher risk than market. That is capital market line. Next line, characteristic line, which means this is a regression line between market return and security return. This is not between return and risk. This is between two returns itself. Independent variable X is market return, dependent variable Y, which is security return. No risk is involved, only returns are being considered. So between these two, when I pass a regression line by way of best fit, that line is called as the regression line. You know, regression line, y equal to a plus bx. First portion is called as the alpha, the intercept, and the second portion is called as the beta, the proportion in which the value will increase. The formula wise, a regression line, S equals to alpha into beta into M. M is market return, independent variable. S is security return, that is the dependent variable. And beta is same formula, R into sigma S by sigma M, security by market. And A is alpha is S square minus B into M square. Alpha is S bar, means average of S minus B into M bar. Okay. Now one simple trick to remember, to this beta formula, I'll be using it in many places. So I would like to give you one common formula for all these things. Market always will be in denominator. whichever formula you look at beta, market is always the base. So market will always come in denominator. Now this formula may be difficult to remember, very easy. Look at this, security is alpha plus beta into m. You do one thing, make it s bar m bar and find out this, keep it left side, s bar minus beta into m bar is the formula of alpha. So a value, intercept value can be computed by simply substituting in the basic original regression equation. Okay, that is characteristic line. Two kinds of risk can be asked. One is called as systematic risk, other is called as unsystematic risk. Systematic risk are macro factors which are market oriented, which cannot be reduced in any portfolio because it's caused by macro factors. Like interest rate risk, social regulatory risk, like what is happening, coronavirus now is an example of systematic virus. Unsystematic virus are, unsystematic risk are the micro factors which are specific to particular business, financial risk, interest rate risk, and so on, particularly related to the specific company. Unsystematic risk can be reduced. I mean, example of unsystematic risk is the S-Bank crisis. What is happening? That is a problem. One time, Nestle, Maggie had a problem. Nestle, that is specific to company. One time, Infosys, Reliant, that is Narayan Murthy has resigned. Infosys had a problem. So these are all specific to companies. They are unsystematic risk. Unsystematic risk can be reduced, can be minimized with the process of portfolio principle called as diversification. By making a better selection of stocks, unsystematic risk can be reduced, but systematic risk cannot be reduced because it's caused by market itself and you can't go beyond market. Okay, now coming to the calculation of this. Give me 1 second so that I'll just put it so it's visible. Yes, it is visible now. Okay, coming to calculation. Total risk of a security is sigma s square. I told you any risk you want to simplify, that means it has to be converted into variance. Standard deviation is for expression of risk and variance is for simplification of risk. We are trying to analyze the security risk, sigma s square. So that's what I am doing. I will divide this into two factors. One is called as systematic risk, other is called as unsystematic risk. Now, systematic risk means the moment of security, what is connected with the market, that is what I'm going to do, market variance into beta square. Okay. Okay, just focus on this point, my dear friends. This is a general thumb rule you have to remember. To convert the market return into security return, what you need to convert market return into security return, that is called as beta. Shortcut, thumb rule, whatever you call it. To convert from market to security, the destination, you can say place, to go from A to B. From market to security, I repeat, from market to security, for this journey, what you take help of is beta. Beta will convert the market parameter into security parameter. So you are trying to understand what is connected with the market related to security. Therefore, from market, you have to come to security. So what is market variance? Sigma m square. Why variance? Variance is used for simplifications. So market variance, sigma m square into beta square. Why beta? Beta will convert market into security. Why variance? Because why square? Because sigma m square is done, beta also should be there. So market variance into beta square, that will give you the systematic risk. Or you can also do by one more method. Instead of beta, you can multiply it by r square. R is called as correlation coefficient. R square is called as coefficient of determination. But coefficient determination means you are not using market, you are using sigma s itself. I repeat, beta means you should come from market, but R means you should take security. So market variance into beta square or the security variance into R square, that will give you the systematic risk balancing figure will give you the unsystematic risk. It's also sometimes referred as sigma E square balancing figure, or if you are using this R square coefficient of non-determination, you can multiply it by 1 minus R square. But whenever R comes, it's the security that comes, not the market. Okay. Now this is the security risk, dividing into systematic and systematic. Both of them are explained. Okay. Just 1 second, because here you need to know about the concept of. Okay. Need to write it. Okay. We have something called as the Sharpe index. Portfolio risk using Sharpe index. So Sharpe index, what does it do? He will tell you compute the security returns, systematic, unsystematic, then combine and call it as portfolio returns. We don't use any standard deviation like what we did in Markowitz, A square, B square, 2AB, that format will not come. So let's say for 2 security, what we are going to do, Sharpe index, we will divide this into 2 parts. One is systematic risk, other is called as unsystematic risk. Systematic risk, how do we calculate? Systematic risk, we are going to do what the thumb rule I told you, market variance sigma m square multiplied by what? Beta of what? This is portfolio. So beta of portfolio square. And how do you compute beta of portfolio? Simple, a weighted average, that is beta 1 into W1 plus beta 2 into W2. This will give you the systematic variance, okay, of the portfolio. This is systematic variance. Unsystematic variance, how do you do? Don't do balancing figure. Like earlier what we calculate here, that is unsystematic risk for individual security you would have done. Let's say I'll do sigma E1 square, unsystematic risk of first security square, sigma E2 square, unsystematic risk of security 2 square. And if I have to simplify it, I have to multiply by weights, but not just weight, I have to square it because these are all variances. So sigma 1 square, and here W1 square, and here W2 square, and add it up. So what I get is unsystematic risk. So this is systematic, this is unsystematic, and if I mix the two, that will give us the total portfolio risk using Sharpe index. Hope you understood the type of risk and then the systematic risk, unsystematic risk, and also using these two, how do you convert it into portfolio. So let's come to next most important aspect. In the exam they have asked this so many times. And that is called as beta. Okay. Okay. What is beta? It is a measure of systematic risk, or I will say some people also call it as sensitivity. So when one variable move by X%, how much other variable will move by is measured by beta. So if I say beta equals to 2, that means if market moves by 1%, security is likely to move by 2%. The proportionate movement between the security and market is called as beta. And I told you thumb rule, from the market, if you want to compute security, multiplied by beta. For example, if market return is 10 and beta is 2, that means security return will be 20. Higher the beta, higher the risk, systematic risk. So many formulas are there. This is the most important one. Change in security return by change in market return. Then R into sigma S by sigma M, the regression line we learned. Or if I simplify it, you will get covariance by sigma m square. You can remember easily actually. Covariance by market variance. Its sounding is also good. Covariance by market variance. Then one more formula is also there, S minus S bar into M minus M bar by M minus M bar whole square, or N into Sm minus sigma M by into sigma M whole square minus sigma M whole square. You remember all these formulas, all these fine. But one small point I would like to address here is, in all the formulas, you see market is the base. In all the formulas, market comes in denominator. Okay. Okay, these are the various formulas I explained to you. Interpretation of beta. Give me 1 second. I'll explain. Let me just explain once more quickly. This also I'll do it. Just give me 1 second. I'll do it. Okay. Okay. So beta, if it is less than 1, that means it is low risky than market. It's always to be compared. Beta is the risk of the security as compared to market. So less than 1 means less riskier than market. Equal to 1 means same riskier than market. More than 1 means high riskier than market. And beta may be less than 0, maybe more than 0, or equal to 0. So less than 0, negative beta means the market and security are likely to move in opposite direction. Beta equal to 0 means market return and security return are not at all correlated. More than 0 means beta, the market return and security return is likely to move in same direction. One more point to be remembered, beta of the market is always 1 because you are comparing market with market, and beta of risk-free security is always 0 because they are not connected, they are not relevant. Okay, so if I just quickly compare the three measures, standard deviation, correlation R, and beta B. Standard deviation is total risk of a security or maybe of a portfolio. Correlation R is the chances of variable moving in same direction or opposite direction. Beta is the proportional movement between security return and market return. A quick comparison between three statistical parameters. Okay, now for beta format you can follow this one. 1 M market return, security return, M minus M bar whole square, then S minus S bar whole square, then multiply the two. So this, if probability is there in each of the cases, you can multiply it by probability also. So variance of the market, variance of security, then you get variance. In fact, you don't require variance of security, you can just do only with variance of market. But sometimes they'll tell you systematic risk, unsystematic risk, then this column also may be required. Okay, now capital allocation line, capital market line, characteristic line is what we have come across so far now. Okay, so the next most important one is security market line. From exam point of view also, this is the most often frequently asked question, security market line SML. Okay, let's look at the graph now. Just give me 1 second. Making it visible. Just give me 1 second. Okay, so security market line is also comparison between risk and return, but unlike capital market line, the risk is measured by beta, systematic risk, on the x-axis. On the y-axis, as usual, return. Therefore, the starting point of SML, of course, it is RF only, risk free rate. Then incremental depending on the beta, the risk what you take. So if I show you the midway through market portfolio where beta equal to 1 and market return, that is RM. So if you cross the security market line, that means beta is more than 1. That means the risk is more than the market. Maybe beta equal to 2. And market return will also be less and security return will be more. Or if I look at left side, the beta will be less than 1, that is low beta stock, therefore risk is lesser than market and return also will be lesser than market. So this security market line is given by RF plus RM minus RF multiplied by beta. Popularly we write it as ER, that is expected rate of return, or we say required rate of return, different names. But this is the most often widely accepted measure as a substitute for the cost of equity, because cost of equity depends on the return required as risk taken by the investor, and the risk is best measured in security market line. So whenever we want to compute the cost of equity, the security market line is the best measure. Therefore, examination also is asked so many times. Now, security market line, this is a cost, the expected rate of return. And whenever the rate of return provided by the stock is more than this, we say that the dividend yield or the average return or the portfolio return, when they are more than this, that means we say that then we say that the stock is good to be purchased. Okay, or other way around, let me say all other returns like dividend yield, or I say average return, or some people say expected return, different names they will provide. Okay, these are all the proxy for return, and the proxy for cost is CAPM. Okay, it might be more than, or it might be lesser than, or it might be equal to. If it is more, that means the cost is less, return is more, that is good to buy, or we say underpriced. And when return is less, cost is more, that means cost is more, not good, we say sell strategy, or it is overpriced. If it is equal to, that means it is correctly priced, and we provide a recommendation or a strategy as hold strategy. Hold strategy. Okay, so these are the important points with respect to security market line, capital market line, and so on, other things. Okay, comparison I told you, I don't want to repeat it once more. Interpretation also just told you, underpriced, overpriced, and correctly priced. Portfolio beta, certain times they will give you the problems. That's very simple. The weights multiplied by respective beta, that is they will have one column like securities, then we'll have number of shares, then we'll have market price, then number of shares into market price will give you the amount, then amount divided by the total will give you the weights. The weights multiplied by beta, the product will give you the portfolio beta. Based on this, quite a few variety of questions are asked. Portfolio beta calculation is one. Sometime they'll also ask you how much risk-free investment should be brought in so that the portfolio beta can be reduced, or how much risk-free security should be given up so that the portfolio beta, the portfolio risk can be increased. Such type of question also will be asked. In such case, if you want to increase the, or if you want to reduce the risk by bringing risk-free securities, then what you should do, you have securities, okay, then your current portfolio, then you write amount, or you can say weight, both ways, and the risk-free securities. Okay, the risk-free security you can say W, or you can say current portfolio is W, then this will be 1 minus x multiplied by beta, then you do the product. The product should be whatever is your target beta. Simplifying it, you get the weight, or this will be the x. Then you say for this so much is the amount, then what should be the amount through cross multiplication method. Hope you got the point. Current you take it as x weight, and the risk-free security will be 1 minus x, multiply the respective beta. Risk-free security beta will be 0, and this beta will be portfolio beta. The product which should be target beta. So this amount, this will be anyway 0. So this amount, whatever the product you get, divided by x should be the weights, or this amount divided by this should be the weight, and that weight you compare it with the amount. So if that is the amount that you need to apply, then how much should be the amount to be invested in risk-free securities? Okay, maybe let me just give you a quick numerical example. Okay, so portfolio amount is, let's say, 5 lakh, and beta of this portfolio, let me say 1.8, and target beta is, let's say, 1.5. You want to reduce it to 1.5, then what should happen? So what you can do, you can do like this. Securities, you have current, then you have weight beta, then weight into beta. Current risk-free security, current, let me say x, risk-free security becomes 1 minus x, beta of this is 0, this is 1.8, then product should be 1.5. This anyway is 0, and this product should be 1.8x. So 1.8x should be equal to 1.5, or x equals to 1.5 divided by 1.8. So how much that comes to? 1.5 by 1.8, it is 0.833. Then you say that 5 lakh is 0.833. How much is the remaining? That is 0.167. Then cross multiply 5 lakh into 0.167 by 0.833. That is the amount of investment to be made in risk-free securities to reduce the beta. Similarly, if you want to increase it to 2.1, let's say, then when you do 2.1, this will be more than 1, which means you have to borrow and invest. Okay, so that's how you can use this portfolio beta as a management technique of risk using CFA model and beta applications. Okay, then we have to understand this concept of levered beta and unlevered beta. Fine. So when I'm looking from the asset or the project point of view, asset or project point of view, this is asset side is called as unlevered beta, because this will reflect only the business risk. Then when you consider the equity shareholders risk, they will consider even the risk which is not taken by outsiders debt. Beta of debt, usually we take it as 0. Okay, so this is unlevered beta, and levered beta, this is levered beta, which is combination of the business risk as well as the financial risk. Business risk as well as the financial risk. Therefore, levered beta formula is unlevered beta into 1 plus debt by equity. If I consider the impact of tax, 1 minus t also will be multiplied, and unlevered beta will be vice versa. Now next thing, using this levered unlevered beta is proxy beta, or whenever you want to value the companies which are private, unlisted companies, they will not have the historical data for you to assess the risk. So then one such case, how do you do? You use the concept of proxy beta. So what do? You do a valuation of beta of a parallel company in the similar line of business. For example, if you're doing software company valuation, you are unlisted company, take a software listed company, let's say Infosys. Okay, so you take the levered beta of the listed company, the proxy company. But problem is they might have different debt equity ratio, your company might have different debt equity ratio, which means the financial risk is different. Therefore, from unlevered beta, you compute levered beta using the debt equity of the proxy entity. That will take out the financial risk of the proxy entity. Then you apply debt equity ratio of the entity which you are trying to value, your company, your financial risk. That levered beta, what you get is the proper representative of your risk. So for unlisted companies or a company which does not have data, we use the concept of proxy beta, where we take the parallel company in the similar line of business, we take out the debt equity ratio, we take out the financial risk element, we get the unlevered beta, purely reflecting reflecting business risk. Then that unlevered beta, you apply your company's debt equity ratio, then you get the risk levered beta, which is a proper risk measurement of company, unlisted company. Then using this levered beta, you can compute the CAPM. Using CAPM, that is cost of equity and other thing, cost of debt, rate of interest into 1 minus T, both put together, you get WACC. Then using WACC, you can arrive maybe NPV of the project or even the merger cases, valuation of companies. Fine. These are all the effects of beta that to be kept in mind, levered beta, unlevered beta. Now, coming to the last theory, I would say after CAPM, the next one is arbitrage pricing theory. Arbitrage pricing theory is an extension of CAPM. CAPM, you know the formula, RF plus RM minus RF into beta. RM minus RF is called as the market premium. RM minus RF into beta is called as the security premium, or return of security minus RF is also called as the security premium. So what is the interpretation of that? How much ever risk you take more than market, that much return also you should get. That's the concept of CAPM. What arbitrage pricing theory say, it goes one step further and say market risk cannot be one risk. Different market factors can mean differently for different companies. For example, if you consider interest rate means more for a financial companies than for a software company. If there is a change in the foreign exchange rate, foreign exchange risk, that is more important for a software company than for a business or bank company. So different market factors can have different impact on your company. So this arbitrage pricing theory say divide your risk element into various factors. They call factor premium and factor beta. So arbitrage pricing theory, expected return is, they say, lambda 0, which is risk-free return, plus lambda 1 into beta 1 plus lambda 2 into beta 2 and so on. Where lambda 1, lambda 2 represents factor risk premiums, whereas beta 1, beta 2 represents the different factors like interest rate, inflation rate, industrial output, GDP, foreign exchange risk. All those beta factors is what you need to consider. One particular type of problem they will ask you here, they will be like you have invested, you have 1 lakh in hand and you have invested 1,50,000 in X, or let's say A, and you have invested minus 50,000 in B. If beta of A is 1.5 and beta of B is 0.6, what is portfolio beta? They'll give for one factor, they'll give you for one more factor also. So this is called as shorting. Shorting I'll come to in the derivative chapter, but this one keep it in mind. So 1 lakh, you invested 1,50,000 and you borrowed 50,000 in security. That's why minus 50,000. So this 1,50,000 by 1 lakh, this is 1.5, and minus 50,000 by 1 lakh minus 0.5. So these are all the weights. So weight becomes 1.5 minus 0.5 and beta becomes this 1.5 and 0.6. Then you multiply weight into beta. So 1.5 into 1.5, 2.25, minus 0.5 into 0.6, maybe 0.30 minus. So that will give you some 1.95, that is beta of portfolio. So like this you need to divide and calculate in case of arbitrage pricing theory. The regular formula I gave you, and this is one more type of problem you can expect. This is your arbitrage pricing theory. And these three ratios comes in mutual fund chapter, but I thought it's better discussed here itself, relevant for the portfolio chapter. Trainer ratio, Sharpe ratio, Jensen's alpha, used for evaluation of mutual funds. Mutual fund is also after all a portfolio only. So when you get more return than risk that taken, that a stock is good, that mutual fund is good. So trainer ratio is portfolio return minus risk-free rate divided by beta of the portfolio. Sharpe ratio is portfolio return minus risk-free rate divided by standard deviation, and Johnson's alpha is portfolio return minus CAPM return. So what is Trainer ratio will tell you what is the risk premium provided by the portfolio for every 1 unit of systematic risk. Beta is systematic risk, standard deviation is total risk. So Trainer ratio will tell the return risk premium for 1 unit of systematic risk. Sharpe ratio will tell you the risk premium for 1 unit of total risk. So if you want to remember, it's very easy. S for standard deviation, S for standard deviation, S for Sharpe ratio, T for Trainer ratio, T for beta. In beta also T is there. So risk premium for 1 unit of risk taken is measured by Trainer as well as Sharpe ratio. All the ratios, higher the better. So these two will tell you in the times, the number of times. So if I tell you Trainer ratio as 8, it means for every 1 unit of systematic risk, you got 8 times returns. Sharpe ratio, let's say 7. That means for every 1 unit of total risk, you got 7 percentage returns. Johnson's alpha is basically what we did for evaluation, overpriced, underpriced, correctly priced. That point of time we observed, right? CAPM return is like a cost, and portfolio return is the return, actual return, average return, or dividend yield. The difference between those two is what you get it as the excess return that portfolio has generated, and that is what is Johnson's alpha. In general, if they ask you to rank and on, you remember higher the ratio, better the stock to purchase. Higher the ratio, the better it is. Lower the ratio, the stock is less or the portfolio is less. Okay. This is about portfolio. Small other aspects are there. Let me tell you one more aspect. There's something called as international portfolio, where an Indian invests in US, what are the returns he gets? So in that case, you should remember this one simple formula: 1 plus the foreign returns into 1 plus the dollar foreign currency appreciation minus 1. Let me give an example. Suppose he invested $1,000 and return is $1,050. That means $50 return. $50 by 1,000 means 5%. And let's say they say dollars appreciate by 3%. So what is going to be your return? 1 plus foreign return 0.05, 1 plus appreciation of dollars 1 plus 0.03. Then you do minus 1, some 8.0815, I think, something you get. It is 8.15 return something is your return obtained in the international portfolio. So this is the discussion about portfolio chapter. I tried my level best to consider all possible concepts. As I told you, problems I'm not solving, theory, concept, whatever is required I'm explaining. Okay. Now comes the mutual funds. Mutual funds, what kind of questions you can expect in exam? One about the NAV calculation, yield calculation, and sometimes they'll ask you reverse NAV calculation. And you should also be aware of something called as load, and to an extent maybe you should know the dividend equalization. Okay, so what is mutual fund is all about? An investor, instead of investing in stock market directly, many investors come together, they make a pool of funds, and those funds are invested in stock market, money market, real estate market, and so on. And whatever the returns they get from the market is shared among the investors. It's professionally managed. Various types of mutual funds are there. Function based, open-ended funds, closed-ended funds. Popular theory question. Open-ended funds means the investor can invest in mutual funds at any point in time. It's like a primary market. 99% of the mutual fund market are by open-ended funds. Closed-ended funds means once it is issued to the investors, if another person wants it, he has to purchase from another investors. So once it is closed, it is closed. It's like shares only. Like when you buy shares, you buy from another shareholders in the stock market. So open-ended funds, whenever the investor wants, he can invest in mutual funds and he can redeem. That is, mutual funds will be issued and will be redeemed. It's between investors and mutual funds. Closed-end funds, once it is issued by the mutual funds, later it is not available for subscription. If anybody wants to invest, he has to buy from another investors. So closed funds are also uh, traded in the stock market. Based on portfolio, equity funds who invest in equity shares predominantly, debt funds who invest in fixed income securities, balance funds also called as hybrid funds who invest in equity certain portion as well as debt certain portion. Other types of mutual funds are also there. You can go through it. Right? Advantages, theory part, you can read through it. That I don't want to discuss much. Disadvantages, even mutual funds are subject to market risk. Please invest carefully before investing. Evaluation of mutual funds comes on the NAV calculation. Let me give you how to calculate NAV, net asset value. That is very simple. Market value of assets minus market value of liabilities is net asset value. If you want per unit, then you will divide by number of units. Sometimes the market value of assets, you might have to value it. For example, investment in equity shares. You have to multiply index latest divided by index at the time of purchase. That is because when we don't know the market value in which you have invested, you assume that the proportion of movement between the market and your portfolio are same. Therefore, proportionately you calculate. Index at the time of purchase you divide, latest index you multiply, that is the ratio of increase that you can apply it on the investment in equity shares. For bonds or for debentures, you give whatever the cost, you multiply it by latest price like 106.5, something like that they give, divided by face value like 100 rupees you get. If it is unlisted, you do the cost amount only. Sometimes what happens, they will give you perpetual bonds, or they'll give you bonds but they don't give you the years. So in such case, what you do, bond face value multiplied, or a cost multiplied by the yield, the expected yield divided by required yield, or that is nothing but you do coupon divided by yield rate of the thing. They'll give you coupon and they'll give you the yield, expected yield, that will also can give you the market value of the perpetual bonds. Cash is there, you can add. Sometimes they say realized gains are distributed as dividends, that should be subtracted. Realized gains means dividend received, that whatever like 80% of realized gains are distributed. In that case, what you do, dividends you take 80%, you multiply, that will be subtracted. Or whenever you purchase the portfolio and sell the portfolio, profit you get, that profit is called as realized profit. On that also you have to multiply the percentages. Then subtract liability like amount payable to management, amount due on shares, such kind of liability will be there, that will give you the net asset. Then divide by number of units will give you the net asset value per unit. Then exchange traded fund is one of the theory question, you can go through it. Exchange traded fund, they'll invest for a particular objective like gold investment, something like that. Okay. Before coming to this, I would like to discuss one more point. Yield for investors. If it is per unit basis, yield equals to NAV 1 means NAV at the end minus NAV 0 at the beginning plus any dividend received plus capital gain received divided by NAV 0 into 100. Okay, this is per unit basis, and this is applicable when there is no reinvestment. Sometimes what happens, they will reinvest it also. In such case, what do you do? When there is reinvestment of dividends, when there is reinvestment of dividends, You can't take it on per unit basis. You have to do it on total basis. So what do you do? Number of portfolio at the end. Portfolio at the end, how do you compute NAV into total number of units minus portfolio at the beginning and divided by the portfolio amount at the beginning, and portfolio at the end will be NAV at the end into new number of units, and number of units will be existing number of units plus additional number of units, and additional number of units will be the capital gain plus dividend divided by NAV at the time of reinvestment. You can multiply it by 100. You see, in reinvestment, dividend plus capital gain is not considered a gain. So this is one kind of dividend yield. Sometimes it might be only for 9 months, 8 months kind of calculation. In such case, what you should do, you should multiply it by 12, divide by number of months or number of days. This also 12 divided by number of months or 365 by number of days. So this is how you calculate NAV for the in unit holder in mutual funds. Okay. Front end load, back end load, this is one of the questions they'll ask. So when the unit holders gives the money to mutual funds, they don't invest entirely in the stock market. They will deduct some of their commission, that is called as front end load, which is very similar to purchase commission. So if 100 rupees is given to the mutual funds, they will invest only 98. The 2% what they retain with themselves is called as front end load. Back end load means reverse. When they sell in the stock market, they get the money. They have to pay it to the unit holders. While paying, they keep money to themselves. That is called as exit load, also called as back end load. For example, if 100 rupees is received by mutual funds, while paying it to the unit holder, they deduct 2 rupees with them. They give it only 98 rupees. Okay, so this may be the NAV. At rate at which you invest or you redeem is called as the public offer price or redemption price. So front end load, entry load, back end load, exit load. Front end load is like purchase commission, back end load is like sales commission. Front end load will make the public offer price more, that means they receive more but invest less, and the back end load will make the redemption price less. Therefore, front end load is net asset value or NAV divided by 1 minus the front end load. That will give you public offer price, and redemption price is given by net asset value divided by 1 plus the back end load. So public offer price will be more because of the NAV or because of the commission. Redemption price will be less because of the commission. So what you have to pay became more, but what you get will be less. And why in between those two, the mutual funds will keep the commissions. That is what is called as front end load and back end load. Dividend equalization is one more concept. Because when a new person joins in between the year, what the income they have not earned, also they have to pay for it, because some unit holders will be there from the beginning and some unit holders will be joined in the middle of the year. So these people who are there at the beginning, they have earned their income, but what about new people who have joined? They also have to earn, but they will pay for it. The amount what they pay before they became the unit holders, that income earned by the mutual fund should be paid by them, and they will get it back at the time of dividend later. That is called as dividend equalization. For solving problem point of view, what you should do is your public offer price will always be the NAV plus the entry load commission and plus the dividend equalization. So whenever you calculate NAV at the time of purchase, even when there is dividend equalization, you do NAV plus entry load plus dividend equalization, and whenever is redemption price, NAV minus entry exit load, because they get less, and don't subtract dividend equalization. They will get what they due. When you leave in between whatever income earned till that date also you will get it. So that also you need to add. Dividend equalization is added. Simple, remember, dividend equalization at the time of purchase also you add, at the time of sale also you add. But entry load NAV will be added, but exit load from NAV it will be subtracted. Keep this in mind. That much sufficient for dividend equalization and load impact. Okay, so these are the aspects related to mutual funds. Okay, moving on. The next chapter is valuation, or I would say the corporate valuation. So I'm mixing the two chapters, security valuation equity part and the corporate valuation chapter. This is one of the chapter which many students ignore, though it comes in the exam for around 15 to 20 marks in every exam. So focus carefully. There is a lot to learn in this chapter. So some basics of valuation. So what is the price? I told you at the beginning is what you pay, and value is what you get. Now, how do you ascertain that value is what this chapter is all about. Various methods are there. I'll try to summarize, give it in one place. Intrinsic value, this you know, account students. Market value of assets minus liabilities divided by number of shares. We have done this in mutual funds also. We called as NAV. That's what is applicable here. It's also called as book value per share. It's also called as book value per share. Okay. Then enterprise value. It's called as EV. Enterprise value is the valuation of the firm. Valuation of the firm means we are not valuing the company from the shareholder point of view. We are valuing the company as a whole, or I would say like a value of a firm, or value of a business, or value of a strategy. For example, when you purchase a house, you might have taken a loan, or you might have put your money out of it. Suppose you purchase a house worth 50 lakhs and you have taken a loan of 10 lakhs. The equity element will be only 40 lakhs. But if I talk about the house itself, that is 50 lakhs worth, right? From the asset point of view, that from business point of view, how do you value is called as enterprise value. That formula is equity value plus debt minus cash. Or if you try to calculate using relative method, using valuation multiple method, then it is operating profit, that is EBITDA multiplied by EV to EBITDA ratio. EV to EBITDA ratio will be given, like a competitor ratio will be taken. You multiply it for the operating profit, which is earnings before interest and tax, EBITDA. That value will be the enterprise value. Fine. P ratio. This is one of the most popular method. Even when you go to merger, you should know this. Price earning ratio, which means for every 1 rupee earnings by the company, how much the shareholders are ready to pay for. So if I say P ratio is 8, it means for every 1 rupee earnings of the company, investors are ready to pay 8 times. 1 rupee profit is worth 8 times in terms of market value. That is P ratio. So formula wise, market price per share, if you want to compute, EPS multiplied by P ratio, a multiple. Or if you want to compute the market cap or value of the equity, then it is PAT multiplied by PE ratio. Then earnings capitalization, one of the popular thing we use for calculating value of business. Earnings capitalization. So earnings in the numerator, the capitalization rate will be in the denominator. So it's like income divided by required rate of return, PAT divided by capitalization factor. These days some more ratios are there. Price to sales ratio, sales multiplied by price to sales ratio. If it is sales to price ratio, then you should take a reciprocal of this. Okay, price to earnings, price to sales, price to assets, price to book, all these are multiplied. If something else is to price, like sales to price, then such things are divided. And coming to cash flow valuation, this you know, one time cash flow you multiply it by discounting factor. If it is recovering cash flow, you multiply it by annuity factor to get the present value. And if it is constant growth, we also going to learn in the dividend discount model, that is CF1 by K minus G, cash flow of the first year Divided by discounting rate K minus the growth rate will give you the present value. Always keep it in mind, when you want the today value, you take the today year end cash flow. There will always be one term gap between the cash flow and its respective value. Okay. Now, coming to the cash flow based valuation, you can think from the shareholders point of view, or you can think from the company point of view. From the shareholders point of view, we have to understand various dividend models. From the entity point of view, we have to understand the methods to calculate using FCFF, free cash flow to firm, and free cash flow to equity method. First, let us take up the dividends. Okay. Now, cash flow anyway will come to it. Let me first take up the dividends part. If I come to the cash flow part, one time, finite, infinite, I told you. One time cash flow means we use the discounting factor, and finite cash flow means we use annuity factor as a multiplier. Infinite cash flow forever means we use the annuity perpetuity factor, which is your annual cash flow divided by rate of interest. If it is constant growth rate, I told you just now, CF1 by K minus G will give you V0. And variable growth rate, this is one of the popular method while computing FCFF, also while computing the multiple growth dividend model also, where we say up to certain number of years the cash flow will grow at a certain rate, and after that the cash flow growth rate will get stabilized. For example, for 5 years the growth rate is, let's say, 8% per annum, and from 6th onwards it will stabilize at, let's say, 5%. In such case, this constant growth model can be applied only from 6th year onwards, but up to 5th year you have to use individual cash flow. And 6th year onwards means when I use 6th year cash flow, what I get is the value at the end of 1 year less, which is 5th year, or it's called as terminal value. So if you want to present this in a tabular format, this is how it looks like. For example, year 1, year 2, year 3, one growth rate, and year 4 onwards one more growth rate. So year 1, year 2, year 3 you take specific cash flows, and discounting factor for year 1, year 2, year 3 you take respectively. Then from year 4 onwards means the growth rate will be stabilized, therefore you will use cash flow of year 4 by K minus G, and cash flow of year 4 means you get the value at the end of one term less, which is 3rd year, and multiplied by respective discounting factor. And CF4 you can also write it as CF3 into 1 plus G by K minus G, and the CF3 is what you would have computed in the previous line. As a matter of shortcut, remember this, in all these calculations the last two cash flows will have same discounting factor, so that you don't do the mistake that 1, 2, 3, 4 in a flow you take discounting factor for 1, 2, 3, 4. Not right. The last two cash flows will have same discounting factor. This table we are going to use for FCFF calculation methodology as well as for multiple dividend growth model methodology. Okay, now coming to dividends. What is the meaning of dividend? It is nothing but distribution of profits among its shareholders, and it is very similar to the withdrawal of profits by the partner. And what is the impact? Immediate impact on the price is always negative because it entails the distribution of net assets of the company. Net worth of the company goes down, so immediate impact, the share price comes down. That price after paying dividend is called as ex-dividend price, excluding dividend price, and before that it is called as cum dividend price. And the date on which the dividend is paid, for this cutoff date for payment of dividend, is called as ex-dividend date. But on the value of dividend, we really don't know what is the impact. Different people have different opinions. That is why we have different theories, dividend theories. We have to learn dividend theories such as Walter model, Gordon model, and Modigliani-Miller approach model. And computation wise, different names can be given. If they give you dividend percentage, you should apply it on face value, that you know, legal terms. But if they give you dividend payout ratio, payout means it is a payout out of earnings, therefore you should multiply it on EPS per share. If it is dividend yield percentage is always applied on market price, so you should take on the market price. So depending on which term is given, the multiplier will be different. Okay, now going further, Some basic terminologies, DPS means dividend per share, D0 dividend just paid or last paid, D1 dividend expected to be paid at the end of year 1, D1 means D0 into 1 plus G, base year dividend into 1 plus growth rate, payout ratio dividend out of earnings, retention ratio retained earnings out of earnings. And therefore we can also say 1 minus retention ratio is payout ratio, or 1 minus payout ratio is retention ratio. So ultimately the payout ratio and return ratio should add up to 1 if you express in decimals. If you are also expressing in percentages, then the total should add up to 100%. Fine. Let me just do one small change in the font. Okay. Hope you can see the font now. Good. Okay, one important element is the growth rate. Growth rate, we write it as B into R, where B represents retention ratio, R represents return on investment or IRR. So growth of a company depends on how much they save and also how much they will reinvest. So saving plus reinvestment rate, multiplication of that will give you the growth rate. And K, cost of capital or required rate of return, or in some problem we have to use the portfolio method, that is using CAPM method for computing the cost of capital. Sometimes they don't mention whether it is dividend per share or at the beginning of the year or end of the year, they just mention dividend per share. In such case, you have to make an assumption and solve accordingly, and mostly the institute has taken dividend per share as at the end of the year. Okay, now let's come to the theories one by one. Let's come to Walter model. Walter model gives, according to him, P0, that is the price in his opinion. P0 is written as two parts. One is distributed profits, which is DPS, which will not grow because paid out to the shareholder, and other part is what is retained by the company, EPS minus DPS, and this will grow. So you multiply it by RA, return on assets, and you discount it for the present value purpose, that is RC. So this is the value of the portion which is retained, and this portion is the value of portion money which is declared as dividends, and this is what you earn every year. So divided by capitalization rate, which is RC. That is what is Walter model, and his recommendation is 2 points. Either RA is more than RC, or either RA is less than RC. If RA is more than RC, then company is capable of generating more returns. Therefore, according to him, optimum payout ratio is 0% when RA is more. When RA is less, that means you are not able to meet the shareholders' expectations. Therefore, in such case, it is 100% payout ratio. Everything should be given to the shareholders. Then coming to Gordon model, which is nothing but the constant dividend growth model. Therefore, that value formula P0 is D1 by K minus G if dividend at the end of the year is known, or you might say D0 into 1 plus G by K minus G. Sometimes they might ask you to compute cost of equity using this method, this formula. In such case, you do cost of equity equals, or K equals D1 by P0 plus G. So using these formulas, you can compute either the market price, or using the market price, you can compute the cost of equity. This is Walter model and Gordon model. Then coming to the next one, which is M and M model, Modigliani and Miller approach. So he solves the problem of two methods, or he says that the dividend does not affect the value of the firm. Therefore, this theory is also called as the dividend irrelevance theory. So he solves the problem under two assumptions: if dividend is paid and if dividend is not paid. So what his theory says is, when dividend is paid, that means you need more money for investment purpose. When dividend is not paid, you need less money for investment purpose. Less money for investment purpose. More money means you are going to raise more money, and here you are going to raise less money. So what he is trying to say is, if dividend is paid, if dividend is not paid. When dividend is paid, what will happen to cash flow? Cash flow or value of the firm. When dividend is paid, cash flow will reduce. You have to pay. And dividend is not paid, cash flow is higher because you are not paying. And you are going to raise money because you need money for your investment purpose. Because you have paid, you need more money. You need to raise more money by issuing shares. And if you're not paid, then you need less money by issuing shares. As a result, on one hand, cash flow will go as a payment of dividend. On the other hand, the cash flow will come as a result of issue of shares. Overall, the balance is maintained. That is Modigliani and Miller approach. And in that process, he assumes two formulas which is required to be remembered to prove these things. One is P0 equals P1 plus D1 divided by 1 plus KE. That is one assumption. And value of the firm is given by new shares plus existing shares into P1 at the end of the year plus income during the year minus investment divided by 1 plus KE. This is for per share basis, and this is total overall value of the firm basis. So using these two formulas under these two columns, he proves that the value of the firm will remain same, and therefore this theory is also called as dividend irrelevance theory. So we have learned Walter model, Gordon model, M&M model. Then what is left out is the multiple period dividend discounting model. Okay, that is what we have to look at. Let's look at that point now. These are all the things which anyway I told you as an example for M&M approach. When multiple dividend growths are there, what you should do? In fact, we just discussed. Let me do it once more quickly. So you follow this tabular format, a regular format, year 1, 2, 3, 4, up to which the dividend may fluctuate, and 5th year onwards, let's say that dividend growth will stabilize. So D1, D2, D3, D4 are specific cash flows, and discounting factors are respectively. And from 5th year onwards, the growth rate of dividend will be stabilized. Therefore, we will use D5 by K minus G. D5 means TD4, one term less, terminal value at the end of 4th year. And D5 can also be calculated as D4, what we just calculated, into 1 plus G. And discounting factor should be very careful. That is 4th year. Last 2 year cash flow will be same discounting factor. The total what you get is intrinsic value or value per share P0, equilibrium price, theoretical price using dividend discount model. Okay. So these are all the things to be kept in mind with respect to the dividend model. Now coming to free cash flow, FCF. There are two categories. One is free cash flow to firm, other is free cash flow to equity. First, understand what is free cash flow. Free cash flow means cash available for distribution to the company after all its commitments. So it does not include any non-cash expenses, and it includes spending on money on purchase of fixed assets and on working capital. WC means working capital. For a growing company, they need more working capital for managing more number of operations. So from the investor's point of view, from the capital employed point of view, it is called as FCFF. Free cash flow to firm, where we consider equity as owners and debt also as owners. We treat them on par, we treat them equally. But if you think purely from equity shareholders point of view, that is called as FCFE, free cash flow to equity. Okay, let's understand the valuation now. Free cash flow to valuation. Basic concept of free cash flow is from the profits we add back depreciation because non-cash expense, increase in working capital we subtract because outflow of cash, and capital expenditure like purchase of fixed assets also we subtract because it is also outflow of cash. Okay, now coming to FCFF valuation, value of the firm, it is used for value of business. Whenever they say FCFF, you take it as value of firm or value of business. Sometimes they might also say value of strategy. They say if the company adopts the strategy, they can increase the sales for 3 years. Evaluate whether the strategy should be adopted. In such case, also you come to FCFF calculation. Okay, so FCF calculation, net operating income into capex plus increase in working capital minus depreciation. So basically water outflow I'm taking within brackets. So capex is outflow, so within brackets, increase in working capital within brackets, depreciation I'm subtracting so that I'm actually adding depreciation. If you observe, minus and I'm minus taking it. So it basically means that depreciation is being added because I'm taking minus common, mathematically it is minus. Net operating income means EBIT into 1 minus t, that is operating income after tax without considering interest as expense. I repeat, interest expense should not be subtracted while computing net operating income for the purpose of FCFF. Okay, so minus capex plus increase in working capital minus depreciation. And value of the firm, what do you get? This FCFF 0, what you calculated, into 1 plus G growth rate divided by K minus G, and this K, remember, it has to be WACC, weighted average cost of capital or overall cost of capital, because you are calculating overall value of the firm. Okay, so cash flow is also overall, the discounting rate also is overall, and the resulting value is also overall value of the firm. Now coming to pure equity shareholders perspective, same formula will apply, but it will change slightly, meaning that this portion, the second part portion, capex plus increase in working capital minus depreciation, is multiplied by equity ratio, because only to that extent the shareholders will be affected, because balance has to be brought by the debt people on a proportionate basis. And also it is net income, and net income means profit after tax. Please be careful about the starting point on these two, FCFF and FCFE model. Then usually again value of equity means FCFE 0 into 1 plus G by K minus G, and remember this is KE, which means it is cost of equity. So the FCFE means you should use cost of equity, and FCFF means you should use WACC. And whenever they talk about the business valuation, strategy valuation, you should compute FCFF. And one more method also is there to compute the value of equity, the value of firm, what you calculated here using the FCFF methodology, minus the value of debt also will give you the value of equity. And these two value of equity don't match because these two are different approaches. Okay, so in the examination, if you can do under both the methods, then you choose one of them and give a appropriate note. Okay, now sometimes they give you year 1, year 2, year 3. Like I told you, application in case of a strategy. In such case, you have to prepare income statement. So what they do, you prepare last financial year for the purpose of computing ratio computation. They say the asset turnover ratio will remain same. So if you want to compute the capex going forward or increase in working capital in future years, you need to know how much it is going to be. They say it is going to be based on the turnover ratio. To compute the turnover ratio, have one column for latest financial year. You can have sales minus cost of goods sold minus operating expenses, but I would recommend you can directly start from EBIT only, because till EBIT things are going to be same. Okay, sales you do compute, because for computing turnover ratio and using turnover ratio to estimate what could be the capex and to estimate what could be the fixed assets, you need the sales information. Then you get profit after tax, add back depreciation, subtract increase in working capital and subtract capex, what you get FCFF, then you can discount it. Okay, let's say that year 1, year 2, year 3, that you have a specific cash flow, or in a strategy case the sales will grow for 3 years, and from year 4 onwards the sales will have a stabilized growth rate, or they might, in some cases there might not be any growth rate at all. Okay, so you can compute till EBIT, all these amounts you can arrive at, and you compute FCFF. And while computing this increase in working capital estimations and capex estimations, use the ratio what you computed, that is the current latest year working capital divided by sales, that is percentage you get or fixed assets divided by sales, you get the percentage. That percentage you apply it on year 1, year 2, year 3, year 4 sales, then you get the estimated working capital and estimated capital expenditure. And once the free cash flow is obtained, multiplied by the discounting factor, but be careful, the moment it is year 4 onwards where the growth rate stabilize, you have to convert it into terminal value, and year 4 onwards means what you get is TV3. Okay, so what you get is TV3. And to compute this cash flow of year 4, FCFF4 by K minus G. Don't do 1 plus G. We are computing FCFF4 and computing TV3. So don't do 1 plus G again. Just do this. And last two cash flows I told you, discounting factor will be same. Then add all these present value. That is the total value of firm. And if they say compare to the strategy, then you compare if strategy not followed. If strategy not followed, then what will be your current profit after tax divided by cost of equity? That is what the value of equity you get, or value of firm you get, value of business. This value and this present value compare. The difference between those two is also called as incremental value of strategy due to adoption. If it is positive, strategy should be accepted. If it is not positive, then strategy should be rejected. Hope you got some control over the value of the firm. Some small other aspects also will be asked. So like this one, economic value added, EVA. Economic value added in very simple terms is over and above the expected profits by shareholders. Shareholders take risk, and if the expectation is crossed, if you are able to get more profit than what the shareholders expect, that excess is called as economic value added. Therefore, it is difference between actual profit minus expected profit. And actual profit means it is NOPAT, net operating profit after tax, and expected profit is calculated by capital employed into WACC. NOPAT means you can compute in two ways, either EBAT into 1 minus T, so interest you are not considering it as an expense, or you do that profit after tax plus interest into 1 minus T. So whatever interest was there, you add back and take out the tax impact. Capital employed, you know, debt plus equity, and WACC means, you know, weighted average cost of capital. Sometimes WACC may not be given, you might have to calculate. Cost of debt is rate of interest into 1 minus T, and cost of equity means you have to use CAPM. Okay, now before we go derivatives, there's also other aspects you should be aware of, like let me just write it. Okay, like shareholders value added or market value added. Market value added is basically difference between the market value of firm minus book value of firm. And when I say market value of firm, it means we take the market value of equity plus preference shares plus debt, and book value of firm means book value of equity plus preference shares plus debt. Then we have shareholders value added. This means the market value of shareholders funds minus book value of shareholders funds. Some problem they may also ask you the value of right issue, value of right. Value of right you can find out as difference between the fair value before issue of right minus fair value after issue of right. And after issue of right means it's called as theoretical ex-right price, that is calculated by the fair value, whatever the market price you have, multiplied by the ratio, like they say 4:1, or I'll say 1:4, 1 share for every 4 shares held. So market price into the existing number plus the right price into the ratio, like in this case 1, divided by total existing plus the right. Example, suppose this number fair value before right issue was 25 and right issue price is 20. So how do you calculate? And the ratio is 1:4, 1 for every 4 held. So market price is 25 into existing is, if you have 4 share plus 1 right shares at 20 rupees divided by 4 plus 1. This will give you the theoretical ex right price or fair value after the issue of right. That number you subtract from the 25, the difference between is called as value of right, that is value of right. And if you come, this is per share basis, if you multiply it by 4, then you get the value of right for every 4 shares held. Okay, these are the things to be considered in the valuation chapter. Market value already is there, value of right is there, dividend discussions are there, FCFF is there, FCFE is there. So at least in the exam 15 to 20 marks definitely you can expect. Okay, the next concept is going to be on the derivatives. Okay, let's go to basics of derivatives. Okay, so definitions. Basically 3 conditions to be satisfied if you want to call something as derivative. One, it should be changing with respect to its underlying variable, maybe interest rate, maybe shares, index, commodities, and so on. Second condition, it should take less initial investment as compared to underlying asset or no initial investment, and it should be settled at a later date. If 3 conditions satisfied, it is called as derivatives. Futures, options, all these are examples. Share price, index are all examples of the underlying asset. There are 3 objectives of derivatives you have to understand, which you are going to apply it in every derivative that we learn. One is speculation, hedging, and arbitrage. Speculation means not your income tax speculation, it is uncertain profit. Whenever we say risk is there, that means we are speculating. So the concept that we don't know is called as speculation. You just take a position in futures is called as speculation. If things happens according to your expectation, then you make profit. If it goes against your expectation, you make loss. This speculation, don't compare it with your income tax speculation. Hedging is popularly I call it as have a backup before breakup, which means the process of managing your risk is called as hedging. So when you have a position in portfolio, you are always having a risk that the share price might fall down. So what other technique you have to protect your portfolio value? One of them is you can use derivative for the purpose of managing such risk. That is what is called as hedging. Arbitrage means process of making the use of imperfect market price. Like if there are 2 markets for the same product, but the prices are different, that means one market is cheap, other market is costlier. You can buy in one market, you can sell in other market. That profit is called as riskless profit, certain profit, guaranteed profit, arbitrage profit. There are opportunity for a short term. People have to make use of, otherwise that will be easily be evaporated. Okay, now some more basics of derivatives that you need to understand. We always assume zero position. This I told you at the beginning when I talked about financial management also. 2 types of settlements are there. Settlement by delivery basis, settlement by cash basis. 2 methods of settlements are there and both will give you the same answer. For example, if you enter into an agreement to buy something at 100 per kg, okay, and on that date, on the date of settlement, market price happens to be 120. So how you can see this 120? That means in the market people are paying 120, but because of your agreement you pay only 100, so you save 20 rupees. Or also you can say from the agreement I buy at 100 and I will go to the market and sell it at 120 rupees. So if settlement by delivery basis means I purchase at 100 rupees, then I go to market and sell at 120, thereby I make a profit of 20 rupees. Net basis means very simple. Instead of buying and selling, you cancel it and the differential profit only other person will pay you. You are on advantage position. If you are on disadvantage position, you would have paid. The difference between market price and the agreement price is settled on cash basis. That is what is settlement on cash basis. So in delivery basis, the agreements are actually executed, whereas in cash basis the contract is cancelled, and difference between the market price and the agreement price is either paid or received in cash. That is why it is called as cash basis of settlement or net basis of settlement. Then two more terms you have to understand: a person taking a long position in the market versus a short position in the market. Long position means you purchase today and sell later. Short position means you sell today and purchase later. So long position is also called as bullish in nature, and short position is also called as the bearish in nature. Not bearish, bearish. So long position means you buy today and you sell later. So if market price goes up, you make profit, but if market price comes down, you make loss. But in case of short position, you sell today, and if market price goes up, you end up in buying at a higher price, so it is loss. But if market price comes down, you make profit. In simple words, if you think market price is going up, then long position you should take and you make profit. And if you think market price will come down, then you should take short position and you make profit. And if things goes against your expectation, so when you take a long position, if market price comes down, or when you take a short position, market price increase, in these cases when things goes against your expectation, obviously you'll have to incur loss. So what are the process that you need to keep it in mind? Just give me 1 second. I'll give you the circular presentation of long position and short position. So I'm giving you the strategy now, process. In long strategy, you have to buy and later you have to sell. But if you want to buy, I told you one more important assumption: zero position. You will not have money also, you will not have shares also. So if you want to buy shares, you need money which you are going to borrow. So first step is borrow money today, using that buy the shares today, and you continue to hold the shares. And later point in time, you sell the shares later, after 1 month, after 2 days, you sell the shares, then you get the money and then you repay the money. So that ultimate circle is complete. You borrow with the money and later you repay the money along with interest. Interest element will come to it. If it is short strategy process, you have to sell the shares. Therefore, before selling, you need to have the shares. Don't tell me buy and sell it. That is not right. You need to borrow the shares. So in long strategy, we borrow money. In short strategy, we borrow shares. So once we borrow shares, we sell it. That's what we want to do in short position, because in future we think the price will fall down and the money received will be deposited, and later using the deposit money you will buy the shares, and that shares what you received once you bought the shares is going to be purchased, and you have repaid the shares earlier. You have borrowed the shares earlier, and that is going to be repaid. Okay, let me tell you the short strategy once more. So short strategy means you have to sell shares. So you borrow shares first. Once you borrow the shares, you sell it, you get the money, you deposit. Later, using that money, you are going to buy the shares, and using buying the shares, you are going to repay the shares. So in both the strategy, you can see both starts with borrowing. When you want to buy shares, you borrow money. When you want to sell shares, you borrow shares itself. So two aspects, that's what you need to consider, and whatever you start with, you are going to end as well. Fine. Then coming to the interesting and important point related to interest element and dividend element. Let us focus on interest. In long strategy, because you borrow money while repaying money, interest will be paid. So interest will be an expense. Coming to short strategy process, because you deposit money, when you deposit money, you will receive interest. Therefore, interest will be your income. Uh, Now relating to dividend, what will happen? Because you hold shares, therefore dividend will be an income. This point, what I'm telling you, is very important. While repaying the shares, dividend also should be paid, therefore dividend will be an expense. This is important. Why dividend need to be paid while repaying shares? Because think from the lender point of view. When the lender giving you the shares, he will not be the owner for certain number of period, then he get back the share. For this process, he will charge some money, but that is a commission, that is an income, that is a transaction charges we usually ignore. Fine. Therefore, he will not be an owner for certain period of time. But if he was a shareholder, if he had not given you, if he has not given the share on the loan basis, he would have been a shareholder, and if he was a shareholder, he would have received dividend. Now because he has lent you the share, he lost the opportunity to receive dividends which need to be compensated. That is why while repaying the share, you not only give back the share, but also you will compensate the lender for dividend, if any, which is to be received during this holding period. Actually, if you can remember the steps, it's very easy. What is long strategy? You borrow money. So interest is expense, dividend is income. Interest expense, dividend income. Opposite in short strategy, interest is income and dividend is expense. So if you just remember the opposite part, you'll be able to remember easily. And you can also remember like this, that is what happens today. Let me say in long position, you are having two aspects. One is on shares and one on money. These are the two markets, share market and one money market. And what do you do today and what do you do later? So on shares, what do? You want to do buy, and later you are going to sell. And on money, what do? You are going to borrow and later you are going to repay. Hope the spelling is fine. Repay. And therefore in between these two you will have interest, which is expense, and between buy and sell you will have dividend income. This is long strategy. If you do short strategy, what will you do? On shares, on money, on shares you sell first, then later you buy. On money you deposit, and later the deposit matures. And because deposit matures, you will have interest being your income, and you sell and you buy, therefore dividend is the expense. But hope you understand this part. And in general, what you need to remember is long position is suitable when you are expecting the market price to go up, and short position is suitable when you're expecting the market price to come down. Example, let's say you want to buy, you are having a position of ITC shares where today it is trading at, let's say, 200 rupees, and you think this share price will increase, or let's say you think that share price will fall, so you took short position at 200, and later the 200 became 210. So the 10 rupee is going to be profit or loss. Think carefully. Since you took a short position thinking that the share price will go down, but what really happened is that it is happened against your expectation and it has increased. Therefore it is going to be loss. Short position, you expect the price to go down, and long position, you expect the price to increase. So these are the main aspects before we dig it into derivatives one by one. So first let us take futures. Fine. Let us take futures. uh, Future is an agreement entered today for settlement at a later date, and that later date is predetermined, and the price is also predetermined. So when I say I buy future, does not mean I buy something. I say I am entering into a contract. That's it, nothing else. Before we go further, you have to understand the comparison between futures and forwards. Between futures and forwards, there are some similarities and there are some differences. In the essence, they are same, but in effect, they are different. So let's try to understand what similarities are there. Later we'll go to what differences are there. The points what we observed: agreement entered today, settlement at a later date, the price is determined today, the date of settlement is also predetermined today. These are the four aspects which are common between the agreement, the forward and future. In essence, both are having a contract. Future is also contract, forward is also contracts. Future is also contract, forward is also contract. In future also one buy, one sell. In forward also one buy, one sell. If future also settle later, forward also settle later. There is one buy, one sell, one buy, one sell, and one long position, one short position, and one person's profit, one person's loss. So these aspects are same between futures and forwards. So in the basic essence, in the substance, forwards and future both are same. Okay, now we'll try to understand about the differences. Differences are, this is the main difference. Future is a standard product available for trading in stock market. Futures are traded, whereas the forwards are not traded. Forwards are over the counter, meaning it is entered between two individuals, no intermediary, no third party. Where, like, if you are purchasing the foreign currency from a bank, it's between you and the bank, nobody else will be there in between. Whereas in futures, it is transacted through stock market. So stock market, stock exchanges are intermediaries. Buyer will be there, seller will be there, they don't know each other, and because it passes through the stock exchange, and because it is passing through a recognized stock exchange, the stock exchange puts some restrictions. It has some standard features. Those standard features are like this: there is initial margin, deposit to be made. So whenever you do enter into a future segment with your broker in the stock market, you have to keep money with them, deposit, for the purpose of transaction. Cash basis settlement. You know, settlement can be of two types: settlement on delivery basis or settlement on cash basis. But most probably or mostly in futures, the settlements are on cash basis, at least for exam purpose. And how the cash basis is affected? Through a mechanism of square off. You need to understand the square off mechanism very clearly. What happens? In futures, today you enter into an agreement. What agreement? To buy certain shares at a particular price on a particular date. And on a particular date, what happens? The settlement by delivery basis is you make a payment and get the share. But square off method means you don't do that. Instead, what do? You cancel the previous position. How do you cancel? If previous position was future buy, to buy at a certain price, today you enter into one more agreement which is opposite of the previous. So it was future buy at 1000, let's say. Now you enter into future sell at 1200, and thereby both will be offset, both will be netted, and both will be squared off, and 200 rupee will come to your account. This process of netting, the process of cancelling the contract, the process of settling in cash is called as square off. So in simple words, square off is a mechanism in future market which is taken as a opposite of previous contract so that the effect of cancellation can be given and settlement can be on cash basis. That is square off mechanism. And usually futures which are traded in the Indian stock market, either they are week ended or they are month ended, but mostly for exam purpose at least you can say they are month end expiry. Last Thursday of the month will be the expiry, but you don't have to remember that. Month and expiry, you remember, that's sufficient. But forward contract, none of these rules will apply. All of these things can happen there also, but it is left to the decision between two parties. But be here, because you pass through stock exchange, you have to remember all these aspects. The settlement mechanism, theoretical, means settlement by delivery basis. I told you this will mostly happen in forward contract. Even in futures, if they say settled on delivery basis, this point applies. So what happens, on a particular date you would have entered into a contract to buy at a certain price and to settle at a particular date, and on that day comes, you pay the money and get the shares. That is settlement by delivery basis. Today you enter into an agreement, and on the expiry date you execute the purchase or maybe sale at the price determined, that is delivery basis, and cash flow will happen only on expiry. But I told you, square off basis, settlement on cash basis means today you enter into a future buy, that is fine, but on the settlement date, on the expiry date, which can happen earlier to expiry date also, what do? You enter into one more contract to cancel the previous agreement so that the difference amount will come to you as cash. That is what is settlement on cash basis, net basis, square off mechanism. At the same time, remember this MTM also, mark to market. Even though the final settlement will happen on the expiry date or on the date on which you do a square off, the cash flow will not be weighted till the end. On a daily basis, you would have deposited initial margin. That initial margin will be kept on adjusting for the daily fluctuations. They will not wait for the last day to happen. That is called as mark to market basis. To give you a simple example, let's say on 1/1/2020, on 1/1/2020 you entered into an agreement, to buy on 31st of March 2020 for rupees 2000 some shares. Okay, now on 31st of March 2020, what do? You enter into one more agreement, AGR, one more agreement to sell at the price at that point in time, let's say at rupees 2100. So effectively, one buy contract, one sell contract will set off each other, and difference between that 100 rupees will come to your account. If it was 1900, 100 rupees it will go out of your account. And this 100 rupees will not happen on the last day. It will happen over a period of time on a daily basis, depending on difference between the 2 day prices. That is what is called as MTM, or mark to market method of settlement. Derivative can be used for 3 purposes, as I discussed earlier. Speculation purpose, where uncertain profit is there, where you enter into future market. Hedging, I'll come to it. Let me give an example for the speculation purpose. Suppose you are having a bullish view on, let's say, TCS share. What do you mean by bullish view? You are expecting the share price to increase. So when you are expecting the share price to increase, what position you should take? You should take long position. Therefore, you enter into future buy. FB means future buy. Today at the rate of, let's say, that was trading at 1600, and later when you want to exit, the futures were trading at 1700. Your expectation came true. So what do? Earlier you did future buy, now you do square off. How do you do square off? You're going to sell at 1700 and 100 rupees come to your account. Again, I repeat, very important point. When I say I buy future at 1600, does not mean I paid 1600. I entered into an agreement to buy at 1600, and on square off I enter into an agreement to sell at 1700, thereby 100 rupees will come to you as a profit on net basis. So if I say I purchased futures, it means I entered into contract. I purchased future means I enter into contract. One more point also was there, I did not mention. There was one point related to lot size. Future segments, for every share separately there will be number of units, lots. So if let's say one lot is 100 units, that means you have to purchase in multiples of 100, 200, 300, 125, 135, you can't purchase. These are all the standard features are available in the futures market. Then for hedging purposes, that is process of minimizing the risk, where you have a risk in one market, you try to cover the risk in another market. For example, you have a portfolio of shares where normally we take long position. That means if share price comes down, you are having a situation of loss. So for a portfolio, you are having a loss risk. Falling in the prices is your risk. Long position, falling is the risk. Against that, what do? You take a short position using derivatives. So if there is a loss in the portfolio, you can make up by profit in the futures by taking short position. So risk in the portfolio, risk in the spot market, you can compensate by profit in the future market. That process of minimizing, reducing, managing is called as hedging, where there is, observe here, speculation we had only one market because you might get profit or loss, but hedging means you are having a position in spot market and the risk is being created, and how risk is being managed through derivative using future market. Next comes to arbitrage, where there is riskless profit in market imperfection. So between spot market, future market, they have to be properly priced. If they are not properly priced, in one market I will buy, let's say spot market, in another market I sell, thereby differential amount you can make up as a profit, riskless profit, and profit known in advance. Certain profit is called as arbitrage, where you start with zero position. That's why you have a spot and future position, money market also, all the three market. In fact, is it remember SFM? I'll give an example also. Okay, let me come to the speculation in detail now. I told you, but I'll just quickly go through the example purpose. Okay, so what is speculation? Uncertain profit. You take a view, either a bullish view or a bearish view, thinking either market price will increase or market price will decrease. If you think bullish, you're expecting the market price to increase, then you take a long position in future. Later, you square off by future sell. And if you have any margin money, because margin money is a deposit money, will come back to you. But what is your real impact is the opportunity cost. So if information is available, you can adjust for that. Otherwise, future sell minus future buy is your profit. Short position means bearish view. You are expecting the price to come down. In that case, you take a short position in futures. Short position means you are selling today. You enter into a future sell today. Later, how you adjust? You're going to square up by future buy. Difference between sale price and buy price is your profit, and adjust for margin money which you deposited as an opportunity cost. That will give you net profit overall. In spite of all these complexities, remember one thing, that overall formula for calculation of profit is selling minus expenses. Future sell price minus future buy price. I might have done that today or tomorrow, does not matter. At what buy price I took the position, at what sell price I took the position, difference between those two is your effective profit. Under any circumstances, this overall formula, keep it in mind so that you don't do any mistakes. So speculation is done. Now let me come to the hedging or arbitrage. But before that, we have to understand the fair value computation. Let me just come to the fair value. Yes. I told you in arbitrage, you compare spot market and future market. They are imperfect in nature. So in one market you buy, another market you sell. But how do you know which market to buy and which market to sell? That depends on whether the future is underpriced or overpriced. For that you need what is correct price. That correct price is called as fair value. What is supposed to be the value of the future based on spot market. So that is what is this chart is all about. Fair value means what is the theoretical minimum price of the future, what should be the ideal price, what is supposed to be the future's price is this discussion. Okay, now if I compare spot price and future price. Now spot price is for one share company, one company share. Future price also for same company share. So quality are same. What is the difference between buying in the spot market and buying in the future market? In spot market you buy immediately, in future market you buy later. So basic difference between spot price and future price is nothing but the timing of settlement. Therefore the spot price, if I adjust for time value of money, then I should get the future value. And what time value of money? Remaining time to expiry, meaning the spot date till the future date, that time period, whatever the date of transaction till the expiry date, the time gap. If I adjust for time value of money, I need to get the fair value. And how do you get it? If it is simple interest, spot price plus interest. If you assume compound interest, spot price into 1 plus r to the power of t. If it is continuous compounding, spot price into e to the power of rt. So in the exam, if they give you e value, use this. Else, if they tell you monthly compounding and all, you can use this. Or if no information, you can simply go with simple interest also. It's not going to make much of a difference. You can go for it. Institute solutions also are given based on simple interest sometimes. Dividend. The basics of dividend I told you. When you are expecting a dividend, when the dividend is being actually paid out, the share price at that point in time will be reduced. That's called as ex-dividend price. And when I say now future price, I'm trying to understand what will be the value of this share price after a particular point in time. Therefore, if you're expecting in that period any dividend to be paid, that means that shares price is going to be fall down. That is what is ex-dividend price is what we need to calculate. In simple words, dividend expected between the date of transaction till the date of expiry. If you are having any dividend expectation, that should be subtracted. So in general, negative impact because we need ex-dividend price. If they give you dividend per share, then all cases you have to subtract. And remember, dividend is expected later. So if you are subtracting from spot price, which is today value, you compute present value of dividend and you have to subtract from the spot price. If the dividend is paid on expiry itself, then no need to do any present value because anyway we get the future value. We can do minus dividend directly. But if any other date dividend is there, you bring it into present value, then subtract from spot price. If they give you dividend yield, you don't have to go to the one step further for computing dividend per share. While calculating this rate of interest is there, no, compute the net interest. For example, if risk-free rate is 8%, dividend yield is 2%, effectively you take it as 6%. But overall, we are subtracting because we need to compute the ex-dividend price per share, which is negative impact on the share price. Okay, so we have understood how to compute the fair value of futures. Now, one more point to be kept in mind is commodity futures, how it will be different. Commodity future also very similar, same calculation, spot price plus interest minus dividend. They don't call it as dividend, they call it as convenience yield. The expected profit by holding a commodity is called as convenience yield. So spot price plus interest minus convenience yield. But one more element will come and that is called as storage cost. Therefore, for commodity future, it is future price equals spot price is fine plus the cost of storage cost plus interest minus yield they also call it as convenience yield, nothing but expected profit, nothing but the expected profit. Okay, now storage costs are usually in paid at the end of the period, paid at end of period. Therefore, you don't have to calculate interest specifically. Even yield is normally used to be assumed at the end of period. But if they say present value of storage cost, if they say present value of storage cost, interest should be calculated on spot and should be calculated on storage cost. If they ask you compute yield, convenience yield, balancing figure will give you. But if they ask you present value of convenience yield, once you get the yield, you should do yield divided by 1 plus R, the present value, discounting factor, then we'll get you the present value of convenience yield. Okay, so once you compute the fair value of future, the next step is to go for the arbitrage strategy. Okay, so when does this arbitrage opportunity exist? Arbitrage opportunity exists when the fair value of the future, what we just calculated, is not same as the fair or the future price given in the problem. Remember, price is determined in the market, so that should be given in the problem, and value is what you determined using the fair value calculation. So two possibilities are there, either the price is more or the price is less. Remember, please think from price point of view, don't think from two sides. Sir, price more means value less, no, and price less means value more, no. Confusion. Keep it very simple. Price is more than value, that means it is overpriced. Price is less than value, it is underpriced. Think from price point of view. Less price, underpriced; more priced, overpriced. Okay, now if the future is underpriced, that means you buy in the futures, and if you're buying in the futures, that means you are going to sell in the spot. If it is overpriced in future, overpriced means future you are going to sell and spot you are going to buy. I repeat this strategy. Arbitrage means taking a position in two markets, and the two markets here are, one is spot market, other is future market. So if you think that future is overpriced, then sell in future, buy in spot. And if you think the future is underpriced, buy in spot and buy in future and sell in the spot. So depending on overpriced or underpriced, you determine whether future to be purchased or future to be sold. And whatever you do in the future, opposite, you should do it in the spot. Okay, so scenario 1, future price is more than fair value, meaning overpriced. So that scenario we'll do now. Just give me 1 second. Just give me 1 second. I'll just be ready with the little bit of formatting. Give me 1 second. Yes, I am ready. Good. Overpriced. Overpriced means what is the overall strategy? Future is overpriced, so you should sell in the future, buy in the spot. So follow this format, you can easily present in the exam. So today what is the value? In future what is the value? What transaction to be done? Because it is overpriced, in future what you are going to do? In future market and in spot market. Let me write it for you so it is easy for you to remember. You can also follow that format. Okay, so future overpriced. What is overpriced meaning? The value or price is more than value. You can understand in two ways: settlement on delivery basis or settlement on net basis. Okay. First, let me say settlement on delivery basis. Settlement on delivery basis. So in the future market, because it is overpriced, you have to sell. In the future market, because it is overpriced, you have to sell. And if you're selling in the future market, what you should do in the spot market? Spot market you need to buy. And in spot market you need to buy means this is in spot markets. What you need to do in the money market? You need to borrow. So three markets, SFM, you remember, future market sell, opposite in spot market you buy, and money market you need to borrow, because if you want to buy means you need to borrow. On expiry date, what you need to do? All corresponding things. Settlement on delivery basis. So delivery basis means whatever contract you entered earlier will be executed. So spot buy, today you are going to sell at what rate? You sell using the contract which is committed earlier, and you borrow money means you have to repay money, and difference on cash, whatever hand, is your arbitrage profit. Settlement by delivery basis. For example, suppose fair value was 108 and actual price was, let's say, 110. Overpriced, therefore you need to enter into sell at 110 rupees, and spot buy, spot rate was, let's say, 100 rupees, that is 108 rupee was the interest element. So spot buy at 100, and you borrow money at 100, and you repay money along with interest, that is at 8 rupee interest, means 108, and spot buy 100, you sell at this rate which is 110. See, profit you can calculate in two ways. Either you say in cash flow mechanism what is the net cash on hand, or you can also say what is the profit element. So if a cash flow method means 110 is inflow, 108 is outflow, so 2 rupees profit. Or you can say that 8 rupees interest expense, 10 rupees profit, net amount is 2 rupee arbitrage profit, and that is nothing but difference between what you have forward fair value and actual price. The difference is nothing but what you are seeing here as the arbitrage gain. If the same thing is settlement on net basis, settlement on net basis means the future market, spot market, you can't mix it. Future market should be settled separately and spot market should be settled separately. Okay, so what transaction today, what transaction on expiry date, same set of thing in future market, in spot market, and in money market. Because overpriced, in future you are going to sell at what price? At 110, at 110. And in spot market you need to buy, opposite of future market, and you buy at spot price 100. And if you want to buy, where will you get the money? You borrow money at rupees 100. And on expiry date, you are going to do square off. Square off at the price prevailing on expiry date, which we don't know. Let's say the future price happens to be 120. You can say both ways, whether the price is more or price is less, but in all the cases you get the same profit. It should be same. Then only it is called as arbitrage profit. So 110 you sold and you buy at 120. That means you have a loss of 10. This 120 is an assumption. You can assume another number also. You should get the same answer. In the exam, usually they will give you those numbers. Don't worry. buy the shares at 100, then you are going to sell. At what rate you are going to sell? At 120 only, because a spot price, future price are different. But on expiry date, spot price, future price will be same. On expiry date, spot price, future price will converge because they are transacting on same point in time, no time value of money. So on expiry, spot price and future price will converge. Okay. Sell at 120, thereby you make a profit of 20 rupees, and you borrow 100 and you are going to uh, repay along with interest at 8 rupees, that is 108, means you have an interest expense of 8 rupees. And if I consider all, loss of 10, profit of 20, interest expense of 8, that means overall you get profit as 2 rupees, and that's what you got earlier also. So got the mechanism. So either you can present in settlement by delivery basis, or you can settle by net basis. Personally I like net basis, but you can also by delivery basis, because institute in many problems they have given settlement on delivery basis. Both are fine. Okay. So difference on cash on hand profit is the arbitrage profit, which is known in advance. If it is overpriced, exact opposite. I'll quickly run through it. Under overpriced we have done. Underpriced means exact opposite. Settlement by delivery basis. Today what do you do? At expiry what do you do? Underpriced means buy. So in future market you buy. In future market you buy means in spot market you are going to sell. That means you are going to deposit money. Later what happens? Deposit money will get matured, and spot sell earlier, later buy. And how do you buy? Using the contract entered into it earlier, using the deposit maturity which happens. Whatever difference of cash on hand is arbitrage profit. You can also present it on settlement on net basis. Today what do you do? And an expiry what do you do? Future market, because it's underpriced, you take a long position. You can also say, because underpriced, you can also say long position buy. And in spot market you sell, so you take short position. In money market you are going to deposit, because once you sell the shares you get the money, deposit. And all these things will be squared off, long with sell, then short with buy, and deposit maturity will be there. Net cash on hand is arbitrage profit. So I've given the example for previous one. Hopefully you can manage this one also. But remember, important element, in this case, your interest anyway we have taken. The deposit money means this will be interest income. This will be interest income. But important, and previously it was borrowed money, so interest expense. But important is, in between this, if you receive any dividend, that will be payment. Dividend will be payment expense, because you are taking sell shares, meaning you are taking short position. In short position, dividend is expense, and in long position in the spot market, dividend is income. Keep that point very clearly in your mind. So in this future, we have done with the speculation, we have done with the arbitrage. Now we'll go for the summary of arbitrage once, then we go for hedging. So arbitrage, what do you do? It's a process of making use of imperfect market price, buy in one market and sell in another market. So first step is to identify opportunity. You compute the fair value of future, either using simple interest or compound interest. If both are not same, the fair value and the actual price given in the problem not same, arbitrage opportunity exists. Okay, fair value is spot price plus interest minus dividend for remaining time to maturity. And strategy is, if the price is less than value, it is underpriced. Underpriced means future buy and spot sell. So in spot market you take short position, in future market you take long position, and money market you are going to deposit. And if price is more than value, overpriced means in future market you are going to sell. So in future market, if it is sell, means spot market you buy. If you want to buy, money market you need to borrow. And ultimately settlement, all the difference in spot will happen, difference in future will happen, difference in the money market will happen, and dividend paid or received depending on long or short in the spot market. Ultimate net cash on hand is your arbitrage gain. So this should be the chart for you to revise easily. 1 minute. So this is the summary chart for the speculation purpose or arbitrage purpose. Now we'll come to the most important area, which is hedging purpose. Okay, hedging. So what is hedging? Process of covering the risk. How do you cover the risk here? Using index futures. Why are we using index futures? And how are we using it? Two questions to be answered. Why? Because we have a long position in portfolio of shares, and to cover the risk in portfolio, long position means a risk of falling prices, risk of falling in prices. So long position on portfolio, if you want to cover the risk, you need another short position in another portfolio. That another portfolio, what I'm making use is market portfolio, which is index, because all the shares are not traded but index is traded. Therefore against the portfolio I'm making use of index. In the portfolio I take long position, in the index I take short position. And one more reason why I take position on index, because index futures are liquid. You will find the buyers and seller easily because it is widely spread, whereas stock futures are some stocks futures may not be there, and even if it is there, liquidity, you may not find a buyer seller whenever you want it. Therefore we go for index. Now the next question comes, why should I go for index future? Can't I buy index and can't I sell index? No, you can't, because index is a notional portfolio. Sensex 30,000 does not mean I can buy one Sensex 30,000, not possible. It is a notional portfolio, indicator of market performance. But index future is there, that is possible to purchase and sold, because that does not require delivery settlement. You can difference, you can adjust it on net settlement basis. So index cannot be traded, index futures can be traded, and index future and index both will move in same direction, because index future is a derivative of index. Therefore we take help of index future. Okay, so keep it the focus once more. In portfolio we take long position, in index future we take short position, and the risk of portfolio is covered through risk of index. But one more point, the proportion of portfolio and index need not be same, because portfolio, your company, your portfolio is different combination of shares, and market portfolio index is different combination of shares. They need not move in same direction, they need not move in same proportion. So to compare the risk of portfolio with the risk of market, you have a connector, and that connector is called as beta. So to eliminate risk, to compute that risk, we take help of beta, where the formula is going to be this. I repeat, the basic is this: in portfolio we take long position, and in index futures we take short position. And what connects between these two by way of risk is beta. So position in index future is the portfolio into beta, and you have to take short position, so that you will reduce the beta to zero. Expectation need not be true. And one more important problem in case of index future is the impact of lot size. You can't enter into the contract value how much ever you want. Therefore what do? you have to compute the value of one contract, and value of one contract is lot size into index future price, not value, price. If actual price is not available, then you can assume value and price is same and you can make use of it. But when the price is given, please use the price, not the value. This will give you the number of index future, number of contracts to be entered into. This is called as perfect hedging, but perfect hedging not a reality because actual beta need not hold good on a real-time basis. So we take usually short position. Partial hedging means from the current beta, we don't want to reduce it to complete zero. We want to reach it to a certain level. That is what is called as the partial hedging. So what do? You do current beta minus target beta, that is the amount of position, then you divide by number of index futures to get the number of contracts. You can also use it for speculation purpose. You can increase the beta also, meaning you're already having a long position in portfolio, you take further long position in index future, long plus long together, you can take a higher position so that you can increase the risk also. So you can reduce the risk, you can minimize the risk, you can avoid the risk, at the same time you can increase the risk. That is the advantage of using the derivatives for the purpose of risk management. I'll give an example to understand. Maybe you can follow this format to understand it better. Okay, so let us take an example. You'll be able to understand better. I'll just take a quick numerical, no problems as such. So this format, if you follow, solving through index hedging is very, very simple. Fine. Instead of taking complete hedging, I'll go for partial hedging. I'll try to prove it also. Okay, so you can follow this format for partial hedging as well as full hedging. The format is very simple. You can follow this formula. Okay, so whatever is the portfolio amount multiplied by the target beta minus current beta divided by the value of one contract, which means the lot size into index future price. And if it is perfect hedging, target beta will be 0. And whenever negative answer comes, it means you can say it is a short position. Sometimes positive answer also can come, because if negative beta comes, you're already short on portfolio. You might need to require a long position on index future hedging. But best thing, if answer comes negative, take it as short position. If it is positive, you take it as long position. Okay, so let me take this as the example, as the format. Today, let's say portfolio amount is 10 lakhs, long position normally, and portfolio beta, let's say, is given to be as 2 for simplicity purpose. Let's say it is 2. Therefore, number of contracts will be portfolio beta, portfolio which is 10 lakh into current target beta minus current beta. Let's say target beta you want to achieve is 1.5. Basically, you should reduce by 0.5. So what will happen? Target beta minus current beta, 1.5 minus 2 divided by lot size, let's say 10 units. Index future price, let's say the value of one index Nifty, let's say, is 5,000. So how much you get? Do it in calculator. So 10 lakh into 0.5 divided by 10 divided by 5,000. So you get 10. So basically it means you are entering into 10 contracts. And because it is negative, that means it is going to be short position. Now later what will happen? Suppose let's say index is down by, given in the problem as index is down by, let's say 1%. If index is down by 1%, portfolio might be down by different percentage. You look at the problem. But in this case, let's say beta is 2, beta holding good. That means portfolio will be down by 1% into 2, which means 2%. So the portfolio, what is going to be your loss? 10 lakh is portfolio into the percentage, not the index percentage, the portfolio percentage, or you can do the total number, 2% or 1% into 2, 10 lakh into 2%, that comes to 20,000. It is a loss because you are taking a short position, long position. In the long position, when the market is down, you take a loss. Now in the future, because you take a short position and the market is down, you end up getting profit. How much profit? Number of contracts you entered is 10 contracts, lot size is also 10, index future price is 5,000 and it is down by 1%. So multiply, so 10 into 10 into 5,000 into 1%, that is 5,000. So you see 20,000 loss, 5,000 profit, and overall you are having 15,000 loss. You are not reduced your complete loss because we are not doing perfect hedging here, we are doing partial hedging here. To quickly verify our answer, what is the formula for beta? The change in portfolio divided by change in market. Now portfolio overall loss is 15,000, right? And change in market, or the percentage wise, if I calculate how much it will be, 15,000 loss divided by 10 lakh, that is 1.5%. So 1.5% divided by market, how much change index? 1%, that is 1.5, and that is the 1.5, the target beta we wanted to achieve. Simple, follow this tabular format, you will be able to solve the problem very easily. Okay, so that is your completion of futures. Okay, now okay, now let's come to options. So what is the main difference between a future and an option? Future, there are two parties and both parties will have an obligation. Future buyer will have an obligation to buy, the seller will have an obligation to sell. But in case of option, both parties will not have the obligation. At the same time, both party will not have the choice. Both party will not have the option. One person will hold the right, the other person will hold the obligations. Okay, so let's understand the basic terms once, then we'll go further. Fine. Okay, so there is one person who holds the right, who gets the right. Okay, and that person is called as the holder of the option. Other person who gives the right, or other person who assumes obligation, he is called as the writer of the option. Not about the underlying instrument, I am talking about the option itself. So holder of the option is nothing but the buyer of the option, and the writer of the option is nothing but the seller of the option. And one person is getting a benefit, other person is getting an obligation, so you need to compensate for it. Therefore the holder will pay premium to the writer as a compensation for risk. So holder gets the benefit of holding the right to choose, and the writer will get the benefit of receiving premium. So this is the basic aspect. Then what right he gets? The right may be to right to buy or right to sell. When it is right to buy, it is called as call option, and when it is right to sell, it is called as put option. And when holder has got the right to buy, the writer will have the obligation to sell. Opposite, holder will have the right means the writer will have opposite obligation. And the definition of call or put should always be from holder's perspective. Okay, so when you buy the underlying asset, so gets the right to buy the underlying asset, then it is called as call option. and if the right is to sell underlying asset, then it is called as put option, and the other party will have to oblige. Hope you got the basic terminology. And one important term is right to buy the underlying asset or right to sell the underlying asset will be at a particular price, and that price is called as strike price. And other features what we have learned about futures: standard product, net settlement, square off, lot size, traded in stock exchange, all those things, and margin money requirement, all those things applicable for options also. Now let us try to understand in a summary format through charts. So option holder will buy the right by paying premium, and he gets the right. And the right may be to buy the underlying asset at a particular price. When it is right to buy the underlying asset, it is called as call option. Right to sell the underlying asset is called as the put option. Other person will be the option writer. Holder buys the right, whereas writer sells the right, and he will receive the premium and assumes obligation. And opposite, the holder has got right to buy, therefore writer has got obligation to sell the underlying asset, call option writer. And when the holder gets the right to sell the underlying asset, the writer assumes obligation to buy the underlying asset, put option writer. So be careful about the buy sell terms. If it is about buying an option, you are called as either a holder or a writer. But buying the underlying asset depends on whether you have right to buy or obligation to buy. But ultimately, only 4 positions exist among the option arrangements. Okay, let's try to summarize once more. So option is an agreement entered today for settlement at a later date. That settlement at a later date is called as expiry date, at a particular price called as strike price. But more importantly, as compared to futures, it is not the obligation for both the parties, it is for the right for the holder. If the holder decides, then only option is exercised. So there are 2 parties, holder, writer, 2 positions, one person getting the right, other person assuming the obligation, 2 instruments, one is the option and the other is the underlying instrument, and the cash flows at expiry, related to underlying asset is strike price, and cash flows today related to the right is called as the option premium. So every time remember 2 things: 2 parties, 2 positions, 2 instruments, 2 cash flows. That way you'll be able to remember better. Okay, now let us come to call option one by one. Basic, you remember, option is exercised only at the discretion of the holder. Now when will the holder will exercise? You can understand through delivery basis or you can understand through net cash basis. Both answer will be same. MP stands for market price on expiry and SP stands for strike price. I use these short forms, not standard. So in the exam, don't use these things. Or if you're using, write the expansion like this. MP, I mean market price on expiry. And SP means strike price. Of course, that is the expiry only, because strike price is fixed. That don't change. We take only one particular price, strike price, for the underlying asset. Now, when the market price is more than strike price, do you think call option is exercised by the holder? The answer is yes, because in the market it is higher price, in the strike price it is less price. You would like to buy the product at a lower price. Therefore, when the call option or when the market price is high, it is beneficial to purchase in the option, therefore it is exercised. If market price less than strike price, market is cheaper, so you go and buy in the market, option is not beneficial, option is not exercised, and we say option lapse. If you want to understand on settlement on cash basis, when market price is more than strike price, it means your market price is more, strike price is less, strike price is cheaper. By how much? That is what you're going to say. Like market price is, let's say, 120 and strike price 100, means you save 20 rupees. Or you can also understand it by way of, I purchase in the option at 100 at strike price, go to market, sell it at 120. Remember, in call option, strike price is always buy price and market price only for call option. Okay, market price is sell price. Since market price is more, you sell, and strike price is less, you buy. Difference is your profit, or that is your savings in purchase. And that saving is also called as intrinsic value. Okay, now intrinsic value can only be positive for a holder, because if it is negative, then option holder will have a choice, he will not exercise. So if market price is less than strike price, intrinsic value will be 0, therefore option is not exercised. Okay, now call option on expiry. To understand in slightly more differently, so when market price is more, it is beneficial to exercise, and that is called as in the money options. Intrinsic value is market price minus strike price. When market price less than strike price, it is cheaper to buy in the market, so option not exercised, it's called as out the money, and intrinsic value is 0. If market price equal to strike price, then it is equal, we say indifferent. Again, we can say option exercised or not exercised, and that we call it as at the money options. Okay, now coming to the profits. The profits are called as payoffs. Remember, intrinsic value do not consider premium aspect, because intrinsic value is only at the time of expiry. The premium you paid earlier will be adjusted later, but intrinsic value is purely difference between market price and strike price. Hope you are able to follow so far. Let's go to the payoff in options. For holder, payoff means profit. Intrinsic value, that is what is computed, market price minus strike price for holder, and that is the profit on expiry. But if you want to compute the overall profit, you should adjust for premium. For a holder, premium is an expense, therefore intrinsic value minus premium. And break even point, I told you, in call option, for a holder, market price is the sell price and strike price is the buy price. When buy price and sell price both are equal, that is what is called as break even point. And strike price is your payment because you're buying, and premium is also your payment. So sum of these two, that should be equal to your market price. Then break even point is obtained. Profit is unlimited, because as you keep on getting higher and higher market price, your profit also keeps increasing. Loss is limited to premium. Writer, exact opposite. Whatever the intrinsic value you get, that is also intrinsic value for writer, but for a holder, premium is outflow, intrinsic value is inflow. For a writer, premium is inflow, but intrinsic value is outflow. So whatever is the profit for the holder is loss for the writer. Same break even point, same profit is unlimited for holder, loss is unlimited for writer. Loss is limited to premium and profit is limited to premium for writer. So if I quickly draw a graph for a holder and writer, y-axis I'll call it as payoff, and x-axis, let's say I call it as market price on expiry. Hope you're able to see. Yeah, and this is origin 0. You see, for a writer, whatever happens, his loss is limited to premium. Whatever the premium, for a holder I'm speaking, premium is his maximum loss, and the loss starts reducing as the market price is increasing and the profit is unlimited. And this turning point, that is what is going to be strike price, and this cutoff point, break even point, is nothing but strike price plus premium. This is for the holder. Maximum loss is limited to premium, profit is unlimited. If I speak from the writer point of view, his maximum profit is limited to premium amount, and just give me a second. Yeah, His maximum profit is limited to premium, and after the strike price, the option starts at exercising, his profit will come down and his loss is unlimited. Same break-even point holds good. So this white one is for the writers. Okay, that's simple graph, not very in detail discussion. This is only a summary part. Okay. So this what we discussed now is the call option category. When it comes to put option, please don't think everything is just opposite. That will ruin your understanding completely. Keep put option afresh. Put option means the holder gets the right, writer assumes obligation. But what right the holder is getting? Right to sell. So put option holder, be very careful about his position. Is he buying or is he selling? He is buying as well as selling. The option is buying, the underlying asset is selling. Always think on two lines. About the option, the buyers, sellers are called as the holders, writers. About the underlying instrument, you are called as the put option or the call option. So keep that in mind. Fine. So put option holder gets the right to sell the underlying asset. So if you understand on settlement on delivery basis, remember in put option, it is always about selling, and you would like to sell at a higher price. If market price is high, you sell in the market. If the strike price is high, you sell in the strike price. Okay, now try to think from the market price point of view. If market price is more than strike price, where do you think it is beneficial to sell? Higher price, market is high, so you sell in the market, not in the option, so option is not exercised. If market price less than strike price, market is not beneficial to sell because market is less, you come to strike price, and strike price you better sell, so option is exercised. If it is understanding on cash basis, if market price more than strike price, again option is not exercised, it's better to sell in the market. If it is lesser, what do you do is you buy in the market and sell in the option, because market is cheap and strike price is high. You buy in the market, sell in the options. So either case, our treatment is same. Call option is exercised when the market price is high. Put option is exercised when the market price is less. Keep that simple thumb rule, you'll be able to remember better. Okay, and when market price is not exercised, intrinsic value is 0. When the market price is more, call option, put option not exercised, so intrinsic value is 0. When market price is less, that means the option is attractive and you exercise, and difference between strike price and market price is called as intrinsic value. You remember in call option I told you the market price is selling price, the strike price is buying price. In put option, the strike price is selling price and the market is buying price. Okay, in put option you remember it as strike price as selling price, because right to sell the underlying asset, and market price you can understand it like a buy price from a holder's perspective. You can also understand this one. If market price less than strike price, that means the option is cheap, option is beneficial to sell, attractive to sell, option exercised, it's called as in the money, and intrinsic value is selling price minus buy price, which is the strike price minus market price. Market price more than strike price means higher rate in the market, so you better sell in the market. Option is not useful, it's called as out the money option. If it is equal, then it does not matter where you sell, it is indifferent position, called as at the money, and intrinsic value is again in this case also 0. Payoff, just like in the call option, payoff for the holder is selling price minus buy price, that is strike price minus market price, that is intrinsic value. Of course, if it is negative, the holder will not exercise the option. And payoff, overall profit, is the intrinsic value minus premium. That formula remains same, because intrinsic value is the benefit for the holder and premium is the expense for the holder, and opposite for the writer. Break-even point, there what we did in call option, strike price plus premium, because strike price was buy price, premium was also payment, so both were payments we added. But in put option, the premium is a payment, but strike price is the selling price, inflow. So one is our expense, other is inflow. So for net benefit basis, net selling price is selling price minus premium. And profit, as usual, limited to profit is unlimited in hold call option, but here it is limited because as and when the market price comes down, the holder makes profit here, but market price cannot go below zero. Limited liability concept. Therefore, profit is limited to strike price minus premium, because 0 rupees is the lowest market price. Loss is definitely limited to premium, and for a writer, everything is just opposite. So quickly, if I draw a graph, how does the graph will look like? For the holder, his for the holder, loss is limited to premium. That means the maximum loss is this, and as and when the market price comes down, he will make more and more profit. Okay, anyway, I don't want to discuss this also, this will take more time at this point in time. Okay, so payoff for the holder in put option, payoff for the writer in put option. So call option we discussed, put option we discussed. So what kind of questions they will ask in examination? They'll be asking like a person took call option on this and put option on this, what is his overall profit? So for that purpose, follow one particular format I'm telling you, it will be easy for you to solve the problems. Okay, so first at the heading you may write down the strike price, and you can also write the position, like you say call option holder. Okay, then you write the columns market price, then intrinsic value, premium, and payoff. 4 columns you have to write down. They will give you various possible market price. Let us take an example. Let's say the strike price is 100 and you are a call option holder. So market price, let's say they give you as 3 possibilities, 90, and they say 100 and 110. 3 possibilities they give. And premium, they will give it in the problem. Let's say that is 5 rupees each. That is same, no? Because you will be paying at the beginning itself. Okay, so how much will be the amounts now? Let's calculate. Intrinsic value, remember call option is exercised only when the market price is less or more. When market price is less, call option lapse. So intrinsic value 0. 100 minus 100, anyway 0 at the money. 110, market price is more, exercised. So 110 minus 100, that comes to 10. For a holder, payoff is always intrinsic value minus premium. So 0 minus 5 minus 5, 0 minus 5 minus 5, and 10 minus 5 is 5. This is 1. Sometimes they will tell you a person has taken not only call option, he has also taken position of put option. Let's say strike price is different here for him. Let's say strike price is 105 or something like this, and they say he is put option holder, and his strike price or the premium is, let's say, 3 rupees. Same columns only will be applicable: market price, intrinsic value, premium, and payoff. Let's say premium, I told you 3 rupees. He's a holder, so it will be an expense. And market price, again same situations, let me say around 90, 100, and 110. Same 3 situations. 90, when market price is less, put option exercised. So, and the strike price minus market price, 105 minus 90, 15, 105 minus 100, that is 5, and 105 minus 110, not exercised, 0. And payoff will be 15 minus 3, that is 12, 5 minus 3, that is 2, 0 minus 3, that is minus 3. And then you just have to write one overall payoff, that is adding the 2, minus 5 plus 2, and that is 7, and minus 5 plus 2, that is minus 3, 5 and minus 3, that is 2. And they might say the lot size, like one lot equals 100 units, then multiply all these things by 100 each. That's how you are going to solve basic option speculation problems. It has come in the exam also quite a few times. Fine. Now moving forward. Okay, let's quickly compare between options and futures now. Futures is one contract where one party will have obligation to buy future buy position and other party will have obligation to sell future sell position. Whereas in the options category, there are two contracts. Call option is separate contract, put option is separate contract, and the two, for every strike price there is different contracts. So call option holder will have right to buy, writer will have obligation to sell the underlying instrument, whereas put option holder will have obligation to sell, will have right to sell the underlying asset, and the writer will have obligation to buy the underlying asset. Various strategies are there. I think this is not the right time to discuss every strategy. There are various things such as straddle long, straddle short, strangle long, strangle short, bull call spread with bull spread with call, bear spread with call, bull spread, bear spread with call, bear spread with put, and butterfly spread with call, calendar spread, and so on. I've given you this table. I'm sure you can't read this now. Let's see if I can highlight it a little bit. In the material which I'm sharing with you, the details are there. You can go through it. Okay, I think it's not visible. Font is too small. Anyway, basically strategy is nothing but a various combinations, portfolio of options. You become a call option holder and you become a put option holder. You become a call option writer and you become a put option writer. I become a call option holder and call option writer. In between, I become call option holder. Like that. When we have multiple combinations of options, they are called as strategies. To give an example, as a sample basis only, I'll take one strategy, long straddle, meaning you become a call option holder and put option holder at the same strike price. For example, call option holder at a strike price of 200, premium of 10. Put option holder at the same strike price of 200, premium of 8. So what and all will happen? Profitable, that is payoff overall today. Net premium, you are paying 10 and 8, that is your effective premium. On expiry date, market price can be less than 200, more than 200, or equal to 200. If it is less than 200, market price is less, call option is not exercised, but put option is exercised. Let's say 150, call option not exercised, intrinsic value 0. Put option exercised, intrinsic value will be strike price minus market price, 200 minus 150, that is 50. Overall payoff 50 is the payoff now, intrinsic value now. 18 rupee was the premium earlier, effectively 32. And market price more than 200, let's say 240. Call option is exercised because market price is high. Put option is not exercised because market price is less. Call option is exercised because market price is high. Put option is not exercised because market price is high. Let's say 240 is example. Intrinsic value in call option 240 minus 200, 40, and intrinsic value in put option 0. Overall intrinsic value 40 plus 0, 40. Premium already paid, 40 minus 18, 22. At 200, both options are not exercised, or at the money option 0, 0 each, and payoff will be minus 18. That is the premium you already paid. So if I represent this in the graph, what will happen? Payoff on y-axis, market price on expiry on x-axis. 150 when market price you got, 32 was your payoff. When 240 was the market price, 22 was your payoff, and 200 market price, that is equal to strike price, then you got maximum loss of 18. So you can see this is the payoff graph you get in long straddle. So if you identify this point at which it cuts the x-axis, that is what is called as break-even point, BEP1 and BEP2. So if you closely look at what is that number, first one 200 minus your premium of 18, that is 182 will be one payoff, and beyond that 200 plus 18, that is 218, which means as long as market is between 182 to 218, you make loss. If market price comes below 182 or 218, beyond 218, that is when you make profit. So basically you are trading in volatility, either high or low. So only on the extreme cases you make profit, otherwise you make loss. So like this you have to write down, mostly in the exam, the strategy they've asked only for theory. So if they give you theory, write down what does it mean, take an example, represent by a graph, identify the break-even point, and recommend when this strategy is more suitable. That's all you can expect as a theory question. Fine. Anyway, let's go further. One of the question they ask, or one of the things you need to know, next concept is put call parity theorem, PCPT. Put call parity theorem means how the four variables are connected. The four variables are the value of call, that is call option premium, value of put option premium, the current strike price of the underlying asset, and the current market price of the underlying asset, and the strike price. So how these four are connected is given by put call parity theorem. It is used in various places. If this equation does not hold good, there exists an arbitrage opportunity, and also, and when we do some valuations in binomial model, risk neutrality model, Black-Scholes model, if I compute the value of call option, I can compute the value of put option. So that way also this formula will be useful. Okay, so basically put call parity theorem connects four variables: call option premium, put option premium, strike price, and the current market price of underlying asset. If the equation does not hold good, there exists an arbitrage opportunity. Let us look at quickly what is arbitrage opportunity in this PCPT. PCPT in the exam have not been asked, so I will not go too much in detail, but still I'll give you a quick shortcut to remember the arbitrage. So put call parity theorem is value of call plus present value of strike price is equal to value of put plus current market price. Value of call is, that is for call, strike price, that is for money you say, value of put is put option, current market price is for shares, the underlying assets. I have taken the shares as underlying asset. So two things are there. If things are not equal, either left hand side is less or right hand side is less. One of them is possible. So first situation, left hand side is cheaper. So what is the basic rule that you need to remember? Cheaper things to be purchased and the costlier things to be sold. Since left hand side is cheaper, left hand side you buy, right hand side you sell. What do you mean by that? Call option you buy means you become a call option holder. That is put option you sell, right hand side is sell. So you become a put option writer, seller in put option writer. Then coming back to the shares, you have to sell. That means you need to take a short position. Sell means you need to take a short position. And once you sell, what do you get? You receive money. Therefore, you do deposit money. Deposit money is nothing but your asset side. You are buying the deposit. You are having the deposit. That is one option. Other thing is what? Right hand side is cheaper. That means what? Right hand side is purchased, left hand side is sold. Right hand side is purchased means put option you are going to buy and call option you are going to sell. So you become put option holder and call option writer. What about shares? Shares are buy. You need to buy shares. You take a long position on shares, and shares you need to buy means you need to borrow money. So on money you need to borrow it. Or you can remember also like this, sell, that is short position, nothing but short position on money, nothing but you have to take the borrowings. Borrowings nothing but short position. Both are same. So this is the way you can remember what consequence to be take place today. And then you prove what will happen on expiry date under a situation when market price more than strike price and under a situation when market price is less than strike price. So in this case, when left hand side is cheaper, what we will discuss: call option you become a holder, put option you become a writer, and on shares right hand side, right, you sell. That means you borrow short position, and once you sell you get money. On money you are going to deposit it, and net amount you are going to deposit, that is basically becomes zero. So two possibilities are there. On expiry, if market price is more than strike price, call option holder you will exercise, you will buy the share. This is settlement on delivery basis. You can also settle it on cash basis. Writer, call option, put option not exercised, intrinsic value becomes zero, lapse. On shares you borrowed earlier, now you need to repay. Where will you get it? Whatever the shares you bought it, you are going to use it for repayment. Deposit will get matured, and where that money is used to buy the share, you need money. The deposit is going to be used. Difference of cash in hand is arbitrage profit. Same thing with the respect to the last column. When market price is less, call option is not exercised, but put option is exercised. On shares, you repay shares. On money, the deposit will maturity will happen. You use it. Being a put option writer, you buy the shares. Net amount arbitrage profit is your profit. And shortcut, this arbitrage profit should be equal to the difference between left hand side, right hand side. But that was at the time of purchase. This is at the time of expiry. So difference between left hand side, right hand side, adjusted for time value of money, that 1 plus R, you can multiply that arbitrage profit also. You will get it easily by way of shortcut. Okay, this is other one. You can quickly go through it. I don't want to repeat the things, the same column, except that these things will be reversed. Holder writer will be reversed in call option, put option, and buying on shares, deposit also will become reversed in case of shares and money. Okay, now this is important. This kind of question they do ask. What is going to be theoretical price of call option and put option? The process of finding theoretical value of option is called as option valuation. In general, you know, today you make a payment, in future you get a benefit, and what benefit you get in options is called as intrinsic value, and what amount you pay is called as option premium. And intrinsic value, you know, is difference between market price and strike price. And once you find out the difference, what do? Market price, we don't know in future what will happen, so volatility is dependent and probability is also used, standard deviation probability. And then once you find out the intrinsic value, that is on expiry, but premium is today, and that's why payoff is also called as the intrinsic value minus option premium is your payoff, but option premium is today, intrinsic value is on expiry date, so difference between these two is also called as time value of money. So intrinsic value is the future value, discount it, divide by 1 plus R, that will give you option premium. And if you want to discount it, what factors are required? One factor is interest rate, other rate is the time period. Therefore, these 5 factors, rate of interest, time period, volatility, probability, strike price, these are the 5 factors that are influencing option valuation, even binomial model, even Black-Scholes model. Methods of valuation. Okay, before that, one popular kind of questions they will ask you, so I have to quickly give you a numerical example. They'll tell you like this. Let's say strike price is 150, market price, they will give you probability chart. Market price may go from, let's say, 120, 130, 150, some random numbers, 170, 180, like that. Probability 0.3, 0.2, 0.5, let's say 0.4 and 0.1, and let's say this also is okay, this is not required then. Okay, they'll ask you compute expected value or expected market price. Expected market price, you know, what do? Multiply. 120 into 0.3 is 36, 130 into 0.2 is 26, 150 into 0.1 is 15, 170 into 0.1 is it? No, 0.4 I think. Yeah, 0.4. 150 into 0.4 is I think 60. And 170 into 0.1 becomes 17. And you do the total, you get the market price. That is how much you get. Let me just do it in calculator. 36 plus 26 plus 60 plus 17, 139. Okay, and then they'll ask you, let's say strike price is 130, just for let's say 135, not 150, 135. Okay, they'll ask you expected market price, you tell 139. Then they'll ask you what is expected intrinsic value. This is the common mistake what people do. What is intrinsic value in call option? Market price minus strike price. What do? Anybody know the expected market price? 139 minus what is the strike price? 135, and you give intrinsic value as 4. That is not right. What should be done then? Like the way you calculated for individually, how you calculated the market price into probability, like that you have to calculate individual intrinsic value into probability. So one column you need to have intrinsic value, like 120 when market price is less, not exercised. 130 market price is less, call option not exercised. 150 minus 135 exercised 15. 170 minus 135 means 35 exercised. Then multiplied by probability, the product 0 into 0.30, 0 into 0.20, 15 into 0.4, and that is 6, and 35 into 0.4, 3.5, and total 9.5. 9.5 is the value of call option. So this is one of the popular practical questions which have been asked in on option valuation front. Okay, hope you are with me till now. Okay, let's go forward on this. Let's go to the types of option valuation. One is binomial method, which assumes only two possible market price. Under that, there are two methods of proving that. One is portfolio replication approach, and there is risk neutrality approach. Under that also we have one period binomial model and we have two period binomial model. And Black-Scholes model assumes n number of market price. Basically it assumes a normal distribution to give you the answer. Okay, let's come to the binomial model. Basic assumption in binomial model is two market prices only on expiry date. That is a basic assumption in binomial model. It can be explained through portfolio replication approach. It can be explained through risk neutrality approach. I will not go through the derivations and all. Let me just directly go to the formulas and how do we solve it in problems. Two steps in both of these cases. Binomial model two steps also to be applied. Very simple to remember. The first step is compute delta. High price minus strike price by high price minus low price. And value of call option is delta into current market price minus present value of delta into low price. I'll give an example, don't worry. If it is put option, delta is very simple. This is for call. For put option, it is 1 minus delta of call. So if you get this as 0.6, for put option it's 1 minus 0.6, it becomes 0.4. Minus 0.4 is more specific. Value of call you computed in this format. For put option, don't use any remember formula and all. You can use the put call parity theorem. Value of call you know, current market price you know, present value of strike price you can put, compute the balancing figure strike value of put. So don't have to remember one more formula in this context. Let me give an example to understand this. Suppose they give you current market price is 200 and they say it can be up by 10% or it can be down by 10%. Two possibility they'll provide. Rate of interest they say 5% and term let me say 6 months. What is required? That's all. So delta equals high price. 200 is current market price. It can increase by 10%. 200 plus 10% means 220 minus strike price or equal strike price. Let's say strike price is can I say 210? Yeah, 210. 210. So 210, 220 minus 210 divided by high price is 220. What is low price? 200 can be down by 10%, means 200 can go to 180. So numerator is 10, denominator is 40, therefore delta becomes 0.25, 10 by 40. So what is this number value? This you can remember it very easily. This is nothing but today portfolio, and this delta in 12 is nothing but future portfolio. You can compute the future portfolio when the market is down or market is up, but I have taken market is down, so I have taken low price. You can take high price also, but some more calculations will come. And because future portfolio today value means I need to discount it, so I have done the present value. So delta is the fractional number of shares. Okay, I have to give you the interpretation of this. Delta 0.25 means, see, this is a portfolio replication approach where we have a portfolio of shares and we would like to get a portfolio in call option. That means on shares and options put together, I'm trying to make sure a perfect hedge situation. On shares, I'll take a long position. On call option, I take a short position. So together, I'm trying to mix it so that a perfect hedge is achieved. Therefore, this delta is also called as hedge ratio. So what is this 0.25 means? For every one call option, you need to have 0.25 shares, or the risk of one call option is equal to the risk of 0.25 shares. So delta, you can remember it as a fractional number of shares. So today portfolio, you are having 0.25 shares multiplied by current market price, which is 200, minus delta, which is 0.25, multiplied by lower price. Lower price means we have taken 180, divided by 5%. I'm discounting it, so 1 plus R. 5% is full year, 6 months means 2.5%. So I will say 1.025, 5% half, 2.5%. So that will give me, this will be, I think, 50 minus 180 into 0.25 by 1.025. 180 into 0.25 divided by 1.025, that is 43.90. So that difference, I think 6.10 is your value of call option. So if the value of call option is 6.1, you are having one call option and you are having 0.25 shares, that means perfect portfolio, perfectly hedged portfolio is achieved. Sometime institute, the delta value, they'll give you one more formula also. They will give you like C1 minus C2 divided by S1 minus S2. C1 minus C2 means value of call options and intrinsic value of call options. S1 minus S2 means the different market prices. If I apply this, what will I get? Now S1 minus S2, that is difference in market price, that is 220 minus 180, high price, low price. Now when market price is 220, what is your intrinsic value? Intrinsic value is market price minus strike price. Market price 220 minus strike price 210, that is 220 minus 210, 10. And when it is 180, when the market price is low, call option not exercised, that becomes 0. So you get 10 by 40 as 0.25. You get the same answer now also. So whether you do high price minus strike price by high price minus low strike price, or C1 minus C2 by S1 minus S2, both ways you get the same answer delta. But most important aspect is the interpretation of delta. Okay, interpretation of delta is important. Delta is nothing but hedge ratio. Okay, so this you solved using portfolio replication approach. Now let's come to risk neutral approach. Risk neutral approach also two step. First step is to compute the risk neutral probability, and the second step is to go for the value of call option. So formula for risk neutral probability, this is not regular probability, this is risk neutral probability. Risk neutral probability means what is the probability such a way that investing in a risk free security and investing in a risky security both are equal. Both are equal. If you want to equal the risky security and risk-free security equal, what should be the probability? That's how derivations have been done, and will give you this probability, F minus L by H minus L. In fact, this formula is very similar to delta, but they are different. Denominator is same. There also H minus L, here also H minus L, but there it is high price minus strike price, but here F minus L, future value minus low price. Future value is the future value of the stock using risk-free rate of interest. Second step, very simple. Compute the present value of expected intrinsic value. So on the expiry date, you're having either high price or low price. Call option means what is your value of call option, intrinsic value of call option, high price minus strike price and low price minus strike price. Low price minus strike price usually is negative, becomes 0. Usually high price minus strike price exercise, that is the expected intrinsic value on expiry. But you want today value, discount it, divide by 1 plus R. As a formula you get high price minus strike price into probability, what you calculated here, low price minus strike price into 1 minus probability and divide by 1 plus R for present value purpose. And usually this will be 0 in case of call option, and in put option strike price minus hike price, this will be usually be 0 anyway. But remember, the probability is always probability of higher price. That is the interpretation. That would have been more understood had we done the derivation, but we are not going for derivation, so remember this point. Probability is always probability of higher price. So same example, if I take it in the previous problem which we solved on what is it, portfolio replication approach. If I solve the same problem now, I should get the same answer. Let me verify it. Okay, this is what I got. What are numbers? High price, current market price 200, then 220, 10%, 210, 6 months, 5%. Okay. The future price will be what? Future price will be current market price is 200 into 1 plus R 0.025, 5% for full year, and for 6 months means 2.5%. Minus low price is 180 by high price is 220 minus low price is 180. So what do you get? Okay, so 200 into 1.025 minus 180 divided by 40, you get 0.625. So if I use this now, value of call option, high price means 220 minus strike price means 210. Before that, what is 0.625 interpretation? Delta interpretation was hedge ratio, to have a portfolio with risk-free interest. This also similar only. I am having two things, risky asset, risk-free asset. If both should give me the same return, what should be the probability? Which means if the probability of the price going up is 0.625, then my expected return in the risky asset and the risk-free return both are same. If the probability is less than 0.625, then the expected return in the risky asset is less. Risk-free return is better. Whereas if the probability is more than 0.625, then the expected return is in the risky asset is more and risk-free asset is less. Like that you can make the decisions also. Anyway, coming back. So 220 minus 210 into probability of 0.625 divided by 1 plus R, that is 1 plus 0.025. If it is a lower thing, it is not exercise because market price less means call option not exercise, 0 into 0.375. This 1 minus 0.625 as a formality you can write. So what do you get? Uh, 10 into 0.625 divided by 1.025, you get 6.09, that is nothing but 6.10. That's what we got in the previous method also. So if they tell you binomial model, you can use either of these two models, get the answer. Sometimes one of the exam they ask whether this option is underpriced or overpriced. So if actual call option is, let's say, 6.70, that means price is more, value is less, it is overpriced. Overpriced means should be sold, and should be sold means it is call option writer is a better position. Okay, so like this you can calculate, but this is the two methods popularly asked in exam also. Then one more question which is there in your syllabus but not asked in the exam very much so far is two period binomial model. Okay, so two period binomial model, have not been asked in the exam many times, but let us still do it because it's one of the potential question in my opinion. So two-period binomial tree means, okay, before that, sorry, I should have forgotten. This probability institute will give you one more formula also. I would like to give you that. Probability, they'll also give you like R minus D by U minus D. R is the rate of interest, future value, that is 1 plus R. D is the percentage down and U is the percentage up. So that method also can give you the answer. If I apply this R, that is 1 plus R, in this case 1.025 minus D, percentage down, 10% down, right? Remaining you should take, which is 0.9 divided by U is 1 plus, that is upper side, that is 10% up. So 1.1 minus down is 10% down. So it is 0.9. So if I do this, how much do I get? 1.025 minus 0.9. 1.025 minus 0.9 divided by 0.2 will also give you same 0.625. So sometimes probability is this R minus D by U minus D, sometimes this F minus L by H minus L. Both ways you should be able to get the answer, but whatever you write, please make sure that you write a note also that this probability formula has been used. Coming to two-period binomial tree, this is an extension of risk neutrality model. Risk neutrality model, we have done only two possible prices. Here what we do, we'll divide this into two parts. So if the contract period is 6 months, we'll divide it into two parts, 3 months, 3 months. So can I do like 3-period binomial model also? Like 6 months, I'll divide it into 2 months, 2 months, 2 months. You can, but 2-period is definitely sufficient for exam. You don't have to go beyond this. So if they give you 1 year contract period, divide it into 6 months and 6 months. Okay. And how many possible prices can come today? Let's say 6 months contract means 3 months, 3 months. Today to 3 months, two possible prices are there. Today to 3 months, two possible prices are there. And from 3 months to 6 months, this 3 months can have two possible price, and this 3 months can have two possible price. So totally there are 4 possible price. And for those 4 possible price, you will compute 4 intrinsic values, and those 4 intrinsic value bring it to today value in a step down manner. 6 months to 3 months, 3 months to 0 month. This process is called as the process of calculation of value of call option, finding theoretical value of call option. Let's do it. So what you should do, they will give you one price, let's say 100. You should find out what will be the price after first period, that is, let's say after 3 months. So let's say it is 10%, 100 can become 110 or 100 can become 90. And then one more term is there, one more 3 month is there. So 110 plus 10% means it will become 121. 110 minus 10% means 99. Similarly, 90 plus 10% means 99, and minus 10% means it becomes 81. So 4 possible market price we got. For all these 4 possible prices, you have to compute the intrinsic value. So first step is to compute the 4 possible market price. The second step is to compute the 4 possible options, and you work back. Look at this transition, the chart I'm looking at very creatively. Please follow this. Stock price, you prepare one chart, one tree diagram, binomial tree from left to right, from beginning to 2, from 2 to 4. Whereas option valuation works reverse. You compute the 4 possible options, then you bring it down, you get the 2 options, then you bring it down to today value, you get the present options. Let me show you once more. Not that I like it, but it's good that if you understand this through this mechanism. Okay, so stock price left to right, option price right to left. Okay, now then using the probability, we have computed risk neutral probability. Using the probability, these two values can be converted into one value, value into p, another value into 1 minus p. Then using the rate of interest, that is 1 plus r, bring it down. Then here also using these two values into probability and into 1 minus probability, you get one expected value. Then you bring it down by 1 plus r, you get the expected value. So you got the expected value after 1 and expected value after 2. This should be further brought down. Again use the probability into p and another number into 1 minus p. Then bring it down using 1 plus r. That value what you get is the value of call option. So ultimately steps in 2-period binomial model is, first step is to compute the risk-free probability, risk-neutral probability. Second step is to prepare the binomial chart for the stock price, underlying asset. Third step is to prepare the chart for the options, the value of call option, and then 4 values you bring it to 2 values and 2 values you bring it into present value. So probability f minus L by h minus L, or you can do r minus d by u minus d. But remember, this is for a single period. So when I say high price, don't go to the end, take only the first term. So if 100 becoming 110 becoming 121, take only this first term as high price 110, low price as 90. Fine. Then stock price at expiry from today to higher values. Then after one term, 2 terms, 2 values each. Then prepare the reverse chart like option valuation. For 4 possible prices, you get the 4 possible intrinsic values, which I am calling it as V1, V2, V3, V4 intrinsic value. Then 2 intrinsic values are converted into present value. You bring 1 term less. That's what I'm calling it as EV1, EV2. And those EV1, EV2 are further brought down to today value. That's what I call it as value of call option VC. So V1, V2, V3, V4 becomes EV1, EV2, and those EV1, EV2 becomes value of call option. EV1 is nothing but V1 into P, V2 into 1 minus P, bring it down, 1 plus R. EV2, expected value at the end of first term, is nothing but V3 into probability, V4 into 1 minus probability, and bring it down by 1 plus R. Then we got EV1, EV2, bring it down. EV1 into probability, EV2 into 1 minus probability, and divide by 1 plus R, you get the value. I have tried many methods which should be easier to students as well as should be effective in examination to present. I thought this is the best approach I got. The 3-step approach: probability, then stock prices one chart, then value of call or payoff one more chart. Then you get 4 possible market price. For that you get 4 possible option intrinsic value and expiry. Those 4 value become 2 value at the end of first term. Those 2 value will become present value. So follow these steps, you get easily the value of call option. Even put option also you can follow the same format, same thing. Only thing is, while calculating V1, V2, V3, V4, you should be careful. For put option, it should be strike price minus market price. So 3 steps approach, you'll be able to get the value of call option or put option under 2-period binomial tree. Okay, now let's go to the last one, which is Black-Scholes model in options. Now Black-Scholes model has mostly theory question being asked, like assumptions of Black-Scholes model, factors affecting Black-Scholes model, factors affecting same factors, that strike price, market price, interest rate, probability, volatility, those 5 rates only will be applicable here also. But let's concentrate on the formulas part. But before that, you should understand the normal curve, because you have to compute that ND1, ND2 in the Black-Scholes. You need normal curve. Normal curve is a bell-shaped curve starting from minus infinity going till plus infinity. Okay, and middle part is being 0. In the exam, they can give you 2-tailed graph or they can give you single-tailed graph. Focus carefully. 2-tailed graph means, or single-tailed graph means, either they give this percentage or this percentage. Can you see that in the graph? The left extreme percentage 1 tail, or right extreme percentage 1 more tail. That is single-tail graph. Okay. We also require that only. I'll come to that. 2-tail graph means this number and this number would have been added. 2-tailed means both the tail would have been summed up, but we require single tail. So objective is, if they give you 1 tail, then use it as it is. If they give you two tail, then you should use whatever the number they have given, you please divide it by 2 so that it is converted into single tail. That is one part. Second part you should convert is, we require the answer from minus infinity to this number. So if they give you the starting point as minus infinity, our number is obtained. But if they give you starting point as plus infinity, our number should be 1 minus of this. How do you understand? They'll give you one column for Z, one column for P. So if probability values are increasing, then you should use as it is. That is because its starting point is minus infinity. On the other hand, Z values, probability they give, if probability values, or they say area also, are decreasing, that means starting point is minus infinity, so you do 1 minus infinity. So two simple steps. If they give you single tail, use it as it is. If they give you two tail, divide by 2. That is step 1. Step 2, if the probabilities are increasing, use the previous step number as it is. If the probabilities are decreasing, whatever the value they have given, you do 1 minus of that. That's all you need to remember with respect to Black-Scholes model. Fine. Formula of call option, value of call is S into ND1 minus X into e to the power of minus RT into ND2. It looks complicated. For the time being, let me take out this ND1, ND2. S is spot price and X into e power minus RT, X is strike price. And e power minus RT means basically discounting factor for continuous compounding. So it is spot price minus present value of strike price. Basically, my dear friends, what is the intrinsic value of call option? It is market price minus strike price. In fact, it is exactly same that this formula also talks about. Market price on one hand, that is spot price, minus today price, now we are taking, so present value of strike price, that is strike price into a discounting factor. That is what it is done here, e power minus RT. So coming to ND1, ND2, one more formula is there. D1 value is this you have to remember by heart. Ln S by X, S spot price, X strike price, R rate of interest, sigma volatility, T time period, sigma root T, D2. And in fact, D2 is easy to remember also. See, this sigma root T, D1 is here, sigma root T is here. Find out difference, you got D2 value. D1 minus denominator, you got D2 value. ND1, ND2, you get it from the normal distribution table I told you. So when you draw a graph, as this is 0 minus infinity, this is what is D1, and this area probability is what is called as ND1, and that normal distribution value they should give it to you, and Ln value they should give it to you, and e power minus RT means the e value also they should give it to you. So all the values will be given, you will be able to calculate using Black-Scholes model. Okay, see, just observe this. This is one tail, so you don't have to divide by 2. But look at the numbers. Numbers are decreasing in order. Numbers are decreasing in order means we need increasing order. So you should do 1 minus. So what you should do? 1 minus 0.4013. You get 0.5987. Then 1 minus 0.3821, you get 0.6179. Like this you can do for every value. So if D1 is 0.25, then ND1 will become this number, corresponding number, which is 0.5987. If D2 is, let's say, 0.30, then ND2 will become this corresponding number, which is got 0.6179. You have to substitute in the number. But sometime in the exam, what happens, they will not give you 0.25, they will not give you 0.3, they ask you what is n of D1 being 0.28. So between 0.25 to 0.3, you have to use the method of IRR, interpolation method. So 0.25 to 0.30, what is the gap? Then 0.5987 to 0.6179, what is the gap? Then we require from 0.25 to 0.28 means only 0.03. So proportionately that number, cross multiply, divide and add it to 0.5987, you get the number. Use the method of interpolation. So these are the things you can expect in the Black-Scholes model. Now, coming to one more theory question, Greeks. Greeks is only related to again options. So when one variable change, how the other variable will change. The rate of change in one variable having an impact on rate of change in another variable, that is called as options. So what are Greeks in options? So what are the factors influencing options like rate of interest, time decay, time value of money, a spot price, current price, probability, or the volatility. So when these one of them changes, how the option value will change. So delta, we have learnt also the unit change in the underlying asset. So when the market price of the underlying asset share price changes, by how much the option value will change. Gamma is change in delta, or I'll say second derivative. Change in delta has an impact on change in value of option. Vega, change in volatility on the value of option. Theta, change in the time, that is 1 unit of time changes means how much option value will change. And rho means if rate of interest change, how the value of option will change. In fact, easy to remember also. Delta gamma, you remember DG, or you say dog, DOG, delta gamma. And then Vega, easy to remember. Vega, V for volatility, T for theta, T for time, R for rho, R for rate of interest. So I don't think they'll ask any problems on Greeks. Remember these 5 names of the Greeks: delta, gamma, theta, rho, and Vega. And you can, using the name, you remember what does it imply. Every Greek will reflect change in the variable as an impact on change in the value of option. So this much if you remember, theory question you can write it. So this is your option, valuation, and discussion. The coming segment will talk about foreign exchange, your favorite chapter. Okay, so let us begin. The foreign exchange risk management. This is one of the complicated chapter. I'll try my level best to simplify, summarize, and it should be quick enough for you to solve it in examination. Okay. Basically, why foreign exchange is important, complicated, because in barter system, goods are exchanged for goods and services. Money system, money is exchanged for goods and services, where money is called as the unit of measurement, or also called as the price currency. Whereas in currency market, what we get is also currency, what we sell is also currency. So the most important point in foreign exchange, what you should remember is every time you sell one currency, you're also buying one currency. Every time you sell one currency, you're also buying one currency. That's an important aspect. Keep it in mind. So foreign exchange market, it's a market where currencies are bought and sold, and both commodities are the currencies itself. So what is exchange rate? It is an exchange rate where price of one currency is expressed in terms of another currency. You can call in different names. Expression can be in different names. Normally, people say, like, if it is 1 USD, if it is 1 USD equals 70 rupees. So people call USD as the base currency and rupee as the price currency. But I don't want to call that. You should remember, but I will call this as left hand side currency and this as right hand side currency, because it's easy to identify. So in every problem, your first step is to express it as left hand side and right hand side. And in that context, keep it in mind, pound always comes higher, below that euro comes, below that US dollar comes, below that rupee comes, below that yen comes. Because in the exam, when they say USD slash INR, should I read it as 1 USD equals or 1 INR equals? Normally, you can say it is denominator per INR equals, but not necessarily. So if you remember this, at least these 5 currency, you can apply it for other currency as well. Let me give an example. If I tell you GBP, INR, definitely you know. INR means you know that rupee is always a lower value that comes on right hand side. So for example, let me start with that only. if I write it as INR slash USD equals 50 rupees, you know it is 1 USD equals 50 rupees. But if I tell you USD slash INR also as 50 rupees, you know something gadbad here, because INR, for 1 INR, or if they just mention like this, okay, so they mention USD slash INR equal to 50, you definitely know it is not 1 INR equal to 50 US dollar, so it has to be same expression. So rupee wise you are good enough to identify, but if it is given as GBP slash USD as 1.7, how do you read? Should I write 1 USD equals to, or should I write 1 GBP equals to? That is where this 5 step will help you. If it is pound, which is we have now, so pound means higher rate, therefore it has to be 1 GBP equals 1.7 USD. This 5, remember, pound, below that euro, below that US dollar, below that rupees, and below that yen. Okay, pound is most frequently asked such thing. If I give you GBP slash USD, then 1 GBP equals to. If I give you, let's say, euro slash USD, yes, here also it is normally 1 euro equals to. But if I tell you USD slash Australian dollars, AUD, in such case US dollar is higher, so 1 USD equals. Okay, whichever is the higher priced currency, whichever is the higher priced currency will come on the left hand side, lower priced currency comes on the right hand side. Okay, so if pound is given, that's the first preference. Next preference is euro, next preference is US dollar, next preference is rupees, next preference is yen. Everything else comes in between these two, that you don't worry much. So rupee you can handle, be careful about the GBP especially, and the euro and US dollars. Fine, so you can find. Let's come to the basic terms. Quotation can be direct quote or indirect quote. Direct quote means 1 unit of foreign currency is equal to so many units of local currency. Indirect quote means 1 unit of local currency is equal to so many units of foreign currency. And my dear friends, direct quote, indirect quote are two sides of same coin, because if I tell you 1 USD equals to 140 rupees, okay, this is foreign currency equal to local currency, you can say direct quote. But if you think from a US citizen point of view, this USD is local currency, rupee is foreign currency, so for him it becomes an indirect quote. So direct quote, indirect quote are two sides of the same coin. It depends on from whose point of view you are looking at, and on that basis you can say whether it is direct quote or indirect quote. But as I told you, I will not follow these rules. I will follow left hand side approach and right hand side approach. I'll come to that. So there are spread also being given. They'll not give you single rate, they'll give you two rates: bid rate, ask rate, that is the rate at which bank buys, and offer rate, the rate at which bank will sell. So bank, when they are buying from the customer, they will buy at a lower rate, and when they are bank selling it to customer, they will sell it at a higher rate. So instead of thinking from the bank point of view, I would say think from the customer point of view is the best. Remember, customer will always be on a disadvantage position. So customer, when he is buying from the bank, he pays more, and when he is selling it to the bank, he pays less. Customer point of view is always preferred, and most of the problems, 70% of the problems can be solved based on customer point of view. But in some cases you have to think from bank point of view, and whenever it is from bank point of view, be very careful. That is where many people do mistake. Bank, when they transact with customer, bank is on advantage position. Advantage position means they buy at a cheaper rate and sell at a higher rate. But when the bank is transacting in the interbank market with the dealer, with the other bank, bank is like a customer, bank will be on disadvantage position. So depending on with whom we are transacting, you have to solve accordingly. When the bank is transacting with customer, it is on advantage position. Bank when is transacting with interbank, it is disadvantage position. But in general, please think from customer point of view, wherever possible, where customer is always on disadvantage position. Fine. Next. Position, I told you disadvantage for customer with bank, but the bank is with the interbank, they'll be on a disadvantage position. Margin is like a commission between bank and customer. Margin is applied, but between interbank margin is not applied. This is one more area where students get confused, whether should I add margin or subtract margin. So when if you think from the bid rate point of view, it is subtracted. Offer rate point of view, it is added. But that is difficult to remember, that is confusing. I'll tell you a better method to remember. Better method is this. Customer is on disadvantage position. Because of margin, extend his disadvantage position. Means when he is buying, he will buy at a higher rate. Already disadvantage position. Now even more disadvantage position, meaning add margin. Customer buying at a higher rate and even more higher rate with margin. Customer is selling at a lower rate, even more lower rate with margin. So best way to remember is extend the disadvantage position for the customer because of margin. Buying at a higher rate, increase even more disadvantage. Selling at a lower rate, reduce even more lower rate. That way you can remember better. Fine. Between interbank market, the margin is not usually applicable. Now conversion rates, many people have this confusion. When to divide, when to multiply. I will give you this route. Please follow it carefully. First step, identify whether it is spot rate or forward rate, because if the transaction is happening today, you take the spot rate. If the transaction is happening at a later date, like after 2 months, then you choose a forward rate. Okay, transaction today you take a spot rate, transaction later you take a forward rate. Second step is choose whether you multiply or divide. Please don't go to the step for higher rate, lower rate. That is where people do mistake. Please follow this chronology, what I'm telling. Follow this order carefully. First, spot or forward. Second, multiply, divide. Third step, whether higher rate or lower rate. So multiply or divide. Rule is this. If LHS currency is mentioned, then multiply. RHS currency is mentioned, then divide. Don't worry about which currency is purchased or which currency is sold. Buying and selling will come later. First, decide whether it is multiplied or divided. For example, they might tell you how many currencies of dollars to be sold to get rupees, or how many rupees to be purchased to sell this. Different sentences may be given. But what you should look at is which is the currency mentioned in the problem. For example, if they tell you 1 USD equals, they'll give you two rates like 50.25 hyphen 50.60 rupees. So first identify left hand side, right hand side. USD is left hand side because it is on the left hand side. Rupees right hand side because it is on the right hand side. Okay. Now they will tell you the question like this. How many rupees to be sold to get $10,000? Or are we sold, or are we selling, or are we buying? Rupees to be sold to get dollars. In every transaction you buy also, you sell also. So you have to think from one currency point of view carefully. That is important. So what currency mentioned? Don't worry about buy sales. What currency is mentioned? $10,000. Dollars is mentioned. Dollars is mentioned. Dollar is left hand side. Therefore multiply. Left hand side currency is mentioned. Multiply. Right hand side currency is mentioned. Divide. As simple as that. Let me give you one more, because rupee means you do it easily. 1 GBP equals 1.70 hyphen 1.75 USD. So GBP is left hand side and USD is right hand side. Fine. Then you go for the question. Let's say they say how many GBP to be purchased, how many GBP to be purchased to sell 1000 USD. Purchase, sell, they will play like anything. You should do what? Ignore it. What you should concentrate? USD. What is USD? Right hand side means divide. Hope that left hand side, right hand side currency is very clear. Left hand side currency is mentioned in the problem, multiply. Right hand side currency is mentioned in the problem, you should divide. Now coming to the question, which rate to choose, higher rate or lower rate? When you multiply, your mind is not at all problem. Multiply means, if the question is, if your second step say multiply, if you're buying, you buy at a higher rate. If you're selling, you sell at a lower rate. Simple. So if you're buying 1.75, if you're selling 1.7, simple. That is when you multiply. But when you divide, that is where people do mistake. Listen carefully. When you divide, the value which is divided is a higher rate. It means 1 by 2 is higher than 1 by 3. In other words, if your answer is division, your higher rate is 1 by lower rate. And if you want a lower rate, take 1 by higher rate. So in this problem, you have selected USD. Am I selling or buying? Sir, purchasing, selling, both are there. Think from the currency what you started with. You started with USD. USD you identified as right hand side. Think from USD point of view. USD being sold, and sold means lower rate, and lower rate means, because you're dividing, it has to be 1 by higher rate, and that means 1 by 1.75. So simple steps: identify whether left hand side, right hand side. If left hand side currency is mentioned, you multiply. If right hand side currency is mentioned, you divide. And if your objective from the currency you started is to purchase the currency higher rate, and if you sell the currency lower rate, but if the previous step was divide, then you should take higher rate is actually 1 by lower rate, and lower rate is actually 1 by higher rate. Let me give one more example, then we move forward. Again, I'll take euro this time. 1 euro equals, let's say, 7 Singapore dollars. It's an example. Okay, they say a question like this. How many Singapore dollar is required for selling 1000 euro? The euro is left hand side, USD is right hand side. Left hand side means multiply, because 1000 euro given, and what you are doing, you are selling will be at a lower rate, and because multiply, straight away lower rate, and lower rate, let's say between 7 to 8, you will select 7 as the lower rate, selling at a lower rate. Hope you understood. Let's go further. Let me see if you can fill up this table. I'll fill up one or two. You try to fill up the remaining. As a sample base, I'll take few. Let's say I'll take this one. One AUD is 1.8 and 1.85 Singapore dollars. Okay, so Singapore dollars is what? Singapore dollar is right hand side. AUD is left hand side. Singapore dollar is right hand side. Therefore, right hand side means we should divide. And you are doing with respect to Singapore dollars buying will be at a higher rate, and higher rate because you're dividing 1 by lower rate, which is 1 by 1.80, 1 by 1.80. Let me take one more right hand side confusion only. Let's say this one, GBP, and sell $1,000 US dollar is right hand side, so you divide, and you are selling at a lower rate, and because you're dividing, it will be 1 by higher rate, it will be 1 by 1.75. okay, so like this I've filled up everything. You can also try it, then you look at the solution. Okay, you can pause the video, you try it, and then you can fill it up and compare your answer, see whether your answer is right or not. Okay, let's go further. Few more terms you have to understand in the foreign exchange market, especially in forward market. First, let's think from exporter point of view. Exporter will receive money from his foreign supporter. Once exporter receives, if he converts it that day itself, then there is no exchange risk. But if he converts it later, then there is exchange risk. Anyway, so once he receives, let's say, US dollar from customer, he cannot keep it in dollar terms, he has to give it to the bank. Now, once it is given to the bank, bank cannot keep it with themselves, they will have to sell it outside. The rate at which bank gets from exporter, think from bank point of view, bank is getting US dollar, therefore the rate at which the bank gets dollar from the exporter is called as the forward rate or forward buy rate. And once it is done, bank cannot keep the position open, because bank, if they keep only dollar with them, the dollar rate fluctuate, they may have a profit or loss. So for that, what they do, they will sell it in the interbank market. But remember, when will bank get it from the export customer? Only later, right? Let's say after 3 months, after 6 months. That is why a customer has entered into a forward contract with bank. Now what bank should do, bank should also enter into one forward contract. And what forward contract? Forward sell contract. In the interbank market, that rate is called as cover rate. So think from bank point of view, bank is getting dollars from customer and bank needs to sell it to the bank, interbank in the market. So with the customer, you have forward buy, and in the interbank, you should have forward sell. If the customer, you have forward sell, then interbank, you will have forward buy. So the opposite forward contract that the bank takes in the interbank market so as to fulfill the requirement of customer is called as the cover rate. So forward rate, they buy, cover rate, they sell in this example, and difference between those two is the profit for bank. Similarly, if you think from import transaction, importer has to make the payment to his supplier. So what will he do? He will come to bank and say, please give me the dollars. So bank has to enter into a forward sell at a particular rate, which is called as forward contract rate or forward rate. But where will the bank get the dollars from? They have to purchase in the interbank market. Therefore, bank will enter into a forward contract in the interbank market so that they can fulfill the requirement of the customer. That rate is forward buy rate, opposite of transaction with the customer, and difference between that cover rate and forward rate is the profit for the bank. So whenever the word cover rate is given in the problem, whenever the word cover rate is given in the problem, it is from the point of view of banker. Banker transacting with the customer, advantage position. Banker transacting with the interbank, disadvantage position. Banker transacting with the customer, margin applies. Banker transacting in the interbank market, margin don't apply. And the profit or loss for the banker is difference between the cover rate and the forward rate. And if the banker is selling it to the customer, then cover rate will be buy rate, and if banker is buying from the customer, the cover rate will be sell rate. So transaction with the customer and transaction with the interbank market cover rate, the forward rate and the cover rate are always opposite, and difference between those two is the profit or loss for the banker. Okay, so these are the points you need to keep it in mind. I have given the form of sentence also. Let's go further. Now one more question they can ask: cross rates. Okay, so cross rates. In direct quote or in the indirect quote, only two rates are given. I would call it straight rate between two currencies. Cross rates means one more intermediary currency also will be given. For example, if you want between USD and INR, they will not give it to you, but they will give you USD to GBP, one currency will be there, and GBP to INR, two rates are given. So when the expression between the two currencies are directly not available, it is expressed in terms of an intermediate currency that is called as cross rates. Okay, sometimes it may be objective like opportunity, sometimes it might be a necessity, both cases. So the process is, when the spread is not given, you can express mathematically, that is faster. Like currency is A by C is A by B into B by C. Okay, so A by C, two currency you want, but they have given between A and B and they have given between B and C. You can easily express. For example, let's say 1 USD equals what is that? Let's say 1.5 Singapore dollars, and 1 GBP equals, let's say 1.8 US dollars. But you want between Singapore dollars and GBP. If that is what you want, then what do you do? Singapore dollar for GBP, because denominator means left hand side. So what do you do here? Singapore dollar and GBP, numerator denominator. In the intermediary, one more currency is there. What is that? US dollar, US dollar. Okay, now what do you require? This is per Singapore dollar equals and today per Singapore dollars, denominator means 1 Singapore dollar, and per GBP equals. Fine. So or you can also say like 1 this is equals 1 USD equals, and this is 1 GBP equals. They have given that only 1 USD equals to 1 GBP equals to, which is 1.5 and 1.8. You can simply multiply it. So things are not very difficult, things are not confusing when they are giving you in the form of single currency. But when they give you spread, that is where the confusion apply. Spread means two rates will be there, that confusion will be there, like whether to buy or to sell, that kind of confusion will be there. For that purpose, what do? You follow this, that is, keep the objective in mind. That is, if ultimate objective is buy, express all the things are in buy. If ultimate objective is sell, express everything in sell. Let me give an example so you'll understand better for the cross rate. Okay, they give you the cross rate like this: 1 USD equals 50-51 rupees, and then 1 GBP equals 1.5-1.6 USD. Okay, and what we want between GBP and rupees. Suppose if you want to buy GBP, that means what? You are having INR and your objective is to ultimately convert it to GBP. So INR to intermediary currency. How do you know intermediary currency? Available in both the rates. So INR to USD is one route, then USD to GBP. Ultimate objective is to buy GBP. That's why GBP is at the end. So what will happen? Since our objective is to buy, remember previous things also express it in buy terms. Remember, in every transaction you buy one currency, you sell another currency. But the rule I'm telling you, if your objective is to buy, express all the transactions in buy. If your objective is to sell, express all the transactions in sell. In this case, ultimate objective is buy. So all the transaction you write it as buy. So what do you do in the first step? From the INR, you convert it to USD. So you are buying USD. In the second, you are converting USD into GBP. So you are buying GBP. Sell, I'll come to it later. Okay, now compare between INR USD. USD is left hand side, means multiply, and buying at a higher rate, and higher rate is 51. Simple. In the second case, you buy GBP between USD and GBP. GBP is left hand side, that means you multiply. Since you are buying, you choose a higher rate, and higher rate is 1.6. You got it easily. Let me give one more example. 1 USD equals let's say 51 rupee, and 1 USD equals 7.5 7.6 Singapore dollars. If they're given you like this, then what do you do? Let's say you want to buy Singapore dollar, that is your objective. So what do you do? From INR, you want to convert it to USD, and from USD, you want to convert it to Singapore dollar. Since your objective is buy, both terms write it as buy. In the first case, from INR, you convert it to USD, so you are buying USD. In the second case, you are converting USD to Singapore dollar, so you are buying Singapore dollars. Now between rupee and Singapore dollars, US dollar is left hand side, so you multiply, buying at a higher rate, and higher rate is 51. In the second case, USD and Singapore dollar, buying Singapore dollars, which is right hand side, you should divide. Buying at a higher rate, but because you're dividing, it is 1 divided by lower rate, 1 by 7.5. So 51 into 1 by 7.5 is the rate applicable for buying Singapore dollar. So if you want to buy, keep all the transaction in buy. If you want to sell, keep all the transaction in sell. In this example, if you want to sell Singapore dollar, start from Singapore dollar to USD to INR, and here sell Singapore dollar, and here you sell the USD. So if you want to buy, keep all the transactions in buy. If you want to sell, keep all the transactions in sell. That is how you are going to manage with cross rates. Okay, now moving further. Forward market, various terminologies that you need to understand. What is forward contract or forward market? It is the contract, an agreement entered today, but for settlement at a later date. The later date is known in advance. The rate at which you are going to transact is also known in advance. Why will you enter into such contract? For various purposes. Maybe speculation, or maybe for hedging purpose. What do you mean by speculation? You are planning to buy at one rate, let's say 70 rupees, but your expectation that in the market it go up to 75 also. So you buy at 70, sell it at 75, you can make a profit of 5 rupees. On the other hand, it may be for hedging purpose also, because you are having an liability to make a payment of so much dollar. You are worried about that rate. You don't know at what rate you are going to buy. You want to have a commitment rate, so you enter into a forward rate. Okay, so rate entered today for settlement at a later date, where the date and the rate both are predetermined. It may be for speculation purpose, or it may be for hedging purpose. So agreed today for settlement at a later date. Now expression of the numbers between spot rate and forward rate. So when I compare between spot rate and forward rate, it might be at a premium or it might be at a discount. The forward rates are at a premium when forward rate is more than the spot rate. Simple words, more means premium. So when forward rate is more than the spot rate, it is called as premium. When the forward rate is less than the spot rate, it is called as discount. If you want to compute this premium in percentage terms or discount in percentage terms, then forward rate minus spot rate divided by spot rate into 100, like P1 minus P0 by P0 into 100. This is absolute percentage. To convert it into annual terms, you do into 12 divided by number of months, or if it is number of days, 365 by number of days. When this number is in positive terms, it is premium. When this number is negative terms, it is discount. Position. For an importer, usually he will enter into forward buy contract because he needs to buy the currency to be able to make the payment to the supplier. An exporter usually will enter into forward sell because he will receive the currency from the customer which needs to be sold in the currency market. Now, quotation, forward rate sometimes may not be directly given. They will give you in the form of points, swap points. So swap points, you should read from right to left, which means what? I'll tell you. So if they give you the rates are like 50.3257 and they give you a hyphen 3260. If they tell you 10/20, like that, if they tell, then you should understand 10 is for last 2 digits. Whether to add or subtract, I'll come to it. Or if they give you 3 digits, 100, 200, you should read for last 3 digits. If it is thousands, 4 and 2000, then you should take for last 4 digits. So read from right to left, Urdu style. Read from right to left. When the swap points are increasing, you have to add. When the swap points are decreasing, you have to subtract. Okay. When the swap points are increasing, you have to add. When the swap points are decreasing, you have to subtract. Let me give an example. Suppose it is $1 is 1.8 some currency, let's say Singapore dollar hyphen 1.9 Singapore dollar, and they will tell you the points, or let's say 1.80, 1.90. They'll tell you swap points are 10/20. 10/20 is increasing, so it will be plus 0.10 plus 0.20. If they tell you 20/10 decreasing, then that means they are trading a discount, so you should do minus 0.20 minus 0.10. When the swap points are ascending order, it has to be added because they will be trading at premium. When they are decreasing, descending order, they have to be subtracted because they are trading on discount. Okay. Now, movement, sometimes they may say percentage also, like appreciation and depreciation. If left hand side currency is appreciated, you increase it to the right hand side. If left hand side currency is depreciated, then you have to subtract 100 minus and other way around. Okay, this point may be confusing. Let me give an example. When left hand side currency appreciates, don't multiply for left hand side, you should multiply for right hand side. Meaning, if I say 1 USD, or let's say 1 liter petrol is 70 rupees, and they say petrol is appreciated by 10%. Does it mean you multiply 10% for on petrol? You don't get more petrol. The price is becoming costlier. In other words, when left hand side currency is appreciated, multiply for right hand side. If right hand side currency is appreciated, multiply for left hand side. Example, 1 USD equals 50 rupees. They say US dollar appreciates by 10%. You should multiply 50 rupees into 1 plus 0.1. If they say INR appreciates by 10%, don't multiply it for rupees. For US dollar, multiplied by 1 plus 0.10%, 10%. If it is depreciation, of course you do minus. Important point is left hand side currency appreciation means right hand side currency depreciation. That is right, but not equal. Means what? If US dollar is appreciated by 10%, that means rupee is depreciated, but not exactly by 10%. Maybe approximately, not exactly. So when one currency appreciate, other currency depreciate, but not exactly, but definitely approximately. Okay, so this is the appreciation of currency and depreciation of currency. Let's come to now some parity theorems. Purchasing power parity theorem is there. Interest rate parity theorem is also there. Okay. So now among the parity theorem, first one is purchasing power parity theorem. What does it say? It says that law of one price, which means the different countries may have different currencies, but their ability to purchase the product should be same. If in any country, if some products are more cheaper, there exists arbitrage opportunity, thereby that becomes more profitable. So currency may be different, but purchasing power should be same. In other words, the spot rate is ascertained as the implied rate between the prices of the products, which means suppose you say in India one laptop is rupees 60,000 rupees and same quality laptop in US, let's say $1,000. Then the exchange rate between these two, 60,000 divided by $1,000 for the same product, identical product or similar product, that is 60,000 divided by 1,000, that will give you rupees 60. This is how implicit rate is ascertained between two currencies. If the rate is different, of course there exists arbitrage opportunity. This is the spot rate. In the forward rate, they say the exchange rate between two currencies is determined by the impact of inflation, that is inflation in India and inflation in US. After considering, you'll be able to compute the theoretical forward rate, and the format is given by forward rate equals spot rate into 1 plus local inflation rate divided by 1 plus foreign inflation rate. Some people also write forward rate by spot rate equals 1 plus local divided by 1 plus foreign, whichever way it is. So this is the forward rate theoretically computed based on inflation between two currencies, that is purchasing power parity theorem. Okay. So if actual forward rate is more or less, that means you say that either it is overpriced or underpriced, there exists arbitrage opportunity, which means one country is good for purchasing and other country is good for selling. That is purchasing power parity theorem. But what is more important from solving problems from your syllabus point of view is interest rate parity theorem. That is, it's very similar to the purchasing power parity theorem, only difference is inflation rates are replaced by interest rates, because inflation for different product can be different, so considering an average may not be appropriate, whereas interest rates of a country is always more controlled and regulated by the central banks like RBI, Federal Bank, Federal Reserves. Therefore interest rates are preferred over inflation rate, and in such case the theorem is called as interest rate parity theorem. Purchasing power parity theorem tells you between two countries, where you buy, where you sell should not matter, it should be indifferent. Whereas interest rate parity theorem says where you borrow, where you invest should not matter. If interest rate parity theorem holds good, whichever country you invest, whichever country you borrow, you are same. If interest rate parity theorem does not hold good, then there exists an advantage in borrowing in one currency or investing in another currency. Okay, that's what is there. If borrowing is cheaper, that means interest is saving is more, foreign currency is less, or you can say borrowing is costlier, loss in money market or gain in currency market. That should happen. That is, if not happening, that means that one currency is advantageous for borrowing and another currency is advantageous for investing. So forward rate should be based on implied interest rates, and if that is formula is given as same formula, spot rate into 1 plus local interest rate divided by 1 plus foreign interest rate. And if this actual forward rate is more, that means that one currency is good for borrowing, other currency is good for selling. Okay, let us try to understand some interpretations before we go to the arbitrage theorems. Suppose spot rate, let me say it is 50 rupees. Okay, 1 USD is 50 rupees, and interest rate in India, let's say it is 10%, and interest rate in USA, let's say it is 5%. Then what will be the forward rate? Forward rate equals spot rate, which is 50, into 1 plus local rate, which is Indian rate 0.10, and keep it in mind, if it is for 6 months, this 10% should be into 6 by 12, 0.10 into 6 by 12, not 1 plus 0.10, 0.10 should become 0.05. Okay, then you add plus 1, be careful about that. Anyway, divided by 1 plus foreign, that is 1 plus 0.05, which will give you the answer as let me calculate. Yes, 50 into 1.1 divided by 1.05, you get 52.3809, or I'll say 52.38. Okay. Now observe one thing. Why the forward rate is high? That is one of the interpretations, observations. The interest rate in US is less, in India is high. Therefore, you see that US currency is trading at a premium. In general, you should observe whichever currency has got less rate of interest will have or will be expected to trade at premium. I repeat the sentence once more. Whichever currency that has got lower rate of interest will be expected to trade at premium. In this case, US dollar is an example. One more observation if you do. What is the percentage you see or forward premium? 52.38 is the forward rate minus spot rate 50 divided by 50 into 100. Or you can express in annual also. This is anyway 12 months only, no problem. So 52.38 minus 50 divided by 50 into 100 will give you 4.76%. You see, that is the difference between interest rate between two countries. So two important points. Whichever currency that has got less rate of interest is expected to trade at premium, and difference between the two interest rates should be approximately be equal to the premium. Okay, that's what approximately you say, 5% difference here and 4.76% difference here. And you know, I cannot directly compare 5% 4.76, though they are approximate, because we don't follow additive model, we follow multiplicative model. Okay, so one of the important question you may face is whether to they also call it as covered interest arbitrage. There are two ways of handling it. Let me show you the first way, interest rate parity theorem, arbitrage. How do you handle it? Then let me tell you the other method. So first method is using the forward rate method. That means compute the theoretical forward rate using IRPT theorem. If theoretical rate, let's say 52.38, what we calculated, but actual forward rate happens to be 55. Actual forward rate is more than theoretical forward rate, overpriced. And forward rate is overpriced means, you know, what is the rule? Overpriced means you have to sell. So forward you have to sell, and forward sell means you should take spot buy. That opposite, you know, we have learnt in future also. Forward sell, foreign currency, you enter into a forward sell means spot you should buy foreign currency. If you want to buy shares, what do you do next? You borrow money. So if you want to buy foreign currency, next step is to borrow local currency. So you borrow local currency, using that money you buy foreign currency, and that money you're going to deposit, and transactions on maturity, everything will be consequent. Deposit matures, borrowing is repaid, spot buy in forward sell using this contract entered earlier. That is what this is not settlement by net basis. Unlike in futures, this is not settled by net basis. This will be settled only on delivery basis. So one of them will be blank. So three transactions will be there. One of them will be blank. Other situation, other way of understanding, what will happen if forward rate is less? Like theoretical rate you got 52.38, but actual rate happens to be 51. So forward rate is less, underpriced, and forward is underpriced means it has to be purchased. It has to be underpriced. Sorry, this is underpriced. Let me do a change. That is a typing mistake. Let me do a change. What is it? Give me 1 second. Just looking for the slide. Just give me 1 second. I'll come to it. 1 minute. Okay. Anyway, so let's come to it now. Okay. So if forward rate is less, that means underpriced. Underpriced means it should be purchased. Forward buy means spot sell. Therefore, transactions are enter into forward buy in foreign currency, and forward buy means spot sell in foreign currency. If you are selling shares, what you do for that? Selling means short position. Selling shares means you took the borrowing of shares. So you need to borrow foreign currency. Once you borrow foreign currency, you sell it in the market, you get local currency, you deposit it. Okay, so fundamental rule, keep it in mind: borrow and deposit should happen in different currencies. Borrowing USD, deposit USD cannot happen. Borrow rupees, deposit rupees cannot happen. If you borrow USD, then you should deposit rupees. If you borrow rupees, then deposit should be in dollars. That basic, keep it in mind. And spot buy means forward sell. Spot market and forward market are opposite. So just to give you a summary part, I'm giving you this arbitrage strategy so that in one place you can remember the clear format for solving problems. Okay, for either it is forward is overpriced or it is underpriced. If it is overpriced, then you follow this rule. Very simple: buy, sell, borrow, deposit. Very simple rule that you have to follow. Forward is overpriced. Forward is overpriced means what do? You enter into sell. And forward sell means what will happen in spot? Spot you will buy. And if you want to buy means where the money comes from, you have to borrow. Therefore, you borrow local currency and deposit foreign currency. And later all this consequence happens. Deposit will get matured, borrowing to be repaid, forward sell will be executed using the contract, and difference profit you get. Net amount on hand is arbitrage profit. If it's underpriced, same format: today, later, buy, sell, borrow, deposit. You remember like your P&L account or balance sheet. Buy, sell, P&L, borrow, deposit, balance sheet. Now underpriced. Underpriced means what is the transaction? Can you tell me? Buy. So forward buy. Forward buy means what will happen in spot? Opposite, spot sell foreign currency. If you are selling foreign currency, where do you get the foreign currency? You need to borrow in foreign currency. Once you borrow in foreign currency, you have to deposit. A very simple, my dear friends. You can also remember like this. See, long position on foreign currency means you need to take short position on local currency. You can remember like that also. See, spot sell, that means short position on foreign currency means long position on local currency, because borrowing and deposit, nothing but borrowing is short, deposit is long term. You can remember that way also. Then what will happen later? This deposit will mature, borrowing should be repaid, and this forward buy contract should be executed, and one blank will be there because settlement is on delivery basis. Follow this format, you can remember better. Okay, so before we go further, there is one more kind of questions, or one more arbitrage strategy you can call. People call it as covered interest arbitrage. Okay, you can say covered interest arbitrage, or also you can say that local borrowing versus foreign borrowing. Using this method also you can ascertain. Okay, so when you borrow locally, what is your interest and what is your savings, and if you borrow in borrowing, what is your interest and what is your saving. So local borrowing means you will save local interest, you pay local interest, and foreign borrowing means you pay the foreign interest. Okay, that is one. But if you borrow in foreign borrowing, foreign interest is your expense. In addition to that, the premium what you say is also is your expense. For example, if local interest is 12% and foreign interest is, let's say, 8%, and premium is, let's say, 5%. So if you borrow in local currency, 12% is your interest cost, but foreign currency 8 plus 5, 13% is your interest cost. But actually you should not do 8 plus 5, because we should follow multiplicative model. So you should do 1 plus 0.08 into 1 plus 0.05, 1 plus r, 1 plus r, then you can do minus 1 to get the percentage. So how much you get? 1.08 into 1.05, then minus 1, approximately you get, but similar one, 13.4%. So you say that foreign interest is costlier, local interest is cheaper, so local borrowing is beneficial. This is one way of analyzing it. Some people also say interest differential versus the premium. So what is interest rate differential, and other, what is the forward premium? Interest rate differential in the given example, 12 minus 8, which is 4%, and forward premium is 5%. So if you borrow in foreign currency, forward premium is like your expense, and interest rate differential is like your savings. So in this case, your expense is more, savings is less, so foreign borrowing is not recommended. Or other words, people say like this: if interest rate differential is more than forward premium, then you better go for local borrowing. Interest rate differential is the savings you do, is less than premium. Okay, so I'm just not opposite, so just give me 1 second. So if interest rate differential is more, then foreign currency, foreign borrowing is preferred. In this example, interest rate differential is less, premium is more, therefore local borrowing is recommended. So you can also go by this rule, but for arbitrage you still follow this only. So when I go for underpriced, overpriced, this was our starting point, sell buy. If you go for the borrowing or deposit, borrow local currency or foreign currency, this will be your starting point. And sometime in exam starting point they only give it to you, but the format remains same. Let me tell you this last point one more. They can ask you for theory question also, or many textbook have followed this covered interest arbitrage mechanism. Interest rate differential versus premium. Interest rate differential, you take it as a saving, premium is take it as an expense. Okay, so when you go for foreign borrowing, so if interest rate differential is more, then foreign borrowing is beneficial. If interest rate differential is less, then foreign borrowing is not beneficial, local borrowing is beneficial. Hopefully you are able to follow these aspects. Now let me go to one more important area in forex, that is hedging. Hedging means the process of reducing the risk or managing the risk. Remember, we are not here to make profits in hedging. Hedging is only a process of making cash flow certain, which means for exporter we are trying to make sure that inflow is certain, and for importer we are trying to make sure that the outflow is certain. So making the cash flow certain, guaranteed, known is our objective, not to make any profit. Okay, now various types are there. Forward hedging, you enter into a forward contract. Money market hedging, I'll tell you, where you make use of deposits and borrowing. Netting concept, where set off will happen. Leading concept is there, lagging concept is there, options are there, futures are there, and even swaps are there. So we have to understand all these aspects. Let us get into one by one. Coming to forward hedging is very simple, because forward hedging, an exporter will enter into forward sell, an importer will enter into forward buy. Okay, that is simple forward hedging applicable for what inflow an exporter gets and what outflow the importer has to make a payment. Exporter will enter into a forward sell contract because he has to sell, he has to give away the money he received from customer. And importer need to buy the forward contract so that whatever he buys in the forward contract, he can make the payment to the supplier. Let's come to the money market hedging. Along with that, forward hedging also I will simplify. Let us think for an exporter. An exporter is selling goods to a person, his customer, let's say in US, and 3 months later he will receive the money from his customer, let's say US dollars. Once he receives, how much he will get by converting the dollars into rupees. Imagine his situation clearly. I'm an exporter. I receive dollars from my customers. I have dollars with me. I cannot keep it in dollar terms. I have to convert it into rupee terms. For that, what should I do? I have to sell US dollars in the currency market. When? After 3 months. That is called as spot market. But at what rate I will sell? Whatever is the rate on that day, that rate I will get. Maybe 70 rupees, 71 rupees, like that. That is uncertain situation. That is what is the risk we are trying to call. This is also called as unhedged situation. But in this situation, how much money do I get is known only on that day, not earlier. Okay, so instead of selling in the currency market, you might sell in the forward rate, that is forward market. And that is what is called as forward hedging. Why it is called as forward hedging? Because that forward rate is committed today itself. Though it is sold after 3 months, but the rate is known in advance today. So I am not affected by the market fluctuations. Therefore, my receipt is hedged. Uncertainty is not there. Instead of selling in the spot market, I am selling in the forward market, which is known in advance. Now, money market hedging means I'm not selling in the spot market, I'm not selling in the forward market, I want to sell in the money market. Money market means what? Sell, it has to go out, means it is used for repayment. So you will use for repayment of US dollar loan. Other way of understanding, some people also explain like this. Hedging means going opposite. In derivatives, in futures also we understood. In portfolio management, we take long position, portfolio, and in index futures, we take short position, opposite in nature. Similarly, for an exporter, receivable is an asset. Receivable is an asset. So to create an offset position, I'll create a liability. So I will borrow US dollars. That way also you can analyze. So if I want to repay US dollar no means today I borrow it. I have a receivable being an exporter in foreign currency. So I create a payable borrowing in foreign currency. I have an asset in foreign currency. I have a liability in foreign currency, so that whatever happens, the rate fluctuations, my net off, my set off position will happen. So my positions are unaffected by market fluctuations. Once you borrow in USD, what do? You convert it to rupee in the spot market. You sell. And once you sell, you get rupees. What do? That rupee will be deposited. That rupee will be deposited. And the deposit matures, that money you get it along with rupee rate of interest. This deposit maturity, what you get effectively is the inflow for exporter. Though the money is received after 3 months, money is received later, but at what amount I'll get is known today itself. That is why it is called as hedging. Now, one more important point to be kept in mind. You should not borrow the dollars equivalent to invoice amount, because if invoice amount is $1,000, you'll receive $1,000 after 3 months. Now if you borrow $1,000 along with interest, it will be more than $1,000. It will not match. So your repayment of USD should match your invoice amount. Therefore borrowing should be present value of the invoice amount, present value using the interest rate of USD, borrowing rate of USD. Then today you are going to sell, so you take sell rate, and once you deposit rupees, you get deposit interest rate in rupee, you get the maturity amount. That maturity amount, effectively what you get is the inflow under money market hedging for exporter. If you example, I don't want to use it now. I have already uploaded a video on the YouTube. In our channel only it is available. I've given you the detailed explanation along with example. You can go for it. Okay, but observe one thing. I'm using present value as well as I'm using future value. Present value is also there, future value is also there, spot rate is also there. But so effectively, instead of following this long calculations, you can follow, I will give you the beautiful shortcut. Okay, so look at what is happening now. What is happening? I'm taking the invoice amount and doing the present value. So invoice amounts and I'm doing present value, means 1 plus R, USD rate means 1 plus R, let's say foreign currency. Okay, then what is happening? I'm taking sell rate in spot market. So I'm taking spot market. Then what I'm doing? Compounding by rupee deposit. That means I'm multiplying by 1 plus R but local currency. That is the effective amount. What is this formula? This is nothing but the IRPT formula, interest rate parity theorem formula. So if you really apply interest rate parity theorem, you get the answer in one line itself. But the examiner don't like if you give the answer in one line, you have to give the series of transaction. So let me give you the shortcut in that manner. So I'll give you shortcut for exporter also, I'll give shortcut for importer also. Okay, so let me give you the shortcut that you require. So I'll tell you how to remember the shortcut also and how to present in the exam also. Fine. So let me do for exporter first. So what do? First you write the IRPT theorem. Spot rate. Of course, you start with invoice amount maybe first. Invoice amount is always there first. Anyway, then spot rate you take multiplied by, or let me just write it once more, spot rate. For exporter, let me write it spot rate. Anyway, invoice amount will come as usual. Then 1 plus local currency divided by 1 plus foreign currency. That's all. Simple formula over. Importer also you do the same thing. Okay, let me have to give, okay, steps I'll write it here. Importer also same thing. Spot rate into invoice amount into 1 plus local rate by 1 plus foreign rate. This much is straightforward. Then you have to modify now. What modification? Exporter. Exporter means he is a buyer or seller. Exporter is a seller. So it will be spot sell. What about importer? Importer is buyer, spot buy. Now exporter, tell me, he will have receivable or payable? Exporter will have receivable. So numerator you write it as deposit. Opposite denominator, that is borrowing. Denominator, importer, what does he have? He has liability, which means you start with borrowing. In denominator, you make it as opposite deposit. Now come to steps in exam, because you can't write the answer like this in one line. So step is very simple. Start with denominator. Step 1, spot rate is step 2, local deposit step 3. You just remember this arrow kind of thing. That is what you need to remember for step 1, step 2 and step 3. Here also step 1, foreign plus deposit. Step 2 is spot buy. Step 3, local borrowing. Let me show you those steps also. So you write step 1, that is you are going to do this one. That means what? Foreign borrowing. So step 1 in the exam you give heading foreign borrowing. How much will be step 1? The invoice amount divided by 1 plus foreign borrowing, right? What is second step? Second step is spot sell. So whatever you have take spot sell, you give the heading only spot sell. How do you calculate? Whatever you calculated in step 1 multiplied by the sell rate. What is third step? Whatever you write here, local deposit, you can write local deposit is your third step. That is whatever step 2 you calculated multiplied by 1 plus R, that is local deposit rate. Similarly, you can write for importer also. Let me quickly write. First step, foreign deposits, which is equal to the invoice amount divided by 1 plus foreign deposit rate. What second step? Spot buy. So second step is spot buy, which is equal to whatever step 1 into the buy rate, spot buy rate. Step 3. What is step 3? Local borrowing. Give the heading also local borrowing. Means whatever step 2 we have calculated into 1 plus local borrowing. You get the formula easily. So logic of money market I told you, shortcut I told you, how to present in the exam also I told you. I think after this, if you do a mistake in the exam, it's a crime. I think my handwriting may not look beautiful. This is the clean answer that you can remember for examination. Anyway, I'm sharing these notes with you, so you'll be able to read it as well. Okay. Now, next varieties of question that you can expect is supplier credit versus bank credit. A typical question. This is usually related to Indian importer only. This is usually related to Indian importer. Usually related to Indian importer only. Actually, this is an extension of local borrowing versus foreign borrowing situation. But in this case, you can also have some more elements like letter of credit, LOC, application problems. So this we are having a separate discussion. Okay, now going forward, supplier credit is like a taking a foreign borrowing. Local credit, like you use bank overdraft, is like local borrowing. Interest rate, when you take the help of a supplier credit, foreign interest rate, the interest rate charged by the supplier. Bank rate means the interest rate charged by your bank overdraft interest rate, so local bank interest rate. Conversion rate, supplier credit means when are you paying, not today, after certain time, so you require forward rate. Bank credit means what you are paying, you will be paying immediately by taking loan from your local bank. Immediately paying means you require spot rate. So we are having forward rate, spot rate, foreign interest rate, local interest rate. And please observe, normally forward rate will be high and normally local interest rate will be high. So both the choices have got their own advantages. So before we compute, we can't say that whether supplier credit is beneficial or bank credit is beneficial. Now one more important question to keep it in mind is, which should I apply first? Forward rate should I take it first, then interest rate, or interest rate first, then conversion rate? That sequence you have to be very, very careful. In case of supplier credit, you tell me which comes first, interest rate or forward rate? Today what do? Are you paying today? No, you pay along with interest later. So interest rate comes first, conversion rate comes later. In bank rate, what is happening? You have to pay to your customer. Today itself you pay him by taking money from your bank. Therefore, today itself you are paying, which means conversion rate comes first, that is spot rate comes first, and then the interest rate that you have to pay to your banker. So remember this simple chart, you can solve the problems on supplier credit versus bank rate. Okay, use one more kind of questions will be there, that is letter of credit. What is this LOC, letter of credit? Again, it is applicable only for importer transactions. You are an Indian importer importing goods outside India, let's say from US. So US supplier is giving you the goods on credit basis. Cross-border transaction, credit requires trust, and as usual Indians are not, I can't say not trustworthy, but they require some sort of a surety, some sort of a guarantee. That guarantee is called as letter of credit. Letter, they'll give a letter of credit. So keep it in simple words. Many other features are there, but keep it only to this much. Either your bank or a foreign bank gives a letter of credit to the supplier on behalf of you, or they make the payment to your supplier on behalf of you, and then they take the money from your side. Both ways it's fine. But for giving the letter of credit, they don't give freely, they charge. That is called as LOC commission, LOC fees, and this fees should be paid immediately as a percentage on invoice amount, and that should be paid in foreign currency. So if I compare the two things, that is local currency was foreign currency, supplier credit was bank credit, that foreign currency was there, along with that you include this LOC. Two extra cash flows will come, one cash flow related to the LOC charges payable today, and along with that interest rate, time value of money also to be considered. So interest rate, as usual, foreign currency means foreign interest, local loan means local interest. Then conversion rate, foreign currency loan means you are repaying it later, so forward rate. Local currency loan means you are paying today itself by taking loan from your local bank, therefore spot rate. And sequence, you know, in case of foreign currency, supplier credit, you apply interest rate first, then you convert. Whereas in local currency, you convert first, to that extent you take loan. Additional two things will come, or one thing will come, letter of credit, that is LOC commission, and because that commission is payable today, you have to multiply it by spot buy rate. Payable today in foreign currency means to that extent you have to buy from the market. Okay, so local LOC commission into spot rate. And one more important aspect, that people do mistake is, on this you have to apply time value of money because you are paying today itself. And for applying time value of money, you don't take foreign currency loan, you take local currency loan. You can't take their loan and pay their commission. See, you're going to that bank taking loan and you have to pay them commission. So when they say give me commission, you say give me one more loan, I'll give you the commission. Does not look nice, right? So to pay the foreign currency, you take the local currency. So even though heading is low foreign currency, commission has to be paid in foreign currency. To that extent, you borrow from your local bank, go to the market, buy that commission, buy that currency and pay the commission to the foreign bank. So even under foreign currency heading, you get local currency interest. Keep this very, very clear. Even in foreign currency loan, you will take the local currency interest on the time value of money related to LOC commission charges. So hope this chart method should be able to remember it easily while solving problems. Okay. Now comes to one of the most important area, that is disposal of forward contracts. One second. Okay. Okay. Disposal of forward contracts. Forward contracts basic meaning, contract entered today for settlement at a later date. So the due date, the date on which the contract was supposed to be settled, is called as due date. So on the due date, contract may be settled, everything happened as per expectations, that is execution on due date. Or you may want to cancel on due date, or you want to extend on due date. Before due date, that is before the settlement date comes, earlier to that only you want to go and execute. It's called as early execution. Or early only you want to intimate, you want to cancel it, or you want to extend it. This is on due date, before due date. Last situation is you're coming after due date, and after due date means on the due date, on the settlement date you did not come, but you come later and delayed, late you came, or after due date. It's called as overdue contract, overdue transaction. You want to execute, or you want to cancel, or you want to extend. Okay, now 9 situations are there. Let us try to address it. First thing, on due date execution is very, very simple. That will not discuss it, because as per the contract you execute it. What is there to discuss? Now let's come to extension. Every extension is extension after cancellation. That is, if you want to extend, you cancel first, and every extension will have a fresh contract. If you want to extend for 2 months, take 2 months fresh contract. So extension equals cancellation plus fresh contract. Therefore, extension also we don't discuss much, because extension is just cancellation and then enter into fresh contract depending on whenever you want the new contract to be. So what we have to focus is these 4 scenarios. If you want to cancel on due date, cancel before due date, or execute before due date, or execute after due date. One more important point, after due date, in case of overdue transaction, overdue contract, cancellation is compulsory. So even if you want to execute, you don't have to do it, because first cancellation will happen, then execution will be a separate fresh spot contract. So execution also we will not worry. So what we have to consider is only four situation: cancellation, 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 and early execution. So for cancellation, what you have to do, for early, what you have to do only. So these four contracts are more important, rest are all just an extension. So cancellation, what transaction to be done, and execution, what transaction to be done, we have to understand. So let me just quickly summarize by way of the charges that will be considered. Charges. Hopefully you can see. Yes. Okay. Let me do one thing. Okay. Now charges are three kinds. One is called as exchange difference, and other is called as swap difference, and other is called as interest on outlay. Okay, what is exchange difference? Exchange difference is usually applied for cancellations. Okay, why cancellation will apply? Earlier you entered into one forward buy contract, now you want to cancel it. How do you cancel it? Not by tearing the paper. Earlier you entered into forward buy contract, so today you enter into forward sell contract, or if you are cancelling immediately, spot sell contract. Okay, so cancellation will be either forward opposite or spot opposite. If you are cancelling it earlier, then forward opposite. If you are cancelling on the due date or immediate cancellation, means it is spot opposite. What is opposite? If earlier was buy rate, today will be sell rate. Okay. Now swap difference will come in two situations. Swap difference will come where the transaction is happening either applicable on early execution, or it is applicable for overdue cancellation. So in these two cases, swap difference will be applicable. Swap difference means you are exchanging the spot with future. Spot with future. You are having one spot buy, but I would like to swap with forward sell. So I take out the position in spot market and enter into position in future market and forward market. Okay, that is swap difference. I'll come to it. And interest on outlay means this is also applicable for these two situations only. That is when transactions date is different from due date. This is also applicable for early execution and applicable for overdue cancellation. Okay, so remember these three broad things. Exchange difference is for the purpose of cancellation of the contract. Swap difference is for the purpose of you want to postpone it. You are exchanging your position. You are exchanging your position from the spot market and to the future market or the forward market. You want to exchange. You want to reverse. You want to swap. Swap difference will come. Interest and outlay means cash flow is taking place, which is different from due date to the transaction date. The cash flow effect, not the forward contract effect. The cash flow is different date, different from the due date. So from the date of transaction till that due date, the time gap is there, the time value of money is applicable on interest on outlay. Okay, let's try to figure it out now. Disposal of forward contract on cancellation is very simple. Due date extension, anyway I told you it is a cancelled existing and enter into fresh contract. Cancel means on due date. If previous was forward sell, now will be spot buy. If previous was forward buy, now will be spot sell. That's all. Very simple. And think from either banker perspective or from customer perspective. It's better to think from customer perspective because we are used to it, which means customer will always be in a disadvantaged position. He will sell at a lower rate, buy at a higher rate. Okay, so cancellation on due date, only exchange difference will come. If it's an importer, originally he would have entered into forward buy contract. On cancellation, he will enter into immediate spot sell contract. If he is an exporter, originally he would have entered into forward sell contract, and on cancellation, he will go for spot buy rate. Difference may be profit or loss, will be either passed on to customer or will be received from customers. Give me 1 second. Okay. Now, before due date only, if you are trying to do execution, early execution will come to it. Cancellation, let me do first because it is opposite forward contract, because earlier only you are cancelling it. So it's not opposite spot contract, opposite forward contract. Extension means cancel first, then enter into fresh contract. Okay. Now cancellation before due date means okay, amount to be paid is only exchange difference, original forward rate and opposite forward contract rate only. So if the person is from importer point of view, originally he would have entered into forward buy from customer's point of view. Today he will do opposite, that means sell, not spot sell because he is cancelling earlier, forward sell. And exporter originally forward sell, now it will be forward buy, that will be cancelled. Remember, these two differential amount, profit or loss, is known today but settled only on due date. So this exchange difference is known, calculated earlier, but paid or received only on due date. Okay, now early transaction by bank, this you should be careful. I'll give you format also, but be careful. Now, originally a customer, let's say importer customer, has entered into a transaction with buy. Importer would like to buy from the bank, bank would have sold on due date. Let's say settlement date happens to be 31st of March. But customer comes on 25th of March or customer comes on 28th of February. 1 month earlier, customer say, now only I want it. I cannot wait till 1 month. What bank will say? Can bank say, come after 1 month? That is your due date. Bank has to honor. That is the directive given by government. Why is that? To support export transactions and import transactions. But at the same time, the government also said you honor the commitment earlier as required by the customer, but whatever the charges you get, you please collect from him. So there are two things to be understood. One is swap differential, other is interest on outlay. Exchange difference will not come, because exchange difference will come only when you want to cancel it. But here you are not cancelling it, you are honoring it earlier. Okay, so first transaction, what the customer should do, or the bank, you have to think from bank transaction. This early settlement, early delivery has to be discussed only from bank's point of view. Okay, fine. Now only from bank's point of view. Think from bank point of view. Let's say importer transaction. Earlier, or whatever the contract you thought, let's say importer transaction, you would like to sell it to the customer. But where will bank get the dollar to sell it to customer? Bank to sell it to customer. 1 second. Yeah, bank to sell it to customer, they will get it from cover market. They will get it from cover market and give it to customer. Correct? But now customer is coming earlier. You have to give it to customer. But the cover rate will happen only on due date. So instead of going to the forward cover rate, you come to the spot rate. You buy in the spot transaction and give it to customer to honor customer's commitment. So one spot transaction is happening to fulfill customer commitment. Spot buy and give it to customer. Spot buy and give it to customer. But this cover rate, what was originally planned, now what do you do for that? That has to be executed on due date. That was supposed to be given to customer. Now customer is not there, then where will you give it? You have to sell it in the market. So other way around, spot buy is replaced by or to be replaced by forward sell. Spot buy to fulfill the customer request and forward sell to fulfill the previous cover transactions what you entered. This spot transaction and forward transaction, this is what is called as swap loss or maybe swap profit. That's what is happening. A transaction in the spot market to honor customers commitment, a transaction in the forward market to adjust the cover rate which was originally planned now will be implemented. Okay, now interest and outlay will come due to the cash flow. What is cash flow happening today? Today what is happening? One cash flow today happening is your whatever the original forward contract you entered earlier you honor, and second what is happening is the spot rate which you are doing to fulfill his customer request. So cash flows what is happening is outlay. On that outlay you have to charge the interest. Okay, summary part if I have to give you, swap loss or gain is difference between the spot rate and the forward rate. Interest and outlay is difference between the original forward rate and the spot rate, the same spot rate for the remaining period from the date of transaction till the due date. Parties, if it is importer point of view, swap difference will be for importer transaction you have to buy in the spot market, so spot buy and forward sell. And interest and outlay is between again the spot buy and the original forward sell, original forward rate. Exporter transaction you have to sell in the spot market, therefore it is spot sell and forward buy, spot sell and forward buy. And the interest and outlay, the original forward buy rate and the spot sell rate. Okay, that is your summary of early settlement. If you want me to give a shortcut, this is what you can follow. Yeah, you can follow this shortcut. You write from interbank point of view, what is the transaction with customer, what is the transaction with interbank. What is the transaction with customer? Transaction with interbank. Transaction with customer is the original forward rate, maybe buy. If it is exporter transaction, you will buy from him. Importer transaction, you sell it to him. And opposite cover rate, that is original due date. On early date, where customer makes a request, with the customer, whatever is the forward rate, that only will be used for execution, and whatever is the spot rate, that will be the cover rate. So if this was sell, this also will be sell. Okay, this is for an import transaction, and cover rate will be opposite buy, and this also will be same, which is buy. Then you need to enter into one swap rate. So what will happen? This buy has to be compensated by one more sell, or what is happening with the customer, instead of customer you do it in the spot market. So this will be sell and this will be executed. Okay, and difference between these two, the spot sell and this forward buy, forward sell and spot buy, this is called as the swap difference, and this is your outlay on which you have to calculate interest on outlay. For export transaction, just do the opposite. So have a columnar format like this, you can do it better and easier. Okay, this is early transaction. Now after due date means extension execution has no meaning because cancellation is compulsory. Extension is a fresh extension contract. Execution is also a fresh execution contract. Okay, let's come to FEDI rules applicable for this overdue contracts, which is extension beyond due date, late due date. Foreign Exchange Dealer Association of India, FEDI rule is on the date of cancellation on the due date, customer don't appear, he does not give any intimation also. So effective date of cancellation is date of cancellation when the customer walks in, or 15 days from the due date, whichever is earlier. Usually for exams, you don't worry about this. Date of cancellation, whenever customer walks in, will take it. Transaction by bank, 3 transactions will come. On due date, what bank should do? They have to swap the spot and the forward contract. On cancellation date, collect the charges from customer, and charges payable by customers are 3 kinds. One is swap loss, interest and outlay, exchange difference. I'll explain all these aspects, don't worry. And if any gain in these 2 cases will in the swap loss and interest and outlay will not be transferred to the customer, unlike the previous transactions. So this also should be analyzed only from the bank point of view. Let me give you the shortcut also and explanation also. Okay, now let me tell you the list of transaction done by bank. With customer, you will enter into, let's say, forward sell, and with cover transaction you do forward buy. So with customer you do forward sell, and in the cover transaction you do forward buy. On the due date, forward buy of the cover transactions will happen, but customer sale will not happen. So what bank should do? Instead of selling it to the customer, they have to sell it in the spot market. So additional transaction number 1, they have to sell in the spot market. They are forced to sell in the spot market. Second transaction, if customer comes, the bank should be ready with it, because no cover transactions was there, because they have already executed in the spot market also. So they will have to enter into one more forward buy contract. Spot sell to fulfill the cover transaction, and as a postponement of that cover transaction, forward buy. Spot sell, forward buy, a swap transaction comes into picture. Then on the cancellation date, when customer walks in, first you slap him. Why are you late? Meaning first you have to cancel the contract. So earlier transaction was forward sell with the customer. Now it will be spot buy, so that the contract is cancelled. And then next is because the cash flows are taking place now. One cash flow which is taking place on the due date, on spot, that spot sell what you did, that, and one more cash flow that is taking place today. From the due date till the date of cancellation, that additional cash flow they have put in. What is additional cash flow? The original cover rate transaction is one cash flow, and spot sell one more cash flow. That cash flow difference, interest should be collected from customer. So swap loss to be collected from customer, interest and outlay will be collected from customer, but exchange difference, that profit or loss will be passed on to the customer. Okay, so these are the transactions involved. I'll give you the shortcut also, I'll give you the process also. But if you want more discussion with example, in our channel about 30 to 40 minutes I have discussed and uploaded with the problem, with the example. So you can follow that. Please search for overdue contract in our channel. You get the video, you can watch it in detail along with example with numericals. So the summary chart I'm giving it to you. Exchange difference is the difference between original forward rate and spot cancellation on the cancellation date. Swap differential is the spot rate on due date and opposite forward rate on due date. Interest and outlay for the cash flows. What are the cash flows that have been taking place? Cash flow on the due date, which is cover rate is one and spot rate is another. The difference between those two multiplied by the rate of interest for the period starting from the date of due date till the date of cancellation. Okay, and for importer exporter, I've given you the list. You can read through that, or you can take a picture of this. And from exam point of view, I would say import is only important. Exporter, they were not asking. Say 5-6 times, 3-4 times they've asked this question in exam. All the 3 times, 4 times they've asked only about importer transaction. Shortcut point, you can follow this format. With the customer, what do? For import transaction, forward sell. In the interbank, forward buy. And on due date, you have to execute, and so you do forward buy, but you should do spot sell. Then on due date, you enter into as a substitution forward buy. On cancellation date, you cancel. Easy to remember, my dear friends. Sell, buy, and sell opposite buy. Sell, buy, buy. SB, SBB, SB, SBB, SB, SBB. That's all. The difference between the difference between the forward buy, spot sell is called as the that is the cash flows taking place, so it is interest and outlay. A spot sell and forward buy, that is the swap loss, and beginning to end is exchange difference. So the 3 charges what bank would collect is given in front of you. Please follow this shortcut. For numerical example, please search for the overdue contract shortcut in our channel. You get the video with the example, you can go through that. Fine. Okay, now let's come to currency option. Okay, so now let's come to currency options. Okay, this might be confusing for certain people. Please follow the chart what I give you carefully. Any currency hedging problem, option hedging problem, even future hedging problem, you can solve it easily. Okay, first of all, what is currency option? All features of our options discussion holds good. Call option, put option, strike price, underlying asset, holder, writer, call option holder, call option writer, all these things, intrinsic value, payoff, everything applicable here also. Option contract where underlying asset is a currency. Regular features, option premium, holder, writer, strike price, expiry date, everything applies. Okay, type. Right to buy the currency is called as the call option. Right to sell is called as the put option. Special feature is this. When you have right to buy, let's say dollars, that means rupee you have to pay. Pay means sell. Pay means sell. Therefore, call option on foreign currency has got implied put option on local currency. Similarly, put option on foreign currency has got implied call option on local currency. This can be confusing for certain people. Anyway, I have to tell you, so I told you. But while hedging situations, I don't use this much. I'll give you a better method, which I'm sharing it to you now. Okay, keep that in mind. For option hedging only for a holder. 3 steps are there. First step, identifying the type of option, whether call or put. Quotation, they will give you 1 unit equal to so many units. For example, they say 1 USD equals 70 rupees, or 1 GBP equals 1.5 USD. Okay, in that case, whatever is the left hand side is the underlying asset. Only when you identify the underlying asset, then only you can choose the option correctly. So whatever the left hand side, that becomes underlying asset. And sometimes they say lot size is 1 lakh rupees, or they might say lot size is $1,000, like that. Whatever lot size they give, that is also underlying asset. That way also you can identify. Next, think from underlying asset point of view, whether it is purchased or sold. If underlying asset is purchased, call option. If underlying asset is sold, then put option. Okay, for example, if underlying asset is dollars, then it is about an importer in, let's say, UK. What is an importer UK does importer in the market, not in the transaction with the supplier. What he needs, UK person needs dollars, he will give pounds. He will get dollars so that he can make the payment to his supplier. So UK person, importer needs dollars. And what is underlying? Dollars. Therefore, he needs dollars and underlying asset is dollars. Therefore, it is purchasing call option. If it was not a UK person, if it was a US person and he is importer, and let's say he has to pay in GBP terms, that means US person needs to purchase GBP and pay US dollar, purchase GBP so that he can make the payment to his supplier. To purchase GBP, he has to pay US dollar. To purchase GBP, he has to pay US dollar, and underlying asset is dollars. Dollar is paying, underlying asset is dollars. Dollar is going out. Going out means put option. So depending on the underlying asset, if it is coming in or going out, you can choose whether it is call option or put option. Step 2, number of contracts. If underlying asset and invoice amounts are same, meaning underlying asset is dollar and invoice amount is also in dollars. That means they say $1 equals to, let's say, 10 Singapore dollars. Like that they give. And invoice amount also is $1,000. Like that. If same, then number of contracts is invoice amount by lot size. Invoice is also in dollars, lot size also in dollars, no problem. Now coming to, if underlying asset and invoice amounts are different, then what should you do? Then you should convert invoice amount divided by strike price. This will convert into the currency required. Then you can divide by lot size. Okay, this second step is very important. Many people don't follow the second step. Third step, computing the cash flows. On expiry date, you have to do like this: number of contracts what you enter multiplied by the lot size, like the way you used to calculate earlier, into strike price. Or if option is not exercised, you might choose market price, because sometimes probability also will be given. Or on the expiry date, if you know the expected market price happens to be this, that number you can take. Okay, number of contracts into lot size into the strike price. If any fraction is there, you can enter into a forward contract. At inception, okay, so at inception, you have to pay premium. How do you calculate premium? Same formula, number of contracts, lot size. Instead of multiplying the strike price, you use the premium. Number of contracts into lot size into premium. If premium is foreign currency, then convert at spot buy rate. Okay, this one point I have to give you a small example before we go further on that. Okay, so please understand. This will apply, this point will apply in the second case, whenever the underlying asset and invoice amounts are different. Okay, I'll give an example for the second part alone. Hold on to that extent. Let us complete the chart once. Interest on premium may be considered, because institute sometimes consider, sometimes not consider it. That is left to your choice. So on expiry date, strike price, lot size into number of contract and strike price, and at inception, number of contract into lot size into premium. And if the answer is foreign currency, then you have to buy using the spot buy rate. Let me give an example that before we go to the futures element. Okay, so let's say we are talking about an importer in UK, and invoice amount is, let's say, $10,000, and lot size is, let's say, 200 pounds, and strike price is £1 equals $2, and premium is £1 equals, let's say, 0.50 or $0.25. let's say $0.50. What is that? Okay, first step, you have to identify what type of option is an importer in UK. What he's going to do, importer in UK means he needs to pay it in dollars. So he has to pay in dollars, and he has to pay in dollars means he has to purchase dollars, right? He has to pay dollars means he has to purchase in the spot market, in the currency market. So buy dollars and pay in pounds. Buy dollars and pay in pounds. Because of the pounds is underlying asset here, which is left hand side or lot size, he is paying in pounds. Pounds is going out, underlying asset is sold, so relevant option is put option. Okay, next, number of contracts. Number of contracts. For that, you should look for the lot size, the invoice amount and the underlying asset. Invoice amount is $10,000 and the lot size is 200 pounds. Not in same currency, you have to convert it. So for that, I told you invoice amount $10,000 divided by strike price, which is 1 pound equal to $2, whole divided by the lot size, which is 200 pounds. So $10,000 by $2 means you get 5,000, and 5,000 divided by 200, I think you get 25. Yeah, 25 contracts. That is the number of contracts. Now coming to premium portion. Premium is what I'm very concerned about. What is the formula I told you? Lot size into the number of contracts into the premium, whatever the premium portion. Lot size is 200 pounds. Number of contracts 25. Premium is 1 pound equals $0.5. So $0.5 you multiply. So answer you get 200 into 25 into 0.5. 200 into 25 into 0.5. You get 2,500. This is the important point. This 2,500, is it pounds or dollars? It is dollars. Whenever this situation comes, invoice amount is different, lot size is different, you will get in opposite currency. That is one way of understanding. Other way of understanding is, look at the currency. Whenever the currency is applied, currency rate, conversion rate is applied. Whenever you apply conversion rate, you always get the other currency. Like $1 is 50 rupees. $5,000 is how much? 50,000 rupees. So $1,000 into 50 rupees. So whenever you apply the conversion rate, the result is another currency. Whenever you apply the conversion rate, the result is another currency. Therefore, in this case, 200 pounds you have, and premium you treat like a conversion rate. Premium you treat like a conversion rate. Strike price also you treat like a conversion rate. So pounds, when you apply the conversion rate, the result is dollars. So when the premium comes in foreign currency, this should be purchased from the market at the whatever the rate it is, spot buy rate. That is the premium to be paid by the importer in UK, which will be expressed in pounds. Okay, so keep that point in mind. The chart will tell you all of these things. I've given an example also for you to understand. Okay, let's now go for next one. Currency futures, future hedging. Same 3 steps will apply. This question in the exam, I don't know how many times they have asked. That means so many times students are not solving in examination. So identify the type of future. Same step. Lot size method or left hand side method. 1 unit, the futures, 1 unit equal to so many units. Left hand side is the underlying asset. If you are purchasing the underlying asset, then the position is future buy. If you are selling the underlying asset, then it is future sell. Like they are called put, here future buy, future sold, future sell. At inception, number of contracts. Same thing. If invoice amount and the lot size is same, then invoice amount by lot size. If invoice amount and lot size are different, then invoice amount divided by the future rate divided by lot size. Same steps you get. One extra thing will come here, initial margin. Initial margin is always per contract basis. So number of contracts multiplied by margin per contract. This will give you initial margin. But initial margin is like a deposit. So don't consider initial margin as your cash flow. Not right. Only the opportunity cost will be your cash flow. I'll come to that. Now cash flow at expiry, easy to remember, SFM. Spot market, money market and future market. Spot market, future market, money market. SFM. In spot market what do you do? In future market what do you do? In money market what do you do? In spot market, in future market, in money market. In spot market, invoice amount into spot rate. In future market, square off will happen. Earlier if you do future buy, then now future sell. Earlier if you did future sell, now it is future buy. Then multiplied by the lot size, multiplied by the number of contracts. That lot size and number of contracts is always multiplied. In options also, for premium also, for strike price also, for square off also. And if this results in foreign currency, that whenever this invoice amount and lot size are different, this situation will come, just like what I explained now for options. Here also it will happen. And this square off also treat like a conversion rate. So when you multiply by the conversion rate, when you multiply it by the premium, when you multiply it by the strike price, when you multiply it by the square of profit, the resultant will be another currency. So if I have lot size of $4,72,000 multiplied by profit, the result is dollars, not rupees. Rupees multiplied by the profit in square of. That profit in square of treat like a exchange rate. I repeat, this square of profit treat like an exchange rate, so that when you multiply you get the another currency. And if that is foreign currency, then please convert it at spot rate, maybe sell rate, maybe buy rate, depending on profit or loss. If this is profit, then spot sell rate on expiry, not today, on expiry. And if it is loss, then spot buy rate. Money market, whatever is the margin money you calculated, multiplied by the rate of interest and also number of months. Rate of interest is always per annum. So rate of interest and number of months gives you the margin money. Overall cumulative value, that will be your net cash flow, either for exporter or for importer. Okay, so those are the various hedging technique. Okay. One more small theory part would apply. Nostro account, Vostro account, Loro account. Nostro account means our account with you. Meaning, if State Bank of India having a US dollar account with US, our account SBI with your account Citibank US dollars, that is Nostro. Vostro reverse. If Citibank comes to India, open an account with SBI in rupee, that is Vostro. So in fact, Nostro, Vostro are two sides of same coin. Nostro means we are having a foreign currency, and for them there is somebody else coming to them. So Nostro, Vostro are two sides of same coin. Loro means their account with them. For example, if you want to have an account in Pakistan, you can't have an account. So what do? You open an account with US and US open an account in Pakistan. So one intermediary route is there, one cross rate is there, that is called as Loro transaction. SBI having a account in Citibank through HSBC, that is intermediary bank, that's what is called as Loro account. So one more kind of problem they will ask you, like Nostro account and exchange position. Okay, let me prepare a simple chart for that purpose. Exchange position or exchange contracts. So records maintained. Two types of records you maintain. One is exchange position, or one is nostro accounts, that is like cash or bank passbook, and other is exchange position, which is a combination of the forward contracts plus the cash transactions. Instead of bank account, let's say cash. So basically what will happen, transactions in cash markets will affect both, whereas transaction in forward market will affect exchange position only. So in nostro account, what are the things you do? Like debit, credit, balance. And for exchange position, what do? You will do like forward buy contract, forward sell contract, net closing balance. So if you deposit money into the bank, that is into your nostro account, so you write it in credit. That means basically you have money with you, so you write under buy, forward buy contract, and closing will be buy. If you if you enter into forward contract, it comes only in forward buy and it comes in closing. If you cancel the forward contract, it comes in forward sell, like a buy purchase returns, and net closing will come. It will not affect the nostro cash account. Okay, so these are the aspects that to be considered in foreign exchange chapter. One point I have not considered, foreign currency swap. I will address it when I am doing interest rate management. So in that chapter, interest rate swap also will consider, and currency swap also will consider. Okay, so this is the end of foreign exchange chapter. Okay, so moving on, next chapter, international financial management. This chapter is more about theoretical aspects, and one particular area is there, that is international capital budgeting. Let us address that. Theoretically, difference between FDI and FII. FDI is direct investment, FPI is foreign portfolio investment. So what is the basic difference? When a foreign or a foreigner come to India and start a business in India, that is called as FDI. FPI means like you and me trade the shares of a company in stock exchange, like that the foreign companies also just trade the shares. Recently what happened, Facebook has purchased 9.99% in Reliance Jio company, right? So that is an example of foreign direct investment. They directly purchase the shares of the company, where if they just trade the shares in the stock exchange, then that becomes foreign portfolio investment. So moreover, you can understand, foreign direct investment is for the purpose of managing the business. It is a primary market. Foreign portfolio investment is with the objective of capital appreciation. Therefore, it is more like a buy and sell whenever the opportunity arises. It is a case of secondary market. So FDI is more productive assets, whereas FPI is more like a financial assets, because management is not involved. And FDI, ownership right and management right is there. Their objective is itself is to control the business, whereas FPI, ownership right is there. They don't participate in day-to-day operations. So FDI do participate in decision making process. FPI are not really taking part in any decision making process. So FDI is for long-term investment purpose. FPI is only for capital appreciation, short-term trading purpose. Okay, let's go further. One more popular theory question, ADRs or GDRs, American Depository Receipts, Global Depository Receipts. How this functions? Typical example if I have to give, the shares of Infosys are being traded in USA. How is it possible? Actually, shares of Infosys are not traded. ADRs of Infosys are traded in USA. So how does it really happen? The shares of Infosys of a company are clubbed together, called as depository receipts. Thereby, the rupee denominated shares of Infosys is converted into the US dollar denominated depositories, and such depositories receipts are traded in stock exchange. I'll give an example. Suppose Infosys is the company, they issue shares to a custodian, we will say Indian custodian, who has the who is the custodian of shares, who is actually recipient of shares, Indian custodian. In the Infosys example, it's actually SBI. What they do, they are the holder of the shares, they will issue to another bank in US, let's say Citibank in US. While converting, what they do, they will convert into depository receipts, like they say uh, uh, one depository receipts equal to 3 shares, and let's say one share is 1,000 rupees, and therefore 3 shares becomes 3,000 rupees, and exchange rate, let's say 60 rupees. So if you divide by 60 rupees, what you get is 50. So one depository receipts will be $50, and that will be listed in US stock exchange, let's say in Nasdaq, and US people can trade the depository receipts, which is denominated in dollars, but the underlying shares being related to Infosys. Thereby, American people can trade in the shares of the Infosys without actually coming into India, or without fulfilling any formalities as such. So the shares are not really traded, depository receipts are actually traded, and depository receipts are nothing but the underlying instrument being the shares of a non-American company but traded in America. If it is traded in other parts of the world for the but in dollar terms only, but traded outside US, is called as global depository receipts. So these depository receipts provides an opportunity for company in India to raise the finance outside India. So these are the basic functionalities. Some theory parts are there, you can go through that. Okay, now let's go further. Okay, so moving further, there are two types of problem that may be asked in case of capital budgeting, or in case of the various types of source of finance that you could get, or two types of problems, I would say, capital budgeting. Foreign company coming into India is one variety, or Indian company going outside India is another variety. So foreign company coming into India will be like any other capital budgeting problem, and you will have to compute NPV, and if NPV is more than 0, you say that the project should be accepted. In fact, the previous attempt, they had this question, so in my expectation this question is more important, and in fact this question, the second variety, is only having more complicated adjustments also. Indian company going outside India, let's focus on that. Indian company going outside India. Company going outside India. They are going out. Just give me 1 second. Okay. Okay, there are two types of questions that you can varieties in which you can solve. First variety is the cash flows which are there in the foreign country are converted into Indian rupee every year. How do you compute the foreign currency into Indian currency every year? Using forward rates. But you will not find forward rates for every year. Therefore, you make use of theoretical forward rate. Theoretical forward rate means using IRPT theorem, interest rate parity theorem, using the Indian inflation or interest rate and the foreign inflation or interest rate. Using those two, they will convert the foreign currency into Indian currency using the theoretical forward rates. Then once you convert the cash flow into rupee terms, discount it using the Indian expected required rate of return, Indian cost of capital, you get the NPV in rupee terms. If NPV is more than 0, project should be accepted. If not, project should not be accepted. Most probably, I would recommend this method while solving problems. The second one is cash flow in the foreign currency only you continue. That is every year cash flow, keep it in foreign currency, discount it in foreign currency, and the result is NPV you get in today terms, then you convert into rupee by multiplying spot rate. So ultimately you get NPV. In both the cases NPV should match. Small difference would be there, that is because of the round off issues. But one important adjustment that you need to do is the discounting rate. You cannot use the same discounting rate. For example, if Indian expects 12% rate of returns, in the first method you would have used cost of capital 12%. That same rate you cannot use it in foreign country because expected rate of return will differ from currency to currency. In the first method, we converted the currency, foreign currency into rupee terms. So I could have used the required rate of return which is applicable for Indian rupee terms. But in the second alternative, I'm keeping it in the foreign currency term itself about the cash flows. So discounting rate cannot be that an Indian would expect. The discounting rate need to be adjusted discounting rate. What is the discounted rate? How do you calculate that? Now we'll come to that. Take an example. FD rates in India is, let's say, 7%. FD rates in US is, let's say, 3%. Expectations are different in different currencies. Why is that? That is because of the risk profile of the two countries. We'll not talk about it. They are about credit riskness, credit worthiness, credit ratings, sovereign ratings. We'll not talk about it. But definitely you have to accept there is a difference in the interest rates. Inflation rates are also different. So if the project in India requires, let's say, in India, a project in India, let's say they require a return of 12%. Why they require more than FD rates? Because projects, business is more riskier, and more riskier means more return. So you expect the excess of, let's say, 5%. What do you call that? Excess over risk-free rate? Risk premium. So if I take 7 as the base rate, risk premium is 5, so total expected return is 12%. In the similar lines, US also, if you apply the same 5%, 3% is the risk-free rate, 5% becomes the premium, so expected return is 8%. So if you're discounting the cash flow in dollars, your discounting rate should be 8%. In different currencies, the discounting rate will change because of this reason. So logically, mathematically, your calculation is right, but not financially, because we follow multiplicative model. I cannot add just like that 3 plus 5 as 8. We have to follow multiplicative model. That's why you have this formula. Risk adjusted rate on project equals 1 plus interest rates in foreign, 1 plus interest rates in local into 1 plus required rate of return of the project minus 1. Just like the way what we followed in, if you remember IRPT theorem, this portion is exactly reverse of that. You can easily remember that. So in our example, 12% is the required rate of return. So risk adjusted rate will be, foreign will be 3%, 1 plus 0.03. Denominator Indian 7%, 1 plus 0.07. And required rate of return is 12% in India. So 1 plus 0.03 into 1 plus 0.12 divided by 1 plus 0.07 minus 1. That will give you approximately 7.81, which is nothing but approximately 8%. So if you are keeping the cash flows in the foreign currency as it is, then you have to use adjusted discounting rate, risk adjusted discounting rate, exchange risk adjusted discounting rate. That's a better term. Exchange risk adjusted discounting rate. And how do you calculate it? Remember the IRPT theorem and just reverse it. 1 plus local by 1 plus foreign. That was IRPT. Reverse it. 1 plus foreign by 1 plus local multiplied by 1 plus required rate of return. Then to get the percentage, do just minus 1. So using this method, you will get the adjusted discounting rate. You discount the cash flows. Using this rate, you get NPV in foreign currency terms. Then using the spot rate, convert it, you get the NPV in rupee terms. So both the methods will give you NPV in rupee terms, but I would not recommend this method. Choose the first method, where every year foreign cash flow is converted into Indian cash flow using respective years conversion rates, which are computed using the IRPT theorem. Okay. Now that is about the international financial management. Okay, so next chapter is interest rate management. Recently, lot of questions have been asked from this chapter, and many students have the tendency to ignore this. Please don't do that. Let's begin. Interest rate management. What is interest rate risk? Interest rate risk means the fluctuations in interest rates. Interest rates keep fluctuating. RBI comes up with the move. COVID-19 happens. RBI reduces repo rate. Interest rates in general is reduced. FD rates are reduced. Loan rates are reduced. Housing loan rates are reduced. So many types of interest rates. It may be applicable to a present borrower, or it might be applicable to a prospective borrowers. You are looking to borrow after 6 months. Today itself you need to manage, because by 6 months comes, interest rate would have been increased. Not only for borrowers, even for lenders, bankers, non-banking financial companies, investment companies, loan companies who lend at an interest rate. So fluctuations in interest rates means their value of assets also will be fluctuated. Their cash flow due to interest also is fluctuated. So these are all interest rate related fluctuations, interest rate risk. So in general, borrower is having the risk of increase in the interest rates, and investor will have the risk of reduction in the interest rates. Interest rate management means you might also have to understand types of interest rates. Some person who is having a fixed rate of interest would like to convert into floating rate of interest, or a person having floating rate of interest might think of converting it to fixed rate of interest. Or some people want to trade, speculate on interest rate. Based on the changes in the interest rate movements, they want to make profits. Such kind of people also there. So the instruments what we are going to discuss in this chapters are forward rate agreements, interest rate futures, interest rate options, and very importantly, interest rate swaps. Okay, so these are the four broad areas that we need to address. Okay. Okay. Before we going further, we should understand this one important aspect called as interbank rate, or we popularly call it as LIBOR, or Indian context we call it as MIBOR. Interbank of rates. Various explanation can be given. but I'll just tell you what is required for solving problems. These are market rates. Just like we say market price for shares, market rates for interest rates are these LIBOR, MIBOR, and they are used as reference rates for floating rate type of loans, variable interest rate loans, because when the interest rate is fluctuating, on a settlement date you need one rate. How do you know which rate? The rate is this LIBOR, MIBOR, used as a reference rate. So market rates in the interest rate management is called as LIBOR or MIBOR. Okay. So techniques, we are going to learn about forward rate agreement, interest rate, future option swaps. I just told you. Let's concentrate on that one by one. First one is forward rate agreement. It is the agreement entered today for borrowing at a later date. It is important. You are not borrowing today. You are planning to borrow at a later date. But at what rate you are going to take the borrowing is already determined today. So quotations in forward rate, you have to understand A cross B. A reflect the borrowing date from today, borrowing date called as fixing date, and B is repayment date from today. Therefore, B minus A is your actual borrowing term. For example, if I write 3M cross 9M, that means after 3 months I will borrow from today, and after 9 months from today I am going to repay. Effectively, my borrowing is for 6 months. Okay, that is the quotation you need to understand. Now settlement may be on delivery basis. What do you mean by delivery basis? If I say 3 cross 9 is 5%, that means after 3 months I will borrow whatever is the amount of loan agreed, let's say 10 crores. I will borrow 10 crores after 3 months, and after 9 months, that is 6 months subsequently, I will repay 10 crores along with the rate of interest as agreed 5%. That is called as settlement on delivery basis. Settlement on net basis means I compare it with the market. Suppose market rate, reference rate, LIBOR happens to be 6%. That is 5% is what I have committed, but market people are 6%. So because of entering into this agreement, I saved 1%. So 1% on 10 crore will be received by me net amount, net basis. And if this net amount you want it immediately at the end of 3rd month, then this should be discounted by the term for 3 months. So 1 plus R into 3 by 12. This is the amount I will get on the settlement at the end of 3rd month itself, because if I don't do this, then the difference I will get only after 6 months later at the end of 9th month. But if I want at the end of 3rd month itself, then you should do discounting of this. And forward rate agreement can be used for speculation. So if I don't have any existing loan, I only enter into forward rate agreement based on the fluctuations in the interest rates in LIBOR. I may get a positive amount instead of 6%. If it's down to 4%, that means I lost it. I'll have a loss. That is also fine. If you are confused about profit or loss, this formula you can remember: reference rate RR minus FR. Reference rate minus forward rate. If the answer is positive, you save. If the answer is negative, you lose. Simple. Speculation is only entering into forward rate agreement. Hedging means you take a loan as well as you enter into forward rate agreement. And arbitrage means you borrow and you invest and you enter into forward rate agreement. Thereby you create a situation of arbitrage. We'll come to that also. And if settlement is on net basis, this formula you remember, on settlement on net basis in forward rate agreement, notional principal, the amount of loan committed, multiplied by, I told you just now, RR minus FR, reference rate minus the forward rate, into term of the loan. If I want to settle on the fixing date itself, then I will discount it, 1 plus reference rate, the rate of interest prevailing on that date, into the term of the loan. If term of the loan 3 months, I'll do 3 by 12. If it is 6 months, I'll do 6 by 12. Thereby, I get the amount of uh, amount of profit or loss that is received on forward rate agreement. Sometimes they say how effectively hedging is done. In that case, you compute two things. One, interest in loan using reference rate, and second, the profit or loss in forward rate agreement. Together, you add both of them, that is your effective interest paid after doing hedging in forward rate agreement. Okay, you have to compute these two things. Anyway, settlement can be on delivery net base, I told you. Examples also I told you, I don't have to repeat it. Okay, before we go to future, let me give an example of this one. What is the arbitrage, that we need to understand how arbitrage works. Let me give an example how arbitrage works. That is very important. Suppose LIBOR for 2 years is 8%, of course, per annum, and LIBOR for 3 year is 9% per annum. Then what is the forward rate? Can you tell me? Do you remember? Don't say 3 year minus 2 year is 1 year and 9 minus 8 is 1. No, not like that. Forward rate for third year is depending on how much cumulatively you get for 2 years, how much cumulatively you get for 3 years, and then how much you get for between 2 and 3 years. Meaning 2 into 8 you get for 2 years 16%, 9 into 3 for 3 year you get 27%, effectively you got 11%. That 11% is called as the implicit forward rate at 11%. But if actual forward rate given by bank, let's say by bank, quoted by bank for 2 cross 3, meaning after 2 year for third year, that's what we are also computing for, happens to be 12%. That means implicit rate is less, actual forward rate is more, so you have to borrow using implicit rate and deposit using actual forward rate. If it was 9%, then you borrow at 9% and deposit at 11%. Sometimes actual forward rate will give you in a quotation, they'll give you 10 to 12%, meaning 10% is for the purpose of deposit and 12% is for the purpose of borrowing. In such case, how do you do? In such case, the arbitrage exists if the implicit rate is below the rate quoted by bank or above the rate quoted by bank. But in this example, 11% is in between the rate quoted by bank, so arbitrage opportunity don't exist. Step 1, compute implicit rate forward rate. Step 2, compare it with the actual forward rate by bank. If the implicit rate is in between the rate quoted by bank, then arbitrage opportunity don't exist. Else you borrow at a lower rate and deposit at a higher rate, as the case may be. Okay, so this is the discussion about forward rate agreement. Speculation I told you, hedging I told you, arbitrage also I told you. Okay, I can only discuss about the summary part. I can't go to the in details of problems. This is only a revision class. Okay, now coming to interest rate futures. Interest rate futures, IRF, has got all the features of futures contract in derivatives. What are those? We understood. Futures are a contract entered today for settlement at a later date. The date of settlement is decided today, and the rate at which it is going to be settled is also decided today, predetermined. And standard feature for a product traded in stock exchange, they are lot size will be there, standard expiry date will be there, and then you will have a net settlement basis, margin money will be there. So those things are there here also. And one extra element is interest rate futures are having underlying asset as interest rates. So these are the derivative where underlying asset is the rate of interest. But one point to be kept in mind, For shares, I will tell I buy shares at 80 rupees, I sell shares at 85 rupees, so I made a profit of 5 rupees. You can tell like that. But in case of futures, interest rates, I can't tell I buy it at 8%, I sell it at 9%. Does not sound nice. So the interest rate futures will convert the rate of interest into bond price by 100 minus R. So standard features are applicable and special feature is the settlement amount is sale price minus purchase price is fine. Lot size you multiply. The term of the contract is multiplied. And also the pricing is expressed as a bond price 100 minus rate of interest. For example, I buy today and I sell tomorrow, one day later. When I buy, interest rate is, let's say, 8%, and when I sold, interest rate became 9%. Okay, now I cannot say I'll buy it at 8%, sold at 9%. I will not tell it. I'll convert it to bond price. So bond price is 100 minus 8, which is equal to 92, and 100 minus 9, which is equal to 91. Since I'm selling at a lower price, I got a loss. How much loss? 92 minus 91, loss of 1 rupee. Remember, it's not 1 rupee loss, it's 1% loss. How do you convert the percentage into amount of rupees? You multiply it by the lot size, and not only the lot size, this percentage interest. What is the underlying asset? All rate of interest is expressed in percentage per annum terms. 3 months interest, percentage per annum. 6 months interest, percentage per annum. 5-year interest, percentage per annum. Right? So whatever the term for which this interest belongs to, that you have to multiply. For example, if it is 6 months interest rate, so 6 by 12. So you should do difference between the rate of interest, sale price minus purchase price in percentage terms, into lot size and multiplied by term of the contract. And for hedging purposes, hedging purpose, mostly it is for the purpose of borrower. So I'll tell you from borrower point of view itself. So try to understand the impact, then you will be able to understand the hedging also. I told you the prices are expressed as 100 minus rate of interest. If rate of interest increase, what will happen? The bond price decrease. The example I gave you now, it was 8 rupee, then it became 9 rupee. So 100 minus 8, 92, and 100 minus 9, 91. So when interest rate increase, bond price decrease. And decrease in interest rates means increase in the bond price. So for hedging purpose, if you think from borrower perspective, tell me, is he worried about increase in the interest rates, or is he worried about falling in the interest rates? A borrower is worried about increase in the interest rates. So what will happen to bond price? When the interest rate increase, just now I told, bond price will reduce. So in the future, bond price will reduce. Now you want to make a profit out of that situation. How can you make a profit when the interest rate falls down? How can you make profit when the bond price falls down? I'm sorry, not interest rate falling down, bond price falling down, because increase in the interest rates means falling in the bond price. How can I make use of the situation where bond price, interest rate futures are falling down, falling. I make benefit by taking short position. So risk of interest rate increase, bond price reduction. So short position is taken on IRF. Okay. So investor means opposite, they take a long position. So but normally we only go for short position because borrower is what we are worried about. So if they ask you what is the effective interest cost using IRF, one, you compute interest at whatever the reference rate prevailing on that date. Second, you have to compute the interest or the profit or loss in IRF. How do you calculate IRF? Whatever the future sell rate you did at the beginning, minus future buy rate at the time of square of divided by 100, its percentage, multiplied by the notional principal, that is lot size, multiplied by lot size, and multiplied by whatever is the term of the contract. That is your effective amount of interest paid in the interest rate futures. One more point to be kept in mind, they will give you loan amounts and they will give you lot size. So using this, you have to compute the number of contracts. But sometimes what happens, you know, loan amount divided by lot size will tell you number of contracts. But sometimes what happens, the loan term may be 6 months, but interest rate future may be 3 months, which are not matching. In such case, you have to write this formula for number of contracts. So number of contracts in IRF is calculated by the loan amounts divided by lot size, not just multiplied by the term required divided by term in IRF. For example, if term required is 6 months and IRF is 3 months, basically you will get double the contracts because you require to protect interest for a period of 6 months. But the interest rate futures protects interest only for 3 months. Then what you should do? You should double the contract. So 3 months, one future contract, 3 months, one more future contract, thereby 6 months future contract is achieved. So that is your interest rate futures. Okay, so now moving on to next most critical aspects of interest rate management, which I'm expecting the most in this particular attempt, that is interest rate swaps. What is interest rate swaps? It is a mutual lending contract. One person is called as the fixed rate payer, other person is called as the floating rate payer, and differential amount is settled on net basis. Obviously, the purposes can be speculation, hedging, and arbitrage. Speculation, I will give an example. Suppose there is a contract of swap between A and B where A pays fixed rate, let's say 8%, and B pays to A floating rate of, we don't know, floating rate, okay? And after 1 year, the reference rate, LIBOR, let's say, happens to be 10%. Now, who has to pay whom? If you observe, A has to pay B 8%, B has to pay A 10%. Effectively, A will receive 2%, and for B, there is a loss of 2%. That's what is speculation. A went for fixed rate, who was expecting the interest rates to increase. So he wanted to protect it, he went for fixed rate. Whereas B was expecting interest rates to fall down, so he went for floating rate. But what happened? Interest rate became 10%. That means A's expectation became true and B's expectation did not become true. A is enjoying profit, B is enjoying loss, not enjoying loss, suffering loss. So when your expectation comes true, you make a profit, else you make a loss. This is a clear example of speculation. So in the interest rate swap agreement, in fact in general swap agreement, one person will pay fixed rate payment and receive floating rate. So this type is called as pay fixed, receive floating. This is called as plain vanilla swap. Other swaps are also there, like currency swap, pay USD rate, receive GBP rate, or pay equity rate, receive fixed income rate. So like that, many swaps are there, but typical swaps are pay fixed rate, receive floating rate, or vice versa. So two players will be there, fixed rate payer and floating rate payer. When the interest rate increase, fixed rate payer enjoys gain. When the interest rate decrease, floating rate payer enjoys gain. And this contract maybe for 3 years, 5 years, like that. And this may be LIBOR of 6 months, 12 months, 6 months interest rate, 12 months interest rate, etc. For example, if the contract is valid for 5 years and LIBOR is applicable for 6 months. So actually 10 settlements will be there. At the end of every 6 months, a settlement happens. How long this will happen? Over a period of 5 years. So every year 2 settlements means there will be 10 settlements in a contract of 5 years. That is how you use it for speculation. If interest rate rises, the fixed rate payer will enjoy gain. If interest rate comes down, floating rate payer enjoys. Hedging can be done. How hedging can be done? Fixed rate payer can convert it to floating rate, or a floating rate can be converted into fixed rate, vice versa. Or it can also be used for arbitrage through the concept of relative advantage in risk premium, where swapping gain is computed and swapping agreements are also done and loan from bank is also done. I will give an example. But before we go to arbitrage, let's understand about the concept of hedging using interest rate swaps. Okay, suppose let's say A Limited is presently paying LIBOR. That means presently paying floating rate. But he wants to convert. Their objective is convert floating rate into fixed rate, or vice versa also can happen if you are presently paying fixed rate. So what will you do? You write simple chart. A Limited presently paying LIBOR and he wants to enter into a swap now. Swap means what? You'll receive something maybe from a bank or maybe dealer and you will have to pay something. Always remember, swap means exchanging. You have to give as well as you have to receive. Only 2 types of swap applicable. Pay fixed rate, receive floating rate, or pay floating rate, receive fixed rate. Which is applicable here? I'll give you one simple technique. Follow it. You will never do mistake. Simple technique. Focus. Simple technique. Whatever you are presently paying, you receive in swap. Did you hear me right? Did you heard me right? Whatever you are paying now, receive in swap. So that whatever is your present situation is nullified. Presently you are paying floating rate. So you receive floating rate. Let's say receive LIBOR. Let's say the term is LIBOR. You are paying LIBOR plus 0.1. Let's say LIBOR plus 0.1. You receive LIBOR. That's the term with the bank, and you pay fixed rate. Let's say 8%. Simple technique. I repeat once more. Whatever you are paying at present, receive from swap. So that whatever you pay and you receive, it will be netted off. Your position will be now nullified. So you are paying floating rate, receive floating rate, that is cleaned up, and remaining you pay fixed rate. Effectively what happens? LIBOR you receive, LIBOR you pay, that is cancelled. You are paying 0.1 here, you are paying 0.8 here. Effectively you are paying 8.1%. Your objective of paying fixed rate is achieved. Okay, this is hedging using interest rate swap. Next most common thing is the arbitrage gain in interest rate swap. Okay, what I just explained, converting fixed rate into floating rate, can also be used for currency swaps, converting US dollar into GBP loan or GBP loan into US dollar loan and vice versa and so on. Okay, next. This is the most important aspect. Many people do mistake. Arbitrage in interest rate swap. 3 steps. Remember clearly. I'll give an example. Then we'll look at this step once more. First, you compute the swap gain. Then you share it among the parties also. Compute relative advantage. Identify the person with whom relative advantage is there. Then you identify the interest rates. Let me give an example. Let's say two banks are there, A Limited and B Limited. They quote a loan from a bank. A bank quotes fixed rate loan and floating rate loan. Fixed rate loan quoted by A Limited, for A Limited is 8%, but for B Limited it is 9%. Why they are charging more? Because B Limited is having more risk, so they'll charge more. So floating rate, here they charge LIBOR, let's say plus 0.5, and here they charge LIBOR plus, let's say, 0.7. So you see, fixed rate is also high for B, floating rate is also high for B. So A is having lower fixed rate and A is having lower floating rate. So A is called as absolute advantage. But we don't look at absolute advantage. Look at this. How much B is charged more higher? Let's say risk premium charged by the bank for B Limited is 1%. But in floating rate, how much? LIBOR cancelled, extra is only 0.2%. You see, bank is not charging equal risk premium. That is where arbitrage opportunity exists. And difference between these two is called as swapping gain. In this example, 0.8% is the swapping gain. Let's say we share it equally among the parties. So swapping gain, share among the parties. A will get 0.4, that is 0.8 by 2, and B will get 0.4 each. Now next step is to construct the arbitrage strategy. For that purpose, first you observe who is having relative advantage. Relative advantage. Is it A or B? Observe what is the meaning of relative advantage. Relative advantage means both situations are bad, between the two bad situations which is good. Like you also fail, your friend also fail, you scored 35, your friend scored 34. So what do you tell? I'm having one more than you, I'm better. Both are fail only, no? But you scored one more. That one more is what is called as relative advantage. So B Limited is paying more in fixed rate also and paying more in floating rate also. But among the two, which is relatively less is A Limited, because B Limited in floating rate, because they pay only 0.2% more, whereas here they pay 1% more. So relative advantage for B is in floating rate. So first step is to go for swapping gain share. Second step is to identify who is having the relative advantage in which type of loan. Then you construct the contracts and determine the interest rates. For that, what do? You write A Limited and you write B Limited. B goes to bank, A goes to bank, and between A and B they will swap. Okay, now B going to bank, that is our starting point, because relative advantage for B is in floating rate. What is relative floating rate for B? LIBOR plus 0.7. Or let me go for the type of loan first. So B is paying floating rate. If B is paying floating rate, what is the technique I told you in arbitrage? Whatever you pay, receive it first. So you are paying floating rate means receive floating rate. Receive floating rate means you pay fixed rate. B is paying floating rate means A is paying fixed rate. So type of loan is fixed. Starting point is only important, then is very simple. Let's come to the numbers now. What is B is paying it to the bank? B is paying LIBOR plus 0.7. And if he's collecting LIBOR plus if he's paying LIBOR plus 0.7, collect it also LIBOR plus 0.7. So whatever you pay and whatever you receive is nullified. And then B has to pay to A. How much B has to pay to A? Fixed rate. For B, fixed rate is 9. If I write 9, B is not getting any advantage. So what should you do? You have to adjust for the gain. B share is 0.4. 9 minus 0.4, that becomes 8.6. So if without this agreement, they would have paid 9. With this arrangement, they paid 8.6, so they saved 0.6. Now, bank anyway has to pay fixed rate of 8, right? And therefore, if you compute now, B limited will be a balancing figure you can calculate. So what the paying B limited, they are paying 8% and collecting 8.6. So net paying only minus 0.6, and they are paying LIBOR plus 0.7. So what is the effective for A limited? LIBOR plus 0.1. And without this agreement, what they would have paid? LIBOR plus 0.5. Now how much they are paying? LIBOR plus 0.5. How much they are saving? 0.4. So when two parties are there, one party you fix it, other party you can calculate easily. Three parties are there, maybe dealer also will get a share. Then two parties you fix it, dealer will be a balancing figure. Let us look at the step once more. What we just understood. First you compute the swapping gain. This is difference between fixed rate and floating rate. Difference between difference. Then share among parties, maybe dealer also will get one share. Sometimes they'll tell you 10 basis points for the dealer. This is, you should divide by 100, you get the percentage terms. Fine. Relative advantage, person paying 100 interest, within that you choose whichever is less. And then third step, start with entity with relative advantage. He goes to bank, in our example floating rate, other entity goes to fixed rate with bank, and they exchange in the swapping arrangement. And while doing calculation of the interest rate, make sure this gain is also considered while calculating effective interest rates. So this is your interest rate swap, applicable for currency swaps also. Same steps would apply. Okay. Okay. So moving on from interest rate swaps, we'll move to the last category in interest rate management, that is interest rate options. Give me just 1 second. Let me just put the animation for this. Yes, right. Oh, interest rate options. Interest rate options asked in the exams, but not very frequently. Anyway, we will discuss. Interest rate options, there are two types of options. Call options, where the holder gets the right to buy the underlying asset by paying premium. Whereas put option, the holder gets the right to sell the underlying asset by paying premium. And all the features of options applicable here also, that is holder, writer, premium, strike price, underlying asset, which is interest rate here, and the expiry date, everything is applicable as it is. It's a derivative with underlying asset is the rate of interest. So premium is paid at the beginning on reset periods. I should tell you what is reset period means. For example, if the contract is valid for let's say 3 years. Contract is valid for 3 years and the rate of interest is 6 months rate of interest at 8% per annum. Some strike rate, but it is for 6 months. So in 3 years, 6 months, how many times comes? So every year 1, 2, 1, 2, 1, 2. So totally there are 6 reset periods. So within the contract period, for which period the rate of interest is related to, in this example 6 months, they are called as reset periods. At the end of every 6 months, in our example, premium should be paid. So even though overall contract is valid for 3 years, the reset period will contain the period for which the rate of interest is connected to. Okay, so premium should be paid at the end of or at the beginning of every reset period. Rate, strike price, and here it is the rate of interest, strike rate. Option lying with the holder, writer should oblige. All those things will be applicable. Okay, one more important feature here, that is, remember call option. How do you compute the intrinsic value? Intrinsic value is computed as difference between market price minus strike price. Here what do we call? It is called as the market rate. What is market rate? LIBOR, MIBOR, that is reference rate minus strike rate. For example, if reference rate is 8% and strike rate is 7%, that is difference is 1%. But we need amount. How do you convert into amount? You multiply it by lot size, but not only lot size, you multiply it by term. So in our example, 3 year was the term of the contract and reset period was 6 months. Which one will you take? 6 months or 3 years? 6 months. The term, the reset period or the rate of interest, this reference rate is connected to. For example, in our example, it will be 6 by 12. In actually throughout this chapter, interest rate management, one common feature is that. What is that common feature? Once you find out the differential rate of interest, it is in percentage, you should multiply it by two things: notional principal and the term of the loan, or in this case lot size and term of the loan, or the reset period. Fine. Now let's come to the type of the options. We have got interest rate call option, and we had put option. So call option, you know, right to buy, and here it is called as interest rate cap, and put option is called as interest rate floor. Why it is called as interest rate cap? Suppose a strike rate, that is the strike price, strike rate is 8%, and let's say market price under different situation, let me take 10%, 9%, 8% and 7%. Now call option is exercised when the market price is high. So in this case 10% exercised, 9% exercised, 8% indifferent, 7% not exercised. That exercise means at that rate you are going to take a loan, and floor means you are going to invest. So if market rate is 10%, that means you are going to exercise the option. So if you exercise the option, what is your interest rate going to be? Only 8%, not 10%. If you exercise in case of 9%, you pay only 8%. If it is anyway 8%, here you don't exercise, you go to market and your interest rate is 7%. So you see, whatever happens to market rate of interest, either your interest rate will be 8% or less than 8%. So interest rate cap acts as an insurance against increase in interest rates. Why? Because if interest rate in the market is less, you can go to the market and borrow money at a lower rate of interest. But in the market, if interest rate is high, then what do? You borrow using the interest rate option cap only at the strike rate, that is your maximum outflow. So your outflow cannot go beyond the strike rate, of course adjusted for premium. That is why it is called as interest rate cap. So interest rate cap, C for call option, is a call option on reference rate, that market rate such as LIBOR, and it is nothing but right to receive, right to buy or right to borrow. And interest rate floor is like investment, put option. It ensures for investor minimum income is guaranteed. That's why it's called as interest rate floors. A combination of the both cap and floor. So you see cap, C is there, floor, O is there, you mix it, it becomes collar. Anyway, collar is a strategy in the option where you become a holder of cap option and you sell the floor option. You are a holder of call option and you are a writer of put option. That is called as collar strategy. So you make sure that your interest rate is in between, a range bound. It will not go below certain rate, it will not go above certain rate. Now coming to hedging strategy, a borrower will go for interest rate caps, investor will go for interest rate floor. Before we go to merger, let me give you a simple example once, just to compute how it is happening. Suppose strike rate is 8% and premium is, let's say, 0.1% of loan, and loan amount is, let's say, 1 crore rupees, 1 crore, and term of the loan is, let's say, 5 years, but payable interest every 6 months, every 6 months. And this is the thing. So first 6 months, suppose interest rate is becoming 9%. So what should you do? You know the 4-column thing we discussed in case of options: market price, then intrinsic value, then premium, and then payoff. That is what we used to calculate. Here one step you should go further and you compute interest and then you compute effective interest. So market price 9%. Intrinsic value, how do you compute? 9% minus 8%, market price minus strike price. Not only that, multiplied by lot size. Assume that 1 crore is the lot size or the number of contracts into lot size, multiplied by interest is payable every 6 months, every 6 months. If interest rate, reference rate less than 8%, then intrinsic value becomes 0. So this calculation will be intrinsic value. Premium will be 1 crore into 0.1%, whatever number you get. Payoff will be intrinsic value minus premium, you get the payoff. And interest rate, how do you calculate interest rate here? The market rate 9%, interest is 1 crore into 9% into 6 by 12. So you get payoff, you get interest, combination of both, you get effective interest. Like that, 6 month, 12 month, 18 month, every term, depending on the market rates, you can calculate the effective rate of interest. Sometimes what happens, the premium is not paid at the end of reset period. Premium is paid at the inception itself. For this example, though the term is, let's say, 5 years, 5 years 6 months means 10 reset period will come. For entire 10 reset period, they will pay at one shot, let's say 1%. 1 crore, 1% comes to, let's say, 1 lakh. But this 1 lakh is not for one reset period, it is for 10 reset period. So intuitively you feel like 1 lakh is to be spread over 10 reset period. But time value of money to be considered, therefore don't divide by 10, divide by annuity factor at certain percentage for 10 years. So if premium is paid at the end of or the beginning of reset period, yes, you can take it in the premium column directly. But if premium is paid one time, you divide by the annuity factor for number of periods, that number you take it in the column and you start calculating the same 4 columns: payoff, interest and effective interest amount. Some more theory questions can be asked, like what is swaptions? Swaptions means there is option on swap valuations. So like this, theory questions can come. So interest rate swap we have done, interest rate options we have done, interest rate future we discussed, and forwarded agreement also discussed. So this is the holistic view of interest rate management. Now we'll go to one more important chapter, that is merger, acquisitions and corporate restructuring. Okay. Theories are there, you can go through it: synergy, operations, diversification, elimination, taxation, technical advancement. The reason why I'm discussing is because theory question from merger is one of the popular question, and the question have not repeated in the previous exam. Every question in the past 10 years, mergers, they have come new questions. So diversification is one, synergy is one, problem with mergers India is one, like the difference between spin-off and hive-off. Like this, they have asked questions in the previous year exams. Like merger, like why mergers acquisition fail is also one of the reasons. Due diligence is nothing but before you acquire, try to check what are the issues that are applicable in a certain company: taxation issues, legal issues, labor issues and so on. Finding problems. Types of merger: horizontal merger means a company in the same line of business, Vodafone Idea. Vertical merger means the supplier and the customer. Conglomerate merger means unconnected companies, different sectors. Reverse merger means lower company taking over the higher company, the private company taking over listed company. That is reverse merger. Let's come to terminologies in merger. Valuations. Mergers and acquisitions are there, so valuation is a popular thing. Valuation are various categories are there. We have discussed in the valuation chapter also. But in the context of merger, problems which have been asked, based on that I'm giving you these things. Okay, so valuations can be solved based on P ratio. If P ratio is given, that is most popular question in the exam. value of company is net profit into PE ratio, or market price per share is computed by EPS into PE ratio. Dividend discount model, D1 by K minus G, dividend expected at the end of the year divided by cost of equity minus growth rate. And based on cash flow, discounted cash flow, present value of cash flow, year 1, year 2, year 3 or 4, and terminal cash flow like year 5 onwards, then again you discount it. Remember the shortcut, last two cash flows will have same discounting factor, and P ratio is the most important factor from the examination point of view. Now, whenever you acquire, two companies will be there. The company which acquires is called as acquirer. Company which is being acquired is called as target. PC settlement, when company is acquiring, the business is acquired, the purchase consideration may be settled by way of cash or may be settled by way of equity shares. If it is settled by way of cash, then ownership structure is not changed, number of shares will not be changed, and one extra thing is there is concept of levered buyout, where company borrow money and then acquire a company. So because you borrow company and pay purchase consideration, on the amount of money you borrowed, you have to pay interest. Now on the shares, there is changes in the ownership structure. The acquired company shareholders will be there, target company shareholders also will be there, and therefore ownership will undergo a change, and more importantly swap ratio will be there. That is, for every one share acquired, how many shares are issued. We'll come to those terminologies, but swap ratio will come only for shares, will not be applicable for cash. But for cash acquisition, if there is borrowing, then there will be an interest expense to be important while computing EPS. Let's come to swap ratio. Swap ratio is the number of shares issued by the acquirer for every share held in the target company. For example, if it is 3:2, that means for every 2 shares held in the target company, you will get 3 shares in the acquirer company. So by applying swap ratio, target company shares are converted into acquirer company shares. If you want to know total number of share, this ratio you multiply it by the target company shares, or the formula wise I can say target company shares multiplied by swap ratio, also called as exchange ratio, will give you the shares in or shares of the acquirer company. Acquirer company already would have had some existing shares, and these shares will get added. And for computation, if it is favorable variable, it is target company by acquiring company. Let's say acquiring company EPS is 10 and target company EPS is 5, then you do target company 5 by acquirer 10, you get 0.5. Why they get only 0.5? Because their value is less. Lesser the value, lesser is the number of shares. You can remember TA, mostly TA, target company by acquiring company. But some exceptional cases are there, unfavorable variables. For example, in bank merger problem, NPA or bad debts or debt equity ratio, when the ratio is lower the better, this formula also will be reversed. 90% of the cases you will apply this EPS, MPS, P ratio, or net assets of company, book value of company, and so on, market price. But if some exceptional cases are there, especially in bank merger problems. If it is NPA based, then you have to use acquiring by target company. Sometimes they say that what do you say? Sometimes they say that not one weights. They will tell you the swap ratio is based on market price, EPS, book value, and some other thing. So 3-4 parameters will be there. So you get 3-4 swap ratios. They will give you the weights, you multiply, you get a weighted average in swap ratio. Okay, then comes to some formulas. Synergy may be in earnings or synergy in value. Synergy in earnings is earnings of the combined entity like AB, I will say, minus earnings of the acquirer A plus earnings of the acquirer B, that is combined entity minus their sum of independent entities. The excess is called as synergy in saving. Earnings is actually, it is savings in expenses. And synergy in value, instead of computing earnings, you compute the value, market cap of combined entity minus the market cap of acquirer and the market cap of target. Put together how much it is and target company how much it is. Whatever the incremental value is called a synergy, maybe in earnings or maybe in the market cap, that is synergy in value. Okay, so various terminologies you have to understand. Let me explain it to you. Give me 1 second. Okay. First, overall benefit or the value of synergy, that is value of merged entity minus sum of independent entities. I just told you the formula for synergy in value. If they'll ask you what is the value of acquisition for the acquirer or the maximum amount that can be paid, how much of benefit you get is the maximum amount that you can pay, and that is the value of merged entity minus value of independent entity. For example, A, B and merged entity, if I give you, A entity is 1000 crores, B entity is 600 crores and merged entity is 1700 crores. So what is overall benefit will be, that will be 1700 merged entity minus sum of the two, 1000 plus 600, that is going to be 100. That is the overall benefit or the value of synergy. Coming to value of acquisition for the acquirer, with merger it is 1700, without merger it is 1000. So by acquiring the company, their value of the company will increase by 700. So how much maximum they can pay to acquire the company is 700 crores. That is nothing but the value of merged entity, nothing but the maximum amount that can be paid. Net benefit will be overall benefit minus what is paid, and whatever is the amount actually paid is also called as the cost of acquisition. We can say the true cost of acquisition. Like over in this example, let's say they pay 650 crores as purchase consideration. So overall benefit in this example is 700, what we just calculated, value of acquisition minus what is paid to them, 650. So net benefit is 50 crores. If they pay 700 also, then this would have been 0. Okay, so that is the net benefit for the acquirer. And sometimes they'll ask you true cost of acquisition is nothing but whatever paid to target. In our example, though you get 7 crore benefit, you paid only 650 crore. So what you actually paid is called as true cost of acquisition. That I will come to the per share base also, but as of now you can say this is the true cost of acquisition. I'll come to this formula, market price after merger into swap ratio into the number of shares. I'll come to that example in some time now. Apparent cost of acquisition is also there, that is changes for true cost you take market price after merger, whereas apparent cost you take the market price before merger. Let me come to that point now. Benefit for merger for shareholders. Okay, you have to calculate the proportionate shareholding in the merged entity minus value of independent merger. Same thing for acquirer shareholders and same thing for the target shareholders. Let me give an example, you understand better. Let's say A company, B company, number of shares were, let's say 1000 and number of shares were 200, and market price per share, let's say 50 rupees, and here let's say 10 rupees. So market value will be, this is 50,000 multiply, and this will be 200 into 10, 2000, 52,000. Let me make, yeah, that's fine. Then market value 50,000 and 2,000. And let's say swap ratio is given as 5:1 based on market price per share, or let's say 2:1. That means for every one share held, you get two shares. Now let's say 1:2, not 2:1, 1:2. So if you have two shares, you get one shares. So for 200 shares, you receive 100 shares. And market value after merger with synergy, just an example, let's say that comes to 55,000. So how do you calculate? For proportionate holding means 55,000 is the value of the merged entity into what is the proportionate for acquirer. Acquirer is having 1,000 shares out of total 1,000 plus 100, 1,100 share, minus what was the previous value, 50,000. This is the benefit for shareholders in the merged acquirer company. For target company, merged company 55,000 multiplied by they were having 1,000 shares out of 1,100, not 1,100, but these people have 100 out of 1,100, and their previous value was 2,000. So this is the benefit the target company shareholder gets. Okay, now focus on second one, that is most important. This is most important. Focus on this. Acquirer shareholder, what they were having is one share of acquirer company. After merger also, they will have one share of acquirer company. But for target shareholder, it is not the case. For target shareholder, before merger, they are the shareholders of target company. They will have the shares of target company. But after merger, they will have the shares of acquirer company. So for comparison purpose, you need to take an example of swap ratio. Let me give an example. Acquirer market price per share was, let's say, 30 rupees, and target market price per share was, let's say, 20 rupees. And swap ratio, let's say it is given as 1:5, let's say, or let's say 1:2, 1:2 for simple calculation. And market price after merger, let's say for example, it became 36. So for acquirer shareholders, market price after merger is 36, before merger is 30, so they have a profit of 6 rupees. But for target shareholder, the market price after merger is 36, before merger is 20. You can't compare directly because before merger was a target company shares, but after merger is acquire company shares. To make it comparable, you have to multiply it by swap ratio. So if I multiply it by 1/2, I get 18. So actually they have lost 2 rupees. Let's say this is 42 rupees for example. Then you do 42 into 1/2, that is 21. So 1 rupee is gained by target company shareholders. So 42 market price after merger into swap ratio minus before merger was 20. So 21 minus 20 equals to 1. This is the benefit for shareholders of the target company, and or you can also say that is nothing but the true cost of acquisition, because that's what is paid. So market price after merger into swap ratio, that is 42 into 1/2, then whatever number of shares, that is what is actually the number of shares held into swap ratio. Or if you multiply only these two, you get number of shares issued. Nothing but whatever is the value of purchase consideration, that is the true cost of acquisition. True cost of acquisition. If you want apparent cost of acquisition, then instead of taking market price after merger, you take market price before merger. Like in our example, before merger was 30, so 30 into 1/2, that is 15. That benefit what you get versus 20, actually you're losing 5 rupees. That is called as the apparent cost of merger. I repeat, very simple. Please focus. For acquirer shareholder, it is market price after merger minus market price before merger. For target company shareholder, market price after merger into swap ratio minus market price per share before merger. This is also called as benefit for the target company shareholder, which is nothing but the cost for the true cost for the acquirer company. True cost for acquirer company is nothing but the benefit for the target shareholder. If you want apparent cost, the only change is instead of after merger, you can take before merger. That will give you apparent cost of merger. So whatever the purchase consideration you call in accounts is called as cost of merger, true cost of merger in financial management. So this is for benefit for shareholders on holdings of the company. If you want earnings, then what change is going to be there? The changes is instead of market price, you make it as EPS. Instead of market price, you make it as EPS. Instead of market price, you make it as EPS. Instead of market price, you make it as EPS. So this will give you the benefit for shareholders in terms of earnings. If you take market price, that is the benefit in terms of holdings. If you take EPS, that is benefit in terms of earnings. Okay, let's look at some more small points before we go further. Okay, okay, sometimes they'll ask you this: what should be the maximum exchange ratio or swap ratio and minimum exchange ratio or swap ratio for the acquirer company and for the target company, so that current market price is maintained? Like that they can ask you the question. So in such case, look at acquirer is paying something to get the company. When he pay, what is the minimum he would like to pay? You want free, right? Why you people are watching these free revisions? You want free. If I charge something, you don't pay. So as a buyer, the minimum you want to pay is always 0. That will not be asked in the examination. Okay, now think from target company point of view, seller point of view. What is the maximum they'll ask? What is the maximum I can ask you from people? I want everything. You pay 10,000, I want it. You pay 1 lakh, I want it. That's why you see different market prices are there for SFM paper. Some people sell at 6,000, some people sell at 20,000. You pay. And if they charge you 1 lakh also, you pay. People are there to pay. So seller always wants more, so infinity. So these things will never be tested in examination. They will ask you, find the maximum amount the acquirer is ready to pay and the minimum amount the target company is expecting. So for that, I'll give you the formula. So maximum, the outer limit, exchange ratio for acquirer. What is the maximum exchange ratio? From the shareholder's perspective, their market price is unaffected. So market price before merger is at least equal to market price after merger. That is not being changed. Now, how do you compute a market price after merger? You will compute it by the market value of the company after merger divided by number of shares. So market value after merger divided by number of shares. Number of shares after merger. And this market price before merger will be given in the problem. And how do you calculate the market value after merger? Using P ratio method. That is the earnings of merged entity. How do you calculate earnings of merged entity? Earnings of the acquirer plus earnings of the target plus what? Plus synergy benefits. Earnings of the acquirer plus earnings of the target plus synergy benefit multiplied by PE ratio after merger. This P ratio usually will be given in the question. Divided by total number of shares, that is acquirer company shares, that will be given in the problem, plus target company shares which are issued. How do you get issued? Target company shares multiplied by swap ratio. That will give you the shares which are issued, and the swap ratio will usually be X. So this market price is known, all these numbers are known. Calculate this X by solving this equation. That is the maximum exchange ratio that an acquirer is ready to give. From a target company point of view, minimum exchange ratio for target. What is that? Same formula only. MPS before should be equal to MPS after. MPS before will be given, but MPS after merger, you can't take just MPS after merger. Same calculation what you did, the entire part will be applicable here also. But one more thing will be applied, because for a target company shareholders, taking the market price alone is not sufficient. Why? Because this is the share of acquirer company you require for target company shareholder, so you have to multiply it by swap ratio. So all these formulas will apply, and you take the swap ratio and you solve for the swap ratio. That is the minimum swap ratio that the target company would expect. So as long as the maximum swap ratio and minimum swap ratios are interchanging, the merger can take place. But if the maximum exchange ratio is 8 and minimum exchange ratio is, let's say, 12, merger cannot happen. He will not give more than 8. You don't accept below 12. So that means it is not going to happen. But if it is, this is 12, this is 8, so anywhere between 8 and 12 negotiation can take place. So this one thing to be careful. Then mergers can be related to sometimes proxy beta problems are there, that one be careful. Dividend discount models, that be careful. Sometimes they'll tell you the CAPM of acquirer, CAPM of target, then you mix portfolio return will be for the merged entity, that kind of things you tell. Or sometimes they say how many shares to be issued to maintain EPS level, to maintain the current EPS. Then same formula you do for the acquirer or for the target. EPS before merger, EPS after merger. Then earnings of the merged entity divided by number of shares. This P ratio and all will not be coming, but earnings of the merged entity, earnings of the acquirer, earnings of the target plus synergy divided by number of shares. Number of shares is existing acquirer shares plus the shares issued. How do you get the shares issued? Existing target company shares multiplied by swap ratio should be equal to existing EPS. You can solve like this for acquirer as well as for target. And for bank merger problems, you just have to be careful about ratios. CAR is always higher the better, market value higher the better, EPS higher the better, book value higher the better. Only ratio which is usually lower the better is gross NPA or net NPA, net non-performing assets. They are the only ratios. You should reverse the formula in swap ratio, else everything is target company by acquirer company. Hopefully I try to summarize the maximum element with respect to the mergers. Hopefully you can manage with this. Fine. Okay, now let's quickly look at some theory chapters. 5 minutes only, I will not go beyond that. Risk management. There is a saying in stock market: if you can take care of the risk, the returns will take care automatically. Or one more important saying is there: it's not about how much you win, it's about how much you lose. So because risk management is the important aspect, because people will always have uncertainties in the market. How do you manage it? Various kinds of risk are there. They are strategy risk, what kind of business they would like to do; compliance risk, whether they follow all the rules by government or not; operational risk, like how many units to be produced; financial risk, that is whether to take more loan or less loan; how do you pay your loan; what is debt equity ratio; political risk, what kind of political affiliations you have, and which economic scenario, what kind of policies by the government can influence your operations; currency risk, you know, the exchange rate fluctuations. One important aspect in the risk management is VAR, that is value at risk. Value at risk is the maximum loss that can be expected for a certain period based on past experience. So you may go for level of significance 99% or 95% more and so on, but these are the two popular numbers. 99% level of significance means there is 99% chance you don't lose beyond this. So while after calculating this, if I tell you VAR, value at risk is 1 lakh, that means out of 100 days, 99 days you cannot lose above 1 lakh, but 1% chance is there you might lose above 1 lakh also, exceptional. 95% means 95% of the cases you don't lose beyond value at risk, but there is 5% of the chance where you can lose beyond 5%, beyond 1 lakh also. So how do you compute? You compute the amount invested by standard deviation. Not only standard deviation, you also multiply it by Z value. For 99% Z value will be different, they will give it in the problem. For 95% will be different, you can take it in the problem. So amount invested into the standard deviation into the Z value will give you the maximum loss expectation. This is for 1 day. For n number of days, you multiply it by square root of n. Observe, it is not n, it is square root of n. Logic being, standard deviation is always a square root for a day. If you want to simplify it, you should convert standard deviation into variance, means you square it. Then you can multiply it by number of days and then you take a square root again. Therefore, standard deviation into not number of days into number of days square root. So that will give you the value at risk for a day and value at risk for certain number of days. One more theory question, debt securitization. Let me just give you a quick summary. Debt securitization is the process of converting debt into a security. Okay, so how do you do this debt into a security? Presently, let's say banks will have loans, or we say portfolio of loans, pool of loans like housing loan, etc. Popularly debt securitization for housing loans. But they are not able to collect the money. They want to sell it. So what they do, they establish one company called as special purpose vehicle, and they will issue securities to various investors. These investors may be mutual funds or foreign institutional investors or LIC corporations, PF corporations, and so on. So these people purchase these securities and give money. And how this money will be given? This money will be given to the bank. The money will be given. So these people have effectively purchased those pool of loans. So one functions involved are pooling function, originating function, and issuing or redemption function. Effectively, investors have purchased this portfolio of loans. Once the money is collected by the bank on these loans, like when repayment of loan happens, they will give the money to special purpose vehicle and the money will be given to investors. It might be as and when you collect, it might be paid. So there are various types of loans also, you can go through it. If money is not able to collect it by the this portfolio of loans, then investor have to suffer loss. So this issue of securities will be credit rated based on the risk associated with portfolio. So with this process, the bank has converted an illiquid portfolio pooling of loan into a liquid stock because they got the money as against the security of pooling. In other words, bank has sold and investors have purchased. If the money is not able to collect it by the bank, the investor will suffer the loss. Okay. Anyway, the returns, risk and all will be associated with the credit rating agencies. They will credit rate it properly. Depending on the risk of the pool, they will fix the returns for issue of securities. Interest, income and all will be fixed in compliance with the risk over there. Anyway, this is the second theory chapter, debt securitization. Next, you will have startup finance or modus operandi. You can go through this. That is originating function, Just put a better font. Okay. So originator, special purpose vehicle, investment bank, credit rating agency, obligator, and prospective investor. So all the elements I have clearly explained. I'll tell you once more. Originator, the bank which I'm talking about, special purpose vehicle, investment bank who is conducting all the document work, credit rating agency who will fix the rate of interest or provide the credit rating based on the quality of the portfolio, obligator, that is a person to whom the bank has given loan like housing finance, prospective investor like mutual funds, LIC people I have told you. So remember this modus operandi and types of securities are there, you can go through it, and the chart debt securitization. With this you can prepare the theory one easily. Startup, that is actually coming as the last one, startups. So 3-4 possible questions are there. Sources of startup, you talk about these forces: personal financing, like you can take a personal loan, personal credit line, take loan from friends, relatives, peer to peer, like from your colleague, office colleague, you can take loan, crowdfunding, you can take help of many people, basically doing this. You understand crowdfunding. Or purchase order financing, you purchase the equipment, you purchase the materials and tell your supplier, give me extended credit, I'll pay you late, maybe I'll pay you interest, those kind of things. Factoring, where against the receivable, factors give you loan, and not only loan, they'll also receive the money on behalf of you for a commission. In your IPC level you would have learned. Bill discounting method is also there, that is also one of the source. Factoring against the receivable is also one of the source. Whenever you go for investment raising, or you want to meet investor, you should give one pitch presentation, so that why your product is worth investing. So it should have these elements: introduction about the product, team, because people always invest in the people, not in the idea as such. Idea comes later. If people are not trustworthy, you will never get funding. So you should talk about the team, problem which you're trying to face, and what is your solution. And you talk about the business model, uh, how you are collecting money from your customers, projections, P&L account for next 5-10 years, what is your marketing planning, and what about competitors, and ultimately why you require finance. So these 3, 4, 5, 6, 7, 8, 9, 10 points, if you talk about short notes, you can write in exam pitch presentation. Venture capitalist fund is one of the popular question, VC, venture capitalist. So they are the people who are risk takers. They fund high growth companies. Banks usually give loan for established company. If you say, I'm starting a new company, I don't have any background, can you give me loan? I'm starting a new idea. Banks usually don't give loan. Venture capitalists provide, but it has to be a path breaking idea, because they expect the return of 20-30% in a year, not merely like bank 10-12%. So venture capitalists essentially are risk takers who are looking for exponential growth potential companies, ideas, and who will participate in equity. Their intention, they will supply the money, you burn it however you want. I mean, burn it means not literally, you go and make use of it. That's how Flipkart, all these Ola, Swiggy, Zomato, all these people are surviving because of the venture capitalist fund. Byju's, how much money they are investing. But by capturing the market, later they will be able to get higher returns, and then company will get listed and they will be able to sell in the market, or they will be selling it to other people. That is called as exit plans. I'll talk about all those things. So characteristics are long-term horizon, lack of liquidity, they're not planning to sell immediately, high risk takers, and equity participation, not debt. Stage of funding, seed money to test the idea, startup to begin with few instruments, few productions. First round maybe for early sales, manufacturing, and getting an idea, getting a team of people. Second round maybe for further working capital, and third round, fourth round for marketing, and so on. New profitable company, new venture will come, and that is as and when they want more money, and if they're comfortable with the idea, they will provide more money. Coming to structure of venture capital is domestic funds, where domestic people come and invest money. Offshore funds means foreign companies, foreign people make a company and invest in Indian ideas. Offshore structure means foreign vehicle invest in Indian companies. Unified structure means combination. Overseas people also will come, domestic people will also come. Combination will be investing in Indian companies. Some theory: startup initiative, Government of India on 16th of January, definition of startup is only for central government schemes, only government schemes. They say if startup means incorporated within 5 years, annual turnover below 25 crores, and only for the purpose of working capital innovation and all, they'll give you loans. Even you have income tax benefits like 3-year tax exemptions. Income tax people, I don't know those things. So these things you can write it. So 3 broad theory questions I would say, or 4. One is related to the source, second pitch presentation, you can say problem faced, and then about venture capital and about the Startup India initiative. These are the popular theory questions you can expect in this chapter. So I tried my level best to include from 0 to 100 all theory chapters and practicals. Wherever examples are required, that also I've given. I hope with this one-day marathon revision you do well in examination. My email ID is there, my mobile number is there, my Telegram channel is also there. So I request, please join the Telegram channel. I will share all my documents there. If you have any doubts also, I will be solving in the Telegram channel. Hopefully this 9-10 hours efforts of mine will help you in clearing the examinations. The result, because we are not charging anything for this, it's free of cost. The only benefit or only return that I am expecting from you is you have to pass exams. So once you have written the exam, if you think this is useful, please send me a message telling this was useful. Or if you want some more points to be added, please leave a comment. Going forward, I'll try to involve those points also. Anyway, hopefully this session was useful. Your time is very, very crucial and precious. Hopefully I have done justice. Okay, so all the best for your examination. See you soon at CA. See you soon as a CA. Okay, so all the best for examination, and thank you so much for your time.